Good morning. It is 9 a.m. on Friday, February 9th. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sozzi. Let's take a look at futures here this morning because we have seen an interesting turnaround already in the futures, which were selling off overnight and into the morning and then turned around an hour or so ago and are now indicating a very slightly higher open on this Friday morning. We continue to watch the bond market very, very closely as well, in part because we saw a 2% handle and we still got it on the 10-year yield. Even though it's off by 2 basis points, it still remains above that 2% level. And that's a threshold that indicates, guess what? People think that rates are going up and perhaps more aggressively. We're going to be talking about that because from burritos to Barbies, prices are going up. What's the Fed going to do about it? We're going to discuss the central bank's game plan and what it means for markets. Sell now, pay never. Firm shares tumble after the company forecasts revenue that missed some estimates. We're going to break down the numbers. And next hour, we'll speak to CFO Michael Linford. And sitting pretty, Tapestry CEO Joanne Crevoiserat joins us for an exclusive interview after reporting record revenue and strong demand for Tapestry brands. That's Coach, Kate Spade, and Stuart Weitzman. That's later this hour. But first, we do want to talk about the inflation and interest rate outlooks. Brian Chung, you see him right there. He is here with us. And of course, we had not only yesterday's CPI number, Brian, we also had an interview on Bloomberg with James Bullard, where he talked about a potential 50 basis point increase at the March meeting. And we have seen people on the street really start to once again get more aggressive in their expectations for the Fed.
Yeah, how dramatically things have changed. When people were having their coffee yesterday in the morning before 8:30, the expectation was that the Fed was going to raise by 25 basis points, a single rate hike in the next meeting. And then you fast forward to now and markets overwhelmingly pricing in a chance of a double rate hike. But let's unpack exactly what happened yesterday. Again, starting off with that inflation number coming in at 7.5% on a year-over-year basis as the consumer price index reported yesterday at 8:30. That is the fastest pace that we've seen since 1982. And that had a lot of people wondering, well, it was also above the street's expectations, and it's probably above a lot of the Fed officials' expectations as well. So the Fed needs to get more aggressive on quelling this inflation problem, which is really starting to kind of get away from them. So, of course, you have markets that started to price in the odds of a 50 basis point hike. We had Matt Lozzetti from Deutsche Bank on the show shortly after the print saying they're expecting a 50 basis point increase, which, by the way, will be remarkable because the Fed hasn't done that since May of 2000. And then you had James Bullard, the St. Louis Fed president, someone inside the ivory tower, actually outright telling Bloomberg he would support a double rate hike in the Fed's next meeting in mid-March. That's why, as of this morning, you see markets that are betting. These are really Fed funds futures markets, which are bets on where Fed policy could go in the future, now showing an 85% chance of a 50 basis point move in the next meeting. You even had some like, for example, Tim Dewey over at the University of Oregon, an economist who actually I think works now for another agency, but he was saying, look, I think the Fed should make an emergency announcement sometime over the weekend. Now, just to kind of step back from that, there's no expectation that the Fed is going to do something like that. My kind of read on everything is that this isn't necessarily enough for the Fed to want to do so. One big reason, the Fed needs to get another inflation print before their next meeting in mid-March, and that could also sway things in the other direction. Imagine if that print ends up coming below expectations. Either way you cut it and slice it, it just shows the volatility that markets have right now, the sensitivity that they have to these inflationary prints, and really the difficulty for the Fed to try to message what comes next.
Well, we've got some Fed speak coming next week as well, so we'll get a little more color from the Fed officials who'll be speaking at that point, and a lot of speculation in between now and the next meeting. Thanks so much, Brian. Appreciate it. Well, one of the reasons that all of this has come to a head, one, it's yesterday's CPI print, but it's also the drumbeat of company after company after company talking about raising prices. We talked to some executives that are doing that over the past week.
At least for the next 2, 3, maybe even 4 quarters, I don't see prices retreating. I don't think labor is going down in the near term. And I don't see, in terms of all the ingredients that we buy, our beef, our chicken, we don't see those ingredients really retreating until at the earliest, the end of 2022, maybe even into 2023.
But as we work through this environment, we also know that we're going to have to continue to adjust our model to preserve the profitability at the restaurant level.
Based on what we see right now, yeah, it's going to be high single digits to 10%. And that is very much a function of the input costs going up as much as they are.
We did raise prices in the third quarter of last year, and it is one of the options we consider given these times of inflation. But when we raise prices, we always keep consumers in mind. We are being very thoughtful and are committed to maintaining the highest quality and the best value for consumers.
So that is just a sampling, because as we know, Saz, there have been so many companies that have been doing this. And the question that we've been discussing, among other things, is when will consumers push back? It hasn't really seemed to have happened, at least not the critical mass as of yet. And as we heard from those executives, it doesn't seem to be abating right now.
Julie, I just want to go back to what PepsiCo CFO Hugh Johnston said. Now, I've covered PepsiCo probably 10 or 11 years. I have never seen a company of that stature come out here on live TV and say, hey, we might raise our prices 10% this year. But I think it really underscores the legitimate pressure a lot of big companies are in terms of labor, transportation, if you're a food company, grains, cooking oils, you name it. These costs are going upwards of 20, 30, 40, 50% in some cases, and they have no other choice. They are publicly traded companies. They're trying to protect their profit margins, and we, the consumers, are going to have to bear the brunt of it. But, just staying on inflation, of course, that's why you're seeing a lot of folks out here on the street come out here this morning and lift their rate hike expectations. Goldman Sachs, Jan Hatzius, he was at 5 rate hikes a couple weeks ago. He is at now 7 rate hikes for this year. I've also read a couple notes that perhaps you see an intra-meeting emergency rate hike before the Fed meets in mid-March.
Although, right, as Brian Chung just pointed out to us, that would be that
hasn't happened since '94
right now. It's not going to happen. Let's just put that to bed right now. There's not going to be an emergency rate hike. I don't make predictions. I'm making that prediction. It's not. Okay. It's not happening.
I would tend to agree with you. I would tend to agree, Julie. I think you would have to see really just more startling signs of price increases. Now, the CPI is not helping matters anymore, but still, I think you would need to see 10% plus on the CPI headline to even think about an intra-meeting rate hike from the Federal Reserve, at least ahead of March.
Yeah, I think, or you would have to have some sort of exogenous shock that has nothing to do with any of this, right? That would cause some sort of tailspin, or spike, or whatever it may be. Be that as it may, I want to bring in somebody else who has a view on all of this, and that is Hugh Johnston, Chairman and Chief Economist at Hugh Johnston Economics. Hugh, it is great to see you. Where do you stand on all of this in terms of what you think the CPI did to the expectations about what the Fed is going to do?
Yeah, Julie, you're right. There's not going to be an intermeeting rate hike. And we've seen a lot of comments from various members of the Open Market Committee. You've heard some of the dark things being said, both by companies as well as some reference to, say, Bullard. No, most people are saying there won't be an intermeeting rate hike. We'll probably have to wait till March. We will wait till March. And in March, we won't get 50 basis points. We'll only get 25 basis points. There's a lot of hysteria that broke out when we saw that consumer price index, and that created a very sharp decline, of course, in the stock market based on the expectation that the Fed was going to be more aggressive than 4, maybe 5 hikes this year. Quite frankly, you see the market starting to recover today, and I think that reflects the fact that now that more sober minds have sort of taken over, we're really still looking at 4 to 5 increases in interest rates in 2022. And it's going to be, and this is important, it's going to be data dependent. You're going to see other numbers, including another consumer price index and employment number before the March meeting. And as time goes on, we'll see more information, and the rate increases or changes in rates are going to depend on what the data looks like. But right now, your best bet is 4, maybe 5 in 2022. Don't get hysterical. Don't talk about intermeeting. Don't talk about 50 basis points in March. We're still about where we were before we saw that very, very high print on the consumer price index.
Hugh, you know you're my guy. We've talked many times through the years, but let me push back on that hysteria. Shouldn't there be a little bit of hysteria in the broader market? We were talking about yesterday, the price of my deodorant has nearly doubled. It has nearly doubled. And that's just one product out of many aisles that have gone up significantly in terms of inflation. Doesn't the Fed have to step up here soon and be aggressive and stomp this stuff out?
You know, you guys had meetings or you had some interviews with a lot of companies. Those companies were service companies. Let me invite you to take a look at some of the manufacturing companies and what's going on there as well. And that's also important. How about automobiles? Automobile sales are extraordinary now. They're very, very strong. And that's largely a reflection, incidentally, I think, in response to the fact that we're seeing the shortages of semiconductors start to be relieved or abate. And you're seeing signs right now across the board. You know, these are not strong signs. These are not things I would bet a lot on, but you're seeing improving labor market conditions. You saw the increase in the labor force. It points to a little bit of an increase in those upward pressure, tightness in the labor market and upward pressure on wages. You've seen some better improvement on the blockchain, on the chain, the supply chain problems. Purchasing managers. The percentage of purchasing managers that are seeing slower deliveries or bottlenecks, that's come down quite a bit since November. The percentage that are paying higher prices, that's come down a lot since. So the point is, what I'm trying to say is, this is not all dark. And in time, I'm crossing my fingers when I say this, I think you're going to see, for very sound reasons, you're going to see the rate of inflation start to come back down towards, maybe not the levels, certainly not 2%, but back down towards 3.5% to 4%. And I think you're going to see that in 2022. This is not all dark. And you got to look beyond the services and you got to look at manufacturing. Things might get better than you think, particularly when everybody's kind of at an extreme right now.
So it sounds like you think that, you know, you're still on team transitory, right? In other words, you think that even if the Fed didn't tighten, we would start to see pricing moderate.
Yes, that's absolutely right, Julie. And as I say, you see those leading indicators of inflation coming down, but there's a lot of other reasons, sort of technical reasons, which I think that's going to come down. Now, I'm saying that as a forecast, but I'm also saying that as a hope and a prayer. Look, it's not for sure, it's not certain, it's not guaranteed, but you look at the numbers, Julie, and I think you can make the case. Look, we're not going to have a grand slide in the rate of inflation, but it's going to come down to much more moderate and manageable numbers, in my judgment, second, third, and fourth quarter of this year.
7 rate hikes this year, as Goldman suggested this morning. If that does actually happen, does that mean S&P 500 fair value under 4,000? And if so, how do you play that?
Brian, I haven't worked the numbers through. I wanted to do that this morning before I got on with you to work those numbers through. If you have something like 7 increases in the federal funds rate in 2022, you're right. I mean, that means higher interest rates in 2022, but we're not going to be going to what I think we were going to go to, which is upwards of, say, 235. We'll go maybe a little bit higher. Price earnings ratios coming down. Upside potential for the stock market coming down. I don't know if we're talking 4,000, but we are certainly talking lower than we are right now. The markets will price in, but they're not going to price in 5, 6, 7 right now. Well, maybe 5, but not 6 or 7. That's not going to be in the cards. People are not going to price that in. Investors are not going to buy into that. So I think we're really still talking about the markets, and I think they've done a good job of it, of pricing in 4 or 5 increases in 2022. And that's it for now. And now let's watch the data and listen to what officials of the Federal Open Market Committee say about what they're going to do about the data or about interest rates. I think we're talking 4 or 5. I would not be talking 6 or 7. I think Jan Hatzius at Goldman is wrong.
So as we take a deep breath on all of that, what do you do? What are you recommending right now? What's the strategic move right now when it comes to equities?
Yeah, Julie, it's a great question. The problem is we're in a low return environment. And the problem is that even though it's a low return environment, it's going to be a low return, but it's going to be okay for the equity markets. But, you know, the problem is a low return environment, it's still going to be the case that equities are going to outperform fixed income from a return basis, on a return basis. So you got to stay overweight in equities. I wouldn't change that weighting. The only thing I would do in portfolios is if you're a little bit scared or nervous about this current inflation hysteria or outbreak, maybe shift a little bit of the portfolio towards defense. So it's not bad idea to be looking at consumer staples, not a bad idea to be looking at healthcare, maybe utilities. I hate utilities in a bull market. They don't work, but maybe if you're really worried about it, that would be fine. But don't forget bull market sectors, and technology still has positive relative performance. So don't go too far from technology. That'll help you a lot if this market turns out the way I think it'll turn out, and it'll still be a positive market. Equities will continue to outperform, and the bull market sectors or economically sensitive sectors will be the best performing sectors inside the equity markets.
Hugh, always good to see you. Thanks so much for all of this. Hugh Johnson, Chairman and Chief Economist at Hugh Johnson Economics. Thank you. Coming up next, we're going to be looking at shares of Affirm. They plunged during the regular session yesterday after earnings were inadvertently released early. They're down another 9% this morning. We will talk about why.
Welcome back to Yahoo Finance Live on this Friday morning. Seeing shares of Affirm being absolutely smacked around here in the pre-market after the company's earnings last night. And Julie, a little bit of a confusing quarter that ultimately I think has placed Affirm in battleground stock territory. There are a lot of analysts that have come out here on the street in fierce defense of Affirm, and then you have other guys like a Jefferies downgrading their rating in the company. I think there might be some confusion on the street on how Amazon revenue is accounted for, and perhaps they didn't like what Affirm said with respect to their guidance that they put out last night.
Yeah, let's just talk about the overall story first of all, and then we can kind of dig into that question about the company. So first of all, we should mention the results came out early yesterday via a tweet, and initially the results look good. They just said revenue was up 77% to $361 million. That's better than estimated. Also, the company came out, on the flip side, I should say, the company came out with a net loss that was wider than estimated. They said the tweet was a mistake. that they attributed to human error. But even after they came out with the whole results, you saw a lot of turbulence in the stock. Gross merchandise volume for the quarter more than doubled. Active consumers more than doubled to 11.2 million. So the company trying to emphasize what went right. One other thing that didn't go right, I think it's fair to say, is the forecast for the third quarter, the fiscal third quarter. Revenue of $325 to $335 million is what the company's expecting. And that leaves it, the midpoint of that basically is below what analysts had been predicting. So that's like the hard numbers. But to your point, if you dig under the hood, it does seem to have more to do, or at least partly to do, with revenue recognition. They have that partnership with Amazon, which I believe the stock spiked when they first announced it, right? But now I guess there's some confusion around it.
Yeah, I think the market took it when they signed that deal with Amazon, Julia. I think the market or an analyst, I should say clearer, they expected a large lump sum of sales and profits from that deal. But what appears to be happening is those accounts are more interest bearing, and that revenue will just accrue over a longer period of time rather than upfront. It's something I think a lot of the analysts on the street just didn't model for correctly.
Well, hopefully we can get some clarity from Chief Financial Officer Mike Linford when we talk to him a little bit later on. And one more note here, when you look at the stock and how it has done, you can see there Affirm versus Amazon. But what we should point out about Affirm is, even going into this, as of yesterday's close, well, of course, it fell quite a lot yesterday, but it was down 64%. If you take out yesterday's close and look at it even before that, it was down by a large amount as well, about 55%. So it's not as though, expectations were lofty going into this and then people got caught off guard. Expectations were already low. So I think that's something important to note as well.
That as well, and in addition to, I think they emphasized on the conference call, they remain in customer acquisition mode instead of trying to switch on those profits here over at Affirm. So again, mixed emotions, I think, on the street on what their next move might be and how their financials will shape out from here. But again, we'll put all this stuff to Affirm CFO Michael Linford, who we'll be talking to really coming right up 10:40. Looking forward to that chat. All right, coming up. Earnings season refuses to go away. It just absolutely refuses to die. We're back with look results from Under Armour, Zillow, and I don't know, maybe 12 others. Stick around.
Welcome back to Yahoo Finance Live. We're a few minutes from the opening bell, and there's some more movers that we were watching this morning. Sazi and I looking at Under Armour, and that company, sort of a lot of different pieces to this commentary. So first of all, let's take the fourth quarter earnings. As you can see there, beating estimates, just about double what analysts were looking for. Revenue also coming in ahead of estimates. But on the flip side, the company talking a lot about supply chain issues that it said will have material impacts on the spring and summer season and maybe beyond that. So this quarter, Under Armour says revenue is going to grow at a mid-single digit rate compared with the forecast that it made back in November for low single digit growth. So you would think that that would be a little bit better, but at the same time, it looks like it's going to get hit by supply constraints. So when I say it's sort of mixed here or a little bit confusing, the outlook, that's what I'm talking about, Saz.
Yeah, Julie, this quarter from Under Armour gets a bleh rating for me. I mean, really, it wasn't, they beat on earnings, but the outlook was about 12 cents below consensus for the first quarter. And if you go down to the bottom of the earnings release, and to your point, look at what they had to say about inventories. Inventories down about $85 million year over year. So you are probably concerned, do they have enough inventory against all of these supply chain bottlenecks to meet just that spring demand? And secondarily, we've also heard from, I think, a lot of retailers, Julie, that January was slow. So there's a lot of expectation, hopefully, that sales bounce back in February and March for retailers.
Yeah, and they're also talking about gross margin being down 200 basis points compared to last year, this current quarter. And so that's sort of similar also to some other companies that we have heard from. So we'll continue to watch this one as we see it trend a little bit lower. On the flip side, we got Zillow. And Zillow also, so it's interesting, Under Armour called this a transition quarter, the current one. Zillow is certainly in a transition as well as it gets rid of some of the inventory it had as part of its iBuy program. The loss shrinking for the company, the loss coming in better than estimated, even as revenue came in better than estimated as well. For the first quarter, Zillow is estimating revenue of up to $3.44 billion. It looks like that is better than estimated as well. The shares are up some 15% this morning. And the company saying that the net impact of those iBuying operations, the wind down of inventory, operating costs, restructuring costs, that all of that will end up being cash flow positive as they go through that transition, Saz.
Well, this earnings call for me, Julie, definitely conjured up some laughing, some LOLs for sure. Let's keep in mind, this is a company that saw its stock price in early last year about $202 at its high, essentially now down in the toilet at under $50 because of their really operational miscues in buying homes now that they continue to sell off those homes. And while I was laughing on the conference call last night, they had the hubris, I should say, co-founder Rich Barton and his team saying, we're going to put out 2025 targets looking for revenue of over $5 billion and $2.25 billion in adjusted operating profits. That is a 4-year compound annual growth rate for sales and profits of 24% and 29% respectively. And to me, they look absolutely absurd. And secondarily, it's hard to believe those type of targets coming from a team that just has destroyed the stock price.
What about the housing super app? Saz, that's what they're
Doesn't do
working
it for
on
me.
now.
Doesn't do it for me.
You're not excited about a housing super app?
Not excited about it. They have a lot to prove.
Well, that's something that the CEO, Rich Barton, touted also, talked about that it would help people schedule tours and sort of take them through different steps of the buying process. We'll see. He's talking about $5 billion in annual revenue and 45% margins on EBITDA by the end of 2025. We'll have to see what happens here. All right, let's take a look at futures here this morning as we get ready for the opening bell. Looks like we've got a mixed picture at the moment. There's the opening bell on this Friday morning, and sort of a muddle, if you will, in terms of stocks here, because investors are trying to figure out what the heck is going on, right? Are there going to be 5 interest rate increases this year? Are there going to be 7? Are there going to be more? Are we going to see a 50 basis point hike at the March meeting? Are we not? What is not just the wind down of the bond buying program, but the wind down of the balance sheet? What does that look like? What's the effect on the economy? And oh, by the way, all of this happens with a lag. That's something to think about as well. The Federal Reserve raising interest rates, it's not like it raises rates and inflation goes down. So by the time all of that makes its way through the economy, what are going to be the underlying effects on inflation and what will be happening then? Yes, Brian Sazi?
Wait, so you're telling me that my deodorant might go from $14 to $20 soon? Is that what you're teasing to me?
Oh boy, you and the deodorant. I've never talked about deodorant so much in my entire life.
Just tying that thread throughout all the shows, Julie. Just tying the thread. We do.
It's a thread. It's a bludgeon. I don't know what it is. All right, we're gonna send it on over to Jared Blickery. I won't ask about his deodorant buying habits. I will ask about what's going on in the market as we get underway this morning.
Yes, just a few thoughts about what's going on. We had that huge reaction to the inflation print yesterday, and then Bullard comes out, says 100 basis points by July 1st, and the market seemed to be absorbing it pretty well. But I think we have to keep in mind that markets react to monetary transmission policies. The transmission period can be up to 18 months, and we see that it takes time for these things to work their way through the economy. We're still buying bonds here. The Federal Reserve is still buying bonds. They have not wound that down, have not raised interest rates. They're going to do that in March. And then they're talking about quantitative tightening. That's winding down the balance sheet, actually selling bonds into an illiquid market shortly after that. This has never been done in such a short period of time. I think QT, if the Fed goes there, and I don't think they're probably going to get there, but if they do, that's going to be the straw that breaks the camel's back. That's going to be what sends the market down, because most people way back in 2018, before Fed chair made that misstatement saying that QT was on autopilot, that was the last time we were doing QT, that tanked the markets along with a couple of other policy mistakes, including interest rate hikes that were too great at the time. I see no reason why this time would be different. In fact, I think it would be worse. So having said that, I'll get off my soapbox and let's go to the Wi-Fi Interactive, where we see the 10-year T-note. Well, this is a 5-year T-note yield that is down 4 basis points after an absolutely huge day yesterday. 10-year also following suit. That's down about 3 basis points. Want to take a look at the S&P 500 here, because as I've been saying, we are just trading in this sideways range as we have for the last couple weeks. And none of this really matters until we break that range. We break to the upside, probably going to get to at least new nominal highs. I'm not sure it's going to be a huge surge beyond that, but probably at least test them. We go down, we're testing these lows and probably going to break them. Here's the NASDAQ 100, I believe, yes. And we see a lot of green here, not a lot of dark green. Probably going to be some earnings stories here, but Amazon notably down about 12 basis points. And let's take a look at the sector action here. We have utilities, that is in the forefront, getting a little bit of a relief from yesterday. Also real estate, those sectors were hit pretty hard. Tech also up there, but so far just kind of a ho-hum day in the markets, guys.
For now, you never know what's going to happen. Jared Blickery, thank you so much for breaking that down for us, including talking about that interest rate increase and the balance sheet effect on the market. We got to talk about Expedia as well real quick. That's another mover that we are watching, another company that came out with earnings. And you can see here, this is another that beat on the bottom line, but there is a slight miss on the top line as well. And the company talking about the sort of whipsaw that it has seen as a result of COVID-19 and the effect on the travel industry. The CEO of the company talking about, that obviously they saw a big depressive effect, then things came back quickly, and then Omicron caused them to go down to some extent. Again, the shares are trading higher by 2.5% here this morning, Saz.
You're still smack in the middle of a pandemic, Julie. One of your key highlights that Expedia put forth, top bullet point for the company, total revenue was down 17% compared to the fourth quarter of 2019. So that is one of their highlights. But I think underscores just the challenges to start the year for many of these travel companies. This is something we heard from earlier in the week over from Trivago, Alex Heifer, the CEO of that company, on our network, discussing, things remain sluggish out there. It's challenging when it comes to business travel. And I think you're seeing a lot of that within these Expedia results as well.
Yeah, most definitely. I mean, you see a rebound, right? Room nights stayed that were booked on Expedia up 74%. Sounds great, right? But you compare it, of course, with up the prior year that was virtually no travel going on. And the estimate, by the way, for those room nights stayed was 97%. So it's interesting that we didn't see the analysts sort of ratchet down their estimates a little bit more going into this report, given the effect of Omicron. But nonetheless, the stock is not really being punished as a result of all of this, perhaps because there is this understanding that things are now coming back, perhaps, and that people are getting back out there?
Yeah, clearly, I think all these stocks are trading off what could be really a nice summer for the lodging sector.
Here's hoping. Here's hoping we all get out there and take vacations, perhaps, Brian Sozzi. I know.
Yeah, probably
I
not.
know. All right. Well, I will be. You're on your own, buddy. All right, we're going to take a quick break. When we come back, Coach parent company Tapestry lifting its annual forecast as consumers continue to splurge and splurge more on luxury handbags and apparel. We're going to discuss the results and what's next with the CEO in an exclusive interview.
Tapestry's better than expected holiday quarter perhaps got overlooked in Thursday's market round, but there was much to like. From the retailer's earnings release, sales at Coach and Kate Spade were up nicely. Execs at Kate Spade has hit an inflection point in its turnaround, and Tapestry also lifted its full-year sales and earnings outlooks. Joining us now for a Yahoo Finance exclusive is Tapestry CEO Joanne Provoicerat. Joanne, nice to see you again. Appreciate you taking the time on this busy Friday morning. Now, you came in a couple years ago now to turn this company around. Is the turnaround over and you can say that, hey, we're back in growth mode?
Well, good morning, Brian. Great to see you again. And it is clear that the transformation efforts that we've undertaken are delivering. We delivered a record holiday quarter. We did see, as you mentioned, a significant inflection at Kate Spade, and also continued outperformance at Coach, and strong growth and a return to pre-pandemic levels at Stuart Weitzman. So a lot going well right now. Our transformation is delivering. We delivered revenue growth for the quarter, the holiday quarter, 27%. That's 18% ahead of pre-pandemic levels. And to your point, this transformed business model, we're focused on getting closer to our customer, leaning into digital and moving with speed. And we saw strength in digital this quarter, increased customer acquisition and pricing power across all brands. So a lot to like, as you said, in the quarter.
I'm guilty, Joanne, of spending, I think, too much time looking at what you are doing and have done over at the Coach brand. It is 75% of your revenue, so I understand. But I think it was a very important point you mentioned that Kate Spade is at an inflection point. Why is that the case? And do you think some of the margin gains you have had in that brand are sustainable?
Absolutely. Standout results in the quarter and a significant inflection point. But this is, driven by first product, people, and our focus on the consumer. And it's an inflection that's been building over a number of quarters. The second quarter results have really strengthened our confidence in our long-term opportunity at Kate Spade to build a $2 billion brand in our future. And I do want to recognize the team for the results they've delivered. As I said, this has been building over a number of quarters. The team really leaned into the Tapestry platform and in our acceleration program to rebuild the foundation of the brand and return Kate Spade to the brand our customers really love. Q2 highlights, I'll just touch on a few, but we saw tremendous top line growth, 33% on the top line. Kate Spade performing 16% above pre-pandemic levels. So really strong inflection in the quarter, continued strength in digital, acquisition of new customers, and importantly, we're reactivating lapsed customers. So customers are coming back to the brand at increasing rates. And we saw a low double-digit increase in handbag AUR over the quarter, which is indicating pricing power. So the product work that the teams are doing, introducing and developing these platforms, new platforms, both the strong core offering that we've been building, as well as new, all performing, selling more at regular price. And our brand awareness is growing in the marketplace. So a lot of good things happening at Kate Spade, but still a lot of runway ahead.
Joanne, it's Julie here. I want to ask about the various selling channels because we've been showing some stats and you mentioned the enormous growth that you guys have seen in the digital channel. But I'm just curious what the sort of cadence looks like currently, sort of coming off of the Omicron wave in terms of your own store traffic, but also through, say, department store channels, for example. How are you thinking about that strategy going forward?
Well, we're 90% direct-to-consumer business, over 90% direct-to-consumer. And, one of the things we saw happening even pre-pandemic was that customer shopping behavior was changing. And we leaned into our capabilities in digital and certainly coming through the pandemic, shopping behaviors and those digital trends have only accelerated. And we're finding a tremendous amount of success in building and connecting with consumers, where they are. We are putting our brands in front of consumers and engaging them where they are. And that's increasingly in digital channels. We showed strength in digital this quarter with strong double-digit growth on top of strong double-digit growth last year. And we continue to see that growth even as brick and mortar trends improve. So, the digital engagement is here to stay. The way consumers are shopping and where they're discovering brands is changing. And we're continuing to innovate in this space so that we can put our brands and engage consumers where they are. And I think it's important to know, we expect our digital business, we're achieving scale here. We expect it to grow to be about $2 billion this year. And our digital business has carry margins that are accretive to total Tapestry. So at $2 billion, it's a big business, but only a third or less of our total business. So we see more opportunity to grow in the digital space. And, and we expect that to be a tailwind to operating margins as we go forward as well.
And Joanne, you have been a big proponent of using data to inform what bags and products you put out into the marketplace. What are you seeing in terms of new consumer use cases? And I'll use me as an example. I needed a briefcase on the run for an actual in-person meeting. That hasn't been the case for the norm. Went to your outlet, picked up a bag, and I was out at my meeting. What are you seeing from consumers here?
Yeah, exactly that. We're seeing consumers very excited to be out and about again. And we're seeing actual trends across the spectrum. Hands-free crossbody bags have been performing, and the hands-free trends that we've been seeing in the market continue. So that business continues to be strong. But the return to work and our totes business, backpacks, totes, briefcases are also performing. So we do see a consumer who is excited to be out engaging in the real world again. And Julie, you know, the excitement, I know you're talking about travel in your last segment, you know, the excitement to be out and engaging with people in the real world. Our occasions business is working, and Stuart Weitzman, the bridal business, has been good. So we are seeing, you know, an optimistic consumer who's excited to be back out, and our brands are positioned perfectly to help and support those customers.
I am all about the hands-free. I'll tell you that, Joanne. I migrated away from the carrier bag, I guess, a while ago. I am curious, otherwise, are there any product lines that you're particularly excited about, or any coming trends that you think consumers are going to be really excited about when it comes to your various lines?
Yes, we have, you know, seen a lot of traction. We're rebuilding the core. So one of the things we're really excited about is that our core product is performing, which is very important and will sustain our business. At Coach, we're leaning into the icons, but we're also amplifying those icons every year with newness. And you know, I'll use our Tabby bag as an example, where Tabby is a loved brand. It's becoming a new icon in the business, but we've amplified that with a pillow tabby, which registers fashion on top of that and breathes new life into the product, but also carries us forward. As I said, you know, the return to work and occasion is performing. Bridal is something that we see consumers and occasion wear, both at Stuart Weitzman, but also at Kate Spade. And we haven't talked as much about Kate Spade, but the brand continues to perform again with the core offerings, but the novelty performance in that brand also carrying both tremendous emotional value with consumers. We're seeing traction in the product. We talked about on our call the sequined sliced pizza bag, which was a top performer through holiday. You know, that consumers carry to their holiday party, and who doesn't want a slice of pizza after a holiday party? But it was a hit, sold out at regular price, over $300 for that product, and you know, was a hit across our social media platforms. So we're continuing to get close to our consumers, build the core offering that we see them coming back to again and again, and then delivering the fashion that registers emotionally with our consumers as we move forward.
Hey, full disclosure, Joanne, I was emotionally happy after I got my new briefcase a couple of weeks ago. I took photos of myself, and frankly, I look great. But always great to see you, Tapestry CEO Joanne Crevisera. Good to see you. Have a great weekend. We'll talk to you soon. All right, our old friend Sam Rowe from Ticker.co. Love this guy's newsletter. He returns with zillions of thoughts on the markets, economy, and life. We'll be right back.
Well, this has been an interesting earnings season, hasn't it? Some really big hits and misses, some big divergences, a theme of companies raising prices. But what are some of the takeaways as we move through earnings season? Sam Rowe is here to help us make sense of it. He is TKR.co editor. Sam, I got to say, every single time I say the name of it, I feel like I'm saying it wrong.
It's kind of set up so that it could be pronounced however anybody wants to pronounce it.
Oh, I like that. Okay.
Of course.
I prefer to call it ticker.
Ticker. Okay. Ticker.co editor. There we go. And you've been watching this earnings season, and not just this earnings season, but the reactions to it coming from the street. And it's interesting because you noticed a trend that people are raising forecasts coming out of this.
Yeah, it's interesting. With every earnings season, you're always trying to extract, what are the big micro themes, right? Like, there might be a discussion about prices, there might be a discussion about geopolitics or whatever. But I think this time around, the big story is that in aggregate, expectations for earnings are up. Generally speaking, companies have been beating their expectations for earnings. Analysts are tinkering with their numbers, here and there. But in aggregate, the expectations for forward earnings have been up.
Sam, you and I are battle-tested market veterans. How crazy do you think all this talk of an intra-meeting Fed rate hike is? Hugh Johnson, we just had him on, longtime wizard of the markets. He shot it right down. What do you think?
I'm probably not as up to speed with the Fed and all the intricacies of monetary policy as most folks. I do read a lot of the research that does come out, and basically, to me, it kind of sounds like the CPI report was a little bit hotter than expected yesterday, but there are a lot of people who are pointing out that CPI was 0.1% higher than expectations. So that's the first question, right? Was it really that much hotter than expected, or just marginally hotter than expected, and just in line with this general theme of inflation is hot and the Fed is going to raise rates? And then secondly, there's this whole question of, what kind of a signal does it send what if the Fed were to do an intermediate hike? Sure, it's one thing to fine tune things, but to do something that's, somewhat unprecedented, sends a signal of panic and all this stuff. So it seems like the consensus is that we're probably going to wait till the next meeting.
And when we look at that inflation issue, to bring it back to earnings for a sec, Sam, it's been really interesting because there had been a lot of dire predictions about what this inflation was going to do to margins for companies, right? And for some companies, it has compressed their margins, but for many, it has not, because they've been able to manage through it, which again has equaled this sort of better than expected outlook for prices. And it seems like the street has been pleasantly, I guess, surprised by all of this.
Yeah, I mean, it's really simple. It just comes down to the fact that the consumers and the businesses that are being sold all of these products and services can afford it. They don't have to like it. Sentiment surveys, PMI surveys, we're going to get University of Michigan in a couple of minutes. All those surveys say that, the buyers, the price takers of all this stuff aren't happy about it, but they can afford it. These companies, companies and consumers as well are in pretty good financial shape. They're sitting on tons of cash and debt servicing costs and all this stuff is very low. So yeah, like Brian was saying, he's going to go to the store and begrudgingly notice, that deodorant prices are still up, but he's still buying deodorant.
Thankfully.
But do you know?
Sam.
None of you have seen me in months. Do you know that I am? Do you know that I am?
Sam, it's good to see you. You're going to be joining us every couple of weeks, so our viewers can look forward to that as well. Sam Rowe of Ticker.co. Thanks so much for being here, Sam. Appreciate it. We're going to have more on today's market action next. And as Sam pointed out, in a few minutes, we've got a consumer confidence read as well. Here are some of the top trending tickers from yahoofinance.com. We'll be right back. It's almost 30 minutes into the trading session. Let's get a quick check on what is going on with stocks. Given that we've got a mixed picture here, we've got the NASDAQ off very slightly. The S&P just up about 0.1%. The Dow leading the pack today, up about 0.25%. Coming up in the next hour, we've got lots more to talk about, including a conversation with the CFO of a firm and try to get him to make some sense of the quarter and the outlook here for investors who have been selling off the shares. Plus, of course, it's a big weekend for football fans. You may have heard. We're going to discuss all things sports betting with DraftKings CEO Jason Robins. Stay tuned.
We made it. Happy Friday and welcome back to Yahoo Finance Live. I'm Brian Sozzi alongside Julie Hyman. The markets are indeed limping into Super Bowl weekend as Wall Street grows more concerned about inflation, rate hikes, and slowing economic growth. Seeing some mixed action here in the early going amongst the major indices. But by and large, I think the market's still trying to figure out what happened yesterday and what might be coming next. But Julie, what's next? Some breaking news on consumer confidence.
Yeah, University of Michigan consumer confidence showing very acutely that it's not just the markets that are worried about this stuff. It's individuals, it's consumers, because we're seeing that sentiment reading, the preliminary reading for February at 61.7. That is down sharply from the 67.2 in January. And it's also much lower than the 67 that economists had estimated. If you break it down, this reading has two main components: the current conditions index. In other words, how do people feel about how things are going right now? That came in at 68.5, which is also, again, below last month and below estimates. And the expectations, how do you feel about how things are going to be, 6 months from now, a year from now? And that going to 57.4, a 64.5 was the estimate there. People, it looks like the inflation expectations for a year from now at 5%. So this really reflective, right, of what we have been talking about over and over again, that people are worried about rising prices, and that is really affecting their sentiment, even though we are seeing most people who want a job have a job. That's what we're seeing in many of the jobs numbers, and their wages are going up, but they're not necessarily outpacing inflation. So this is the lowest, by the way, the lowest read on that headline number since October of 2011, Saz.
Yeah, this is a very interesting report, but let's stay on the economy here, Julie. All things consumer, all things inflation. Let's bring in Seth Carpenter. He's Morgan Stanley's chief economist here. Seth, always nice to get some time with you. So a below expectations read on consumer sentiment. Do you think the inflation, these high levels of inflation we are seeing, is starting to really hit households and how they think about consuming goods?
I think inflation has to be a concern for a lot of households, especially the households at sort of the middle and lower end of the income distribution. On top of inflation, we also know that the child tax credit ended at the beginning of the year. And so I think all of that really is a drag, at least in the short term, on the consumer mindset, consumer spending. So an air pocket seems very plausible. I think, though, in the more medium term, the job market is solid. I thought Julie's point was valid. The unemployment rate as measured is quite low. We saw from the last jobs report that there were a lot of new jobs. We got upward revisions to previous months. And so usually what the data tell us is that as long as those job gains continue, we tend to get a consumer spending holding up. So I think the consumer sentiment numbers, they're definitely a cautionary tale. They're definitely a bit of a yellow light flashing, but the fundamentals still look pretty good.
Where are you guys at, Seth, in terms of interest rate increases, the number this year, whether we're going to get 50 basis points at the March meeting? What's the Morgan Stanley estimate here?
Absolutely. So Ellen Zentner is our chief U.S. economist, and her team, they do great work. Right now, the baseline view is 4 rate hikes with some front loading and the balance sheet coming off. But I think we all would agree if there are risks to that. Right now, it looks like the risks are to more hikes rather than fewer. So I think that's key. The 50 basis point in March is clearly a big narrative right now in the markets. My baseline now is that it's not going to happen. I see the arguments for it when I talk to clients and they say which hiking cycle is the best one to compare. I point to the 1990s, so where we did see some outsized increases. That said, we've had a bit of mixed communication. We definitely had a number of FOMC participants walking back on the idea of 50 to start things off with. So I think for now, I'm inclined to think 25 is the most likely outcome. They probably wait until the meeting itself to start that rate hiking cycle so they can have it in the context of forecasts, have it in the context of a press conference. But the world is moving quickly, and they clearly have a strong desire to get moving soon with raising interest rates.
So, Seth, what I keep trying to figure out here is you see the inflation hit to consumer confidence, people clearly worried about prices. The Fed going to react to that in one way or another. But what effect is that going to have on inflation and when? Because we are still looking at supply issues that are a problem, right?
Absolutely. So I think there are a few aspects here. First, we've constructed, following some of the research out of the New York Fed, a global index on supply chain issues, supply chain conditions. And it does look, in level terms, they're still a problem. But in change terms, they are getting better. And I think that's important. And that fact is part of our forecast that over coming months,
Oh, I think Seth is frozen there. Brian Sozzi, unfortunately.
Yeah.
Oops, sorry.
Yeah.
Oh, Seth, are you back with us?
I think so. Hold on for 1 second. There we go.
There you go.
Yeah. So apologies for that.
That's okay.
I think supply chains should be getting better over time, and in several months' time, we could see that showing up in better goods prices. So that for us is a key part of the forecast. But what can the Fed do? What is all this meaning? I think the main part is to try to slow aggregate demand across the economy so that the actual available supply in the economy is better aligned with what's going on. Usually most empirical estimates say that that takes a few quarters to hit the real economy, and then a few quarters after that to actually hit inflation. So I don't think policy this year is going to have a material effect on US inflation in 2022. That's going to be much more of a 2023 phenomenon.
Seth, help us understand this new narrative in the market that we might see a Fed, an emergency Fed rate increase before that March meeting. In your view, what message would something like that send to the markets?
I think that is a very, very difficult communication situation for the Fed to be in. They clearly want to communicate to markets, to the public, to the Congress that they care about inflation. They're on the way to do something about inflation and that they're not asleep at the switch. On the other hand, doing an emergency move outside of a scheduled meeting, especially on the heels of an extra inflation print, could send a signal that all of a sudden they've become panicked. So I think it's a very delicate communication issue for the Fed. My baseline view is that they would wait until the meeting so they could have that whole communication context to deliver things on. But I think it is, there are clearly members of the committee who are enthusiastic about getting going with rate hikes. I just don't think that's where the committee is going to end up.
You look globally, of course, not just at the United States, and we are seeing the ECB sort of inch towards tightening, right? Then you've got the BOE there in the mix as well, sort of in between the US and Europe, I suppose. What is all of this going to mean for global growth when all is said and done? I mean, that's not even to speak of, obviously, there are a lot of other parts of the world, including China as well.
Exactly, and it's great you bring in China because they are in many ways the counterpoint to the large central banks of the world starting on the tightening cycle. So absolutely, the ECB, we've recently refreshed our call for the ECB. Jens Eisenschmidt is the chief Europe economist for Morgan Stanley. We see them ending that asset purchase program early by September, and then as early as December, starting to raise rates and in fairly quick order, getting to at least zero, so eliminating the negative deposit rate. So the shift across the developed market central banks is now sort of more or less complete with the ECB on board. I think, though, in very strong contrast is the PBOC. So China slowed aggressively last year. Then there was a signal that they were changing policy, not just monetary policy, also fiscal policy, credit policy, some of the environmental policies that were put in place. And we've seen that reversal already start to show through in China. So the PBOC is actually in an easing stance. The rest of policy out of Beijing is in an easing stance. So there really is this interesting divergence going on between the large DM central banks and the other very, very large economy in the world, which is China.
Seth, with all this talk of global coordination on rate hikes just to cool inflation, what is your probability on a recession in the next 24 months?
So I think in the next 24 months, I feel reasonably constructive, pretty sanguine about a recession. There's always a chance things go wrong, but I don't think the next 24 months is the time to look for it. We still have some catching up to do, especially in Europe, coming out of COVID. So there's some underlying strength there. For the US, like I pointed out, the labor market is still strong. Back to Europe, the recovery fund has not yet been deployed and will add some support. So I feel in the near term, better and better about it. As central banks start to tighten policy, they have what is the canonical problem of monetary policy, which is how do we tighten policy, slow the economy, cool down inflation without going so far that we tip over into recession. I don't think any central bank is at this point intending to cause a recession, and that's going to be the challenge. Now, in terms of timing, again, why I feel good about the next year for sure, and probably the next 24 months, is that it takes time for that policy tightening to feed through to the real side of the economy. And so I feel like with those lags, the next 12 months for sure, the next 24 months, pretty good about where things are. Once we get into the 2024 range, I think there you have to be super careful. How able are central banks, with all of the best intention, how able are they to calibrate that policy tightening to ease up on the tightening when it's needed?
Seth, finally, I just want to switch gears here for a moment, and I want to talk about who might be setting policy going into the next few years. Lisa Cook is one of the nominees for the Federal Reserve Board right now. She would be the first Black woman to serve on the board, and she's come under criticism, particularly from Republicans, because her research is very focused on the role of race in the economy. As a Black economist, as someone who has served in government, I'm just curious how you're watching that situation and what you make of it.
I'm watching it with great interest. I'll say just at a very high level, the Fed, the policymakers, I think, are well served by having a diverse set of views on lots of different ways to conduct policy. the narrative at the time that Chair Powell was first being nominated to be chair, one of the market narratives was, is this a good idea because he's not a quote unquote real economist? I actually think he has demonstrated that he is extremely smart, has a great grasp of both markets and the economy, and not being a trained PhD economist with his own research is probably liberating to allow him to take the best of all worlds without being constrained. So now to other nominees, I mean, there's Phil Jefferson, who has a long history of working on monetary policy, so I think that's a natural fit. Sarah Raskin spent time at the Fed, time at the Treasury, not an economist by training, but has a clear view into how policy should work. And so I think Lisa Cook's research as an economist into how different parts of the economy, especially for Black Americans, I think is a very, not necessarily her specifically, but I think having that broad range of views is a very healthy place to be. I personally have academic research published in academic journals way back from the beginning of the 2000s on the differential effect of monetary policy on unemployment rates across racial groups. I don't think that makes anyone a lesser macroeconomist. I think it forces you to ask questions. Are we being too simple with our models? And if so, where are the degrees of complication? So I think a diverse set of views is a great benefit to a policymaking institution.
Indeed it is. Always appreciate your insights. Seth Carpenter, Morgan Stanley Chief Economist. Have a great weekend. All right, our next guest says that the rise of defense tech is bringing Silicon Valley back to its roots. We'll discuss with Lux Capital founder and managing director Josh Wolf next.
Well, we have seen tech stocks really get hit this year. The NASDAQ, the big underperformer when it comes to the major averages. And we've seen a lot of talk about tech valuations. That is extended, by the way, not just in the public markets, but in the private markets when it comes to valuations as well. Let's talk more about that with Josh Wolf, founder and managing director of Lux Capital. Josh, thanks for being here. What have you made of all of this turmoil that we have seen within public-facing tech shares, and what has that meant for valuations in the private space also?
Well, my own view, which is a bit dark, is that we are probably in March of 2000, and we've got an 18-month period where you might see 50 basis points to 1% declines. And that's basically the slow decay of people's belief in what historically has been rah-rah growth mode. So the first thing I would say, which is the admonishment that we are telling our companies, is for the people who have been fortunate, whether through IPOs or SPACs, equity issuances, debt, whatever it might be, is husband your cash. Use that cash wisely. I think we're going to be in for some tumultuous times. And the people that are going to be able to consolidate their industry positions are the ones that are going to emerge as the winners. So that's the first thing I say. The second thing is I think you're going to have some really interesting market structural changes. There's early evidence that we're seeing this when you have, Facebook have its the all-time historic $250 billion loss of market value. And then within a day, you see Amazon see, its greatest 100 or the market's greatest 119 plus billion dollar ascension. You see Snap going down 24% in one day and then back up 50% the next. That volatility is indicative of market structure changes, of going from passive indexation into active investors, from people who might be highly levered into liquidating those positions, from retail investors into institutional, from momentum and growth investors into value investors. So I think we're going to see a lot of change over the next 6 months or 12 months. And I think it's critical that people husband their cash.
And how are you seeing that in your sort of day-to-day or week-to-week business? What sort of signs are you seeing that are making you send these caution signs to your portfolio companies?
Well, oftentimes, almost like that Sherlock Holmes story of the curious incident of the dog in the night, it's the sound that you don't hear. So what has been noticeably absent from most of our Monday and Thursday partner meetings at our venture fund has been bad news. And the absence of bad news is bad news. You want to hear that there are struggles, that there are issues that are happening. You want to hear that many of the great companies that you've backed, suddenly there's, rifts, reductions in force, layoffs. They're struggling to have a down round. There might be an issue with a CEO. There might be a coup of an engineering team that wants to replace management. Those are signs of healthy functional change. When everything is up and to the right and all of our companies are doing phenomenally well, it's like when your kids are in the bedroom and you don't hear any noise, it's a little bit time to worry. So the signs for us are the absence of the signs, which portend that you're going to have some perilous moments. You're starting to see capital go from extremely abundant and the cost of capital very low and valuations very high to the opposite. You're starting to see a scale back from late stage growth investors, from crossover hedge funds. You're starting to see allocators, which are the LPs who give us and other people money, see a denominator effect, which in simple terms means all the money that they put into VC and private equity and public funds, when the public funds are getting hit and some of these stock names are down 50% or more, suddenly they're overweighted in private equity and they need to start thinking, hey, how do we reduce the exposure to venture and private equity? Harder to do with an illiquid asset class, also probably going to create a lot of dislocations.
Josh, just given the sell-off we have seen in tech, has that impacted the culture inside of these very innovative companies? Because as you know, a lot of times these next generation tech executives are compensated in options.
Indeed. First, you've got comps in the public markets that often dictate what valuations are in the private markets. Now, the private markets on the way up lagged the public markets, but I think you're going to see the same thing on the way down. They will lag in part because of that illiquidity I was just talking about. The cultural mindset when you're issued stock at the ground floor of a company, as that company ascends and you have subsequent financing rounds and those financing rounds are ever higher, life is great. When you start to have down rounds, which I have to tell you, in about 10 years, you really haven't seen companies and you haven't seen a generation of people that have really experienced permanent capital loss, that great definition of risk, permanent loss of capital. And so I think that you're going to have a shakeout. I think you're going to have a reduction in the number of venture firms. I think you're going to have a reduction in number of companies, and capital is going to get scarce. Really valuable talent is going to become more valuable. Really valuable ascendant momentum stocks are going to be harder to come by. Now, I say this and I sound like a doomsayer, but I have to say, while the biotech index, the XBI, is down, 40, 50%, some of our companies are doing rounds where they are seeing 5x or 7x step-ups between those rounds because they are singular in their space. They're doing something that nobody else can do. And so part of the message here is, yes, while indexes might sell off and broad swaths of sectors might sell off, individual idiosyncratic companies can still be absolute rocket ships. And the key for an entrepreneur that's looking at their stock options is, how do you make sure that you get into those winning companies?
Well, and I guess, Josh, that sort of is parallel to the theme that we're hearing from so many public investors, which is it's a stock picker's market, which people say all the time, but which now actually seems to be true. So if you're an investor, whether you're a public or private investor, how do you find those opportunities that you're talking about? What are some of the criteria that you look for that means the difference between a company that's going to do a down round and one that's going to be able to step up like what you're describing?
Well, a lot of it comes down to industry position, the talent and quality of the management team. That's the number one thing in private markets that we're looking for. We like people with chips on shoulders. We are convinced that chips on shoulders put chips in pockets, people with something to prove. And no matter what comes and what volatility and vicissitudes in markets may be thrown their way, they just will not ever stop. They just keep going. And so that's super valuable. So that's number one. The second is a defensible technology position. You have people that used to say, oh, moats are nonsense. Buffett and Munger aren't dead, and they're not dead yet. And value investing isn't dead. And one of the great tenets is buying something for less than what it's worth today so that it grows in value and ultimately the rest of the market sees what you see. A lot of that comes from a competitive advantage. Competitive advantage could be a locked up supply chain. It could be some technological capability, some set of patents, something that allows a company to do something that nobody else in the world can do. And when you look at some of our companies, Icon, EIKON, this is a private company that has a set of microscopes and instruments that allow you to see inside of cells in real time that has never before been possible. That's the kind of company that when everybody else is struggling in biotech, attracts $500 million, $500+ million of new financing, because the demand to invest in that singular set of capabilities is there. So as an investor, you're really trying to find the N of one, the one company in 5 in a small sector that is going to be the absolute leader. You do not want to be invested in sectors where there are 500 competitors and no barriers to entry and just money sloshing around. It's too messy. It's too chaotic. It's too much driven by luck. Find dominant technology, incredible management, big growing markets, and some competitive advantage where they can do something that nobody else in the world can do.
Useful advice for a lot of people. Josh, thank you for being here. Really appreciate it. Josh Wolf is founder and managing director at Lux Capital. Thank you. Well, coming up next, Amazon reportedly taking away paid COVID-19 leave for unvaccinated workers. We're going to have the details on that story next. Shares of Didi are falling this morning despite Chinese tech giant Tencent increasing its stake in the ride-hailing company. Tencent's stake in Didi now 7.4%. That's up from 6.8% when Didi went public on the New York Stock Exchange in June. Remember, Didi faced regulatory scrutiny just days after that public debut in the U.S. China's cyberspace regulator immediately opened a cybersecurity review into the company, and Didi shares are now down almost 70% from that IPO. Back in December, Didi announced it would delist from the New York Stock Exchange and make plans to go public in Hong Kong, so that is in process. Amazon will reportedly be taking away paid leave for unvaccinated workers who catch COVID-19. That starts on March 18th. Employees who are vaccinated will also no longer be required to wear masks inside Amazon warehouses. That's according to a memo obtained by Reuters and the Wall Street Journal. The memo came days after several U.S. states, including California and New York, announced they would roll back mask mandates as cases of COVID-19 decline across the country. And Elon Musk said SpaceX's rocket would soon be able to reach orbits at a significantly lower cost. In 2 to 3 years, the company's most powerful rocket, Starship, could reach orbit for less than $10 million a flight. SpaceX has said that it would use Starship for its biggest missions, including a trip to Mars. Coming up, DraftKings CEO Jason Robins is going to stop by ahead of this weekend's big game for a look into all things sports betting and what is next for his company. Stay with us. This Super Bowl Sunday, there will be 45 million more potential sports bettors than there were last time around. That's because of legalized sports betting that's happened in a number of states. That's according to numbers from Axios. And one of the folks who wants to benefit from that is DraftKings CEO Jason Robins. He joins us now. Jason, it's great to see you. And I know you're out in LA ahead of the big game. So I'm curious what you expect from the game. I should say our Josh Schaefer is here as well. What you're expecting from the game in terms of what kind of volume of bets you expect associated with it.
Well, I saw a study from, I think it was from the AGA, saying over 30 million people were planning on making a bet this year in the Super Bowl. I think it was around $7.6 billion they were estimating would be bet. But the interesting thing is still the vast majority of that is happening in the illegal market. I know a number of states have legalized, but there's still, a ton of concentration of activity, and still, the three largest states by population don't have legal sports betting. So hard to say what we're going to do, but I think it's a big opportunity to keep expanding sports betting into more states and keep getting more people over from the illegal market.
Jason, we've seen the promotions start to come in from DraftKings this week with the push notifications for different prop bets, some boosted bets, kind of trying to gain customers that way. What have you guys seen from that thus far? And how do you sort of balance the spend there of trying to get people into the app while not giving too good of odds on some sort of boosted bets and promotions?
Well, promotion is exactly that. It's designed to acquire new customers, to activate people. And for a game like the Super Bowl, which is, the biggest sports day of the year, that's the perfect time to be doing that. That's the best opportunity, or one of the best opportunities, to get a ton of new customers to try the product, maybe to get people who haven't played in a while to come back and make a bet. So that's really the goal. I think the balance has much more to do with where we are at this stage of the industry. It's really that early days where, as I mentioned earlier, there's over 30 million people still betting in the illegal market. So there's already a huge built up market. And that's a big difference from other industries. Most other industries, when you find product market fit, they kind of build, customer bases organically. This is one where, because it's been in the illegal market for so long, there's literally tens of millions of people that were already planning to make a bet on the game. So I think that's why you're seeing such aggressive activity on the customer acquisition side. There's just a flood of new customers coming into the legal regulated industry right now.
Well, and the other part of that customer acquisition too, that a lot of the sports books are getting into, is the content build out and kind of creating your own content and covering the Super Bowl that way. I know DraftKings has been doing that throughout the week. This week, where does the company stand in terms of content creation? Are you planning on investing more in content moving forward and kind of creating more of instead of it being a 2-screen betting experience, maybe it being a single screen betting experience more moving forward?
Well, I think for us, it really is still very early in our foray into media. We just brought on a bunch of new talent, and I think that's going to make a big difference and accelerate our efforts. I'm very excited about it because there's a clear synergy between content and betting. As for what we'll do, I think we're still figuring that out, but I think you will see us continue to increase our focus on trying to do things that appeal to sports bettors so that we can, build the top of the funnel, but also so we can engage our customers. Our customers are much more likely to watch sports, much more likely to watch content related to sports. And we want to be there to engage them all the time on all the things that they are interested in related to this subject, not just on the betting and DFS side.
Jason, how different or how much more live betting will be done on the platform this year compared to last year?
Well, I don't, it's still early in the year, so hard to say, but we've seen it growing every year for the last few years as more live bets are put on the platform, as more, kind of organic adoption happens. I think a lot of people, when they first start betting, don't even realize you can live bet. And once they discover it, they find it's a fun way to enjoy things during the game. And sometimes your bet on the spread or your money line bet, by the time you get to the third or fourth quarter, it's not looking good. So you can come and make a live bet, and that'll keep your attention and engagement in the game and make that last quarter or two more fun.
And Jason, how's the technology held up with that? We know as bigger states come on, like say New York, and you have more and more people on the app, has that been a challenge at all when it comes to the micro betting and the live betting from a technology standpoint?
Well, we're very fortunate. We have a great engineering team. They work really hard. I think during the months over the holidays when we're ramping up going into playoffs and Super Bowl, everybody's working really hard to make sure the platform's stable. In August, going into NFL season, same thing. So we've been fortunate. We haven't had any real hiccups on that front this year. It's obviously a lot to keep up with when you're growing that quickly. The traffic is also very spiky. So it's a bit of a different problem than some other services have where their traffic is more smooth. We get huge spikes during, right before the games, during times when big plays happen and people are checking their bets or checking their fantasy teams. So it's a unique challenge, and the team's done a great job handling it.
Jason, the Super Bowl's in California. Sports betting not yet legal in the state of California. So how does that affect the sort of the flow of things and how it works? And what's your outlook for this coming year in terms of how many more states could legalize it?
Well, it's hard to know because, states, government isn't always predictable. And sometimes you think you're going to get a law passed and it doesn't go through. And then sometimes a state that you never thought was going to even consider it out of nowhere decides to take the issue up. So, we haven't really gone the route of trying to predict how many. As far as California goes, we have a ballot referendum that we are in the process of gathering signatures to qualify for on this November's ballot. I'm very excited about that. California is obviously a huge market. If California were a country, I believe it would be the 5th largest in the world by GDP. So really big opportunity if we can get California there. And I'm looking forward to hopefully getting enough signatures to qualify for the ballot. And then we just need the voters to turn out and vote for it.
Jason, this coming Sunday for the Super Bowl, I'm probably going to eat 20 boneless wings, suck down some tequila. I'm going to have fun, but can you have fun during Super Bowl day? This is essentially a work day for you, no?
It's funny because I love sports, but you're absolutely right. I used to just be able to have a Super Bowl party and watch with friends or family. And my kids are back home and they always, wish that I were there watching with them. So it's definitely work. I mean, of course, it's fun to be here. There's a lot of action. I've gotten to see a lot of people that I haven't seen in a long time. So that's been nice. But you're right. I can't just sit back and relax and watch the game. It's work the whole way through. But I'll try to catch a little bit of it in between talking to people and meetings.
That is a good point. Like even just being in the same space with a lot of people, is a fairly novel experience at this point. Jason, finally, I'm curious what the most popular bet or bets are on the platform right now. And finally, do you actually place any bets before the game, or is it sort of like a church and state situation?
Well, I have always loved betting, but I'm not. I think it's probably better to, at least for now, not do that. And certainly I can't do it on our platform. And there's certain states that actually don't allow me to do it at all. But I just found it better to steer clear. I'll probably have a few daily fantasy games going against my co-founder, Matt. He and I enjoy playing against each other. But other than that, I'm going to steer clear. As far as the most popular bets, obviously the typical stuff, spreads, money lines, over-unders. But, actually on the prop bet side, the most popular bet is the coin flip. And then as far as player props go, Cooper Kupp scoring a touchdown's up there. A lot of people think he's going to score, and rightly so. He's had a great season.
Well, our producer Val is very excited to bet on what flavor of Gatorade is going to be dumped on the winner. Jason Robbins, great catching up with you ahead of the game. I hope you manage to watch a little and have some fun, have some beers as well for us. Jason Robbins, DraftKings CEO, as well as our Josh Schaefer, who covers sports for us. Thanks. And ahead of that game on Sunday, we've got some people to tell you about who are going to be on the show to talk about the Super Bowl on Monday, including the mayor of Los Angeles, Eric Garcetti, the FanDuel CEO, Amy Howe, and Troy Aikman. Brian Sozzi's pretty excited about that one. Yes, indeed. All right. Well, now let's talk about the stat of the day that has to do with the Super Bowl. Forbes says the average NFL team is now worth $3.5 billion. Yahoo Finance's Max Zahn calculates the overall total net worth of NFL owners is $154.3 billion, and almost 3/4 of that net worth of NFL owners is from the teams. Coming up next, Affirm CFO Michael Linford joins us to discuss the company's latest quarterly results and the state of the buy now, pay later industry. We'll be right back.
Affirm shares are seeing a sharp sell-off after the company's latest earnings and full-year forecast disappointed some analysts. Let's dive right in here with Affirm's CFO, Michael Linford. Michael, good to see you again. Thanks for hopping on in this Friday. The stock's been under pressure here all morning long. What's your message to investors?
I think the most important thing for investors to think about is to take a step back and really remind themselves what Affirm is and what market we're playing in. Consumer demand and consumer preferences are changing rapidly. Buy now, pay later is the fastest growing payment method globally, and Affirm is winning. Our Q2 results demonstrate that our investments in technology and our enterprise relationships allow us to achieve a totally different level of scale. We had a killer quarter last quarter. We grew merchants by 21 times. Our GMV was up 115% year on year. We showed triple digit growth in consumer counts, up 150%. And revenue grew 77%, while unit economics outpaced that. So we had a phenomenal quarter, and we think that puts us in a really good position to continue to scale and build the most valuable network going forward.
Do you think the market got ahead of itself on what to expect from your deal with Amazon?
I don't. I think there's obviously a lot of excitement for what we're doing, and the enterprise relationships we have are the marker or the proof point for us being the partner of choice. So I do think the market got very excited about that. I think more than anything, our business is changing so fast, and it's difficult sometimes for investors to really understand all of the moving parts in a business that has as much dynamic change as we do.
Michael, it's Julie here. There's definitely a disconnect here. There's no question, right? I mean, you got the stock down 10%. You're talking about how well things are going internally. It's not just down 10% today, by the way. It's off some 60, 65% from its highs. And yes, we have seen a big sell-off in tech more broadly, but help us understand, help investors understand what they're not getting here. As you talk about, as you make some transitions, maybe there's some confusion. So here's your opportunity, clear up the confusion.
Again, I think Affirm's competitive position is unrivaled. We have the best technology, and our enterprise partnerships are a function of us being the best solution. And consumer preferences that are changing here are going to change in 3, 5, even 10 years down the road, going to fundamentally change how consumers buy and pay for things. And so the thing investors should be doing is finding who's going to win in the space and be backing the winner, which we think is us. Our product offering is unrivaled. We address the widest set of transactions, and our competitors can't really match what we do. The truth is we don't react to short-term swings in our price. I understand the point and pressure, and as a CFO and shareholder, it's my job to deliver long-term shareholder value, and that's what we're focused on. But to do that, we have to scale the network. And so when you look at the proof point of the 150% growth in consumers, or the fact that our frequency was actually up, our transaction counts more than tripled last quarter. So what you're seeing right now is a really hyper growth company and capturing this enormous market opportunity, which we think will in the long run deliver really great shareholder value. It will, of course, given all the attention on the stock and the company, it'll be something that will continue to have some volatility, and we're focused on the long term and building the most valuable franchise.
Michael, you mentioned that you are a shareholder. Are you buying shares on a dip here?
I can't, as there's a lot of rules on what Section 16 officers can do. But look, I'm a proud shareholder, and I think it's really important for every retail investor, especially, to know just how invested the management team is in the stock.
What's more important to you and the team at this point? Is it acquiring more customers or reaching that profitability measure?
It's definitely the former. We are focused on scaling the network. It's both consumer counts and merchant counts. If you look again at the staggering number of merchants, we ended with 168,000 merchants. That means that more brands are using Affirm to grow their business. The consumer counts up to a little over 11 million last quarter from a 4 million last year, 150% growth year on year. These sort of growth rates are really hard to match, and the investments pay off over time. So we included a chart for those of you who want to go to our investor relations site that actually broke down repeat usage and first time usage. And what's I think most interesting is despite this really aggressive pacing and new user acquisition, we're also driving a lot more frequency with consumers. And in our business, that's what is the most important thing, to see network effects where consumers are repeating on your platform. And why does that matter? Well, that is what makes your product most valuable to merchants. And these things reinforce one another. The more valuable we are to merchants, the more valuable we are to consumers, and the two feed off of each other. And because we know that, the focus right now is around building the biggest scale that we can, and not so much on delivering any sort of short-term financial profitability.
And when does that flip, right? What is the benchmark you want to get to in terms of growth where you start to ratchet back on investment a little bit and focus more on the profitability line?
It's a really good question, and we get it a lot. And we spent a lot of time on this at our investor forum last September. We don't communicate it in terms of a timeline, and we communicate it instead as a function of growth. Our growth rate last quarter, 115% GMV. When we're growing that fast, we're not going to take our foot off the gas. We are focused on scaling the network while that growth is available to us. What we've communicated to investors is that when we enter what we call the growth phase, which is a 20 to 30% growth rate, then we will begin to deliver adjusted operating income profitability. And in the longer term, we think we can deliver 20 or 30% adjusted operating margins. But we're way ahead of that. Right now, our growth rates, again, are triple-digit growth rates. And we think the best way to deliver value to our shareholders in the long run is to scale our network right now.
Well, we appreciate you taking some time. We imagine it's been a busy few hours. Affirm CFO Michael Linford, good to see you again. Enjoy the big game this weekend. All right, Kellogg CEO is joining other food execs warning about higher inflation. Caught up with the cereal giant's top executive. We'll be back with a few takeaways next.
Well, we've been talking about all the companies raising prices under pressure from raising input costs. Kellogg, one of the food companies that's squarely in that trend. And Saz, you had the chance to catch up with an executive, right?
Yeah, I had a chance to get a few minutes with Kellogg CEO Steve Cahillane, and company reported yesterday organic sales of 5.2%. That is good, very good for a packaged food company, but operating profits were under pressure here for Kellogg. Currency neutral adjusted operating profits down 11.4%. In large part, it is that reflects just these inflationary pressures that we've been hearing all week long from food companies. Kellogg, PepsiCo CFO Hugh Johnston to us yesterday saying the company might have to hike prices 10% this year. Nonetheless, Kellogg CEO Steve Kaling just calling out some of these price hikes they're seeing, telling us, quote, we're seeing double-digit cost inflation. Where some of this inflation is most acute, Steve is noting cooking oils, rice, grains, transportation. He's adding that there's really nothing or no category that is immune to these inflationary pressures. He did suggest really strongly that they're going to have to also raise prices. Unclear how much price they will have to take this year. But again, here's another food company warning about major inflation, really not suggesting that it's going to end this year. A lot of food companies have been stepping up over the past few weeks on these earnings calls, hinting strongly that inflation may not cool off until 2023. Wow. So, but which is sort of in line with what we've been hearing from a lot of other companies this week, Saz. Chipotle also talking about that's going to be the norm for this year, and Pepsi talking about that high single-digit percentage increase in pricing for its products. What's striking to me? So I'm taking a look at the Wi-Fi Interactive right now, and what's striking to me is that given all that we've been talking about, stocks have gone pretty much nowhere this week. It felt like sort of from an emotional perspective that this was not a turning point week necessarily, but perhaps so a turning point week in terms of the perception of inflation and what the Fed is going to do, how aggressive it's going to be. And yet we have an S&P 500 that's unchanged on the week, which I think is pretty fascinating here. And I was also looking at the year-to-date chart. We have a S&P that is still off 5.5%, but still up off the lows that we've seen thus far this year. So it's kind of interesting given all of the doom and gloom we've heard about this week. Here's the 10-year yield as well. And I was looking at that movement that we've seen over this week, and that has been a huge movement upward as well, and to that threshold of 2% that we have been watching and traders have been watching so closely, now at 2.02% for the 10-year yield. So also let's translate it over and take a look at what has meant for the various groups. We've watched the NASDAQ, of course, very closely. This is the NASDAQ 100 intraday, and we're seeing a similar theme that even as markets overall are a little changed, we're seeing a lot of large cap tech under disproportionate pressure because of concerns about what higher interest rates are going to mean to these companies. So Amazon off by more than 1%, Nvidia down by about 2% as well. And let's see how it translates into the sectors. We're seeing a similar movement to what we saw yesterday in terms of energy being a standout to the upside, and not just yesterday, but of course this year and last year we've seen energy be a standout, but we're seeing tech and consumer discretionary to the downside today. So that's the kind of push and pull that we're seeing in this market here today. Saz, it's been a really interesting ride. I'm going to click on to this earnings full screen as well. Actually, let me go back over. I want to look at the trending tickers. As you noted before, Affirm, we just talked to CFO Michael Linford. And Affirm is that top trending ticker here on the Yahoo Finance ticker page. Look at that 5-day chart. But obviously the decline today, about 12%. It's actually accelerated in the past few minutes here. And I also want to look at the 6-month chart, because there you see the peak in the stock back in November and then the subsequent tumble, and investors just not buying this sort of long-term growth argument there. No, but overall, Julie, I think you said it perfectly. Food inflation isn't great. And really, I think you, of course, referencing Tony the Tiger, Frosted Flakes. And for our younger viewers, Tony the Tiger was used for many years to hawk cereal.
Isn't he still? All right, that does it for Saz and I. Of course, we're going to have lots of coverage of the Super Bowl on Monday. We're going to have special coverage from 12 to 1 in particular. And Saz and I will be talking about it on the 9 to 11 as well. Have a great weekend, everybody.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast. Hey guys, it's Friday. I'm Brian Chung alongside Akiko Fujita here to hang with you in the final hour of the morning here. But of course, all eyes on the markets right now as we do get a little bit of a mixed picture here. Actually, for a brief second, about 15 minutes ago, all the major indexes were up. Of course, picture very different right now. NASDAQ down about 0.3%. S&P 500 essentially unchanged for the end of the day yesterday. And the Dow just barely in the green, up about 0.3% as well. But of course, the big focus remains the Federal Reserve as the hot inflation print yesterday has people scrapping the question, when will the Fed hike? And instead replacing it with how big the Fed's going to hike. We'll have JJ Kinahan from TD Ameritrade stopping by to answer that question. And then staying in the same theme, we'll discuss how inflation is hitting your Super Bowl snack budget. We'll give you the lowdown on the best game plan for your grocery store visit ahead of the big game on Sunday as some popular party bites see some pretty massive price increases. But of course, starting off first with the Federal Reserve, just want to highlight right now the 10-year note, which tilted above 200 basis points, 2% yesterday, now at about 203 basis points. I mean, this has been a pretty interesting rise up, about 25 basis points, even just over the last week. This is obviously because of rate expectations quickly repricing after that hot inflationary print yesterday. So, Akiko, a lot of movement. I mean, now the Fed funds futures markets, which is kind of where you can bet on where Fed policy is going to go in the future, now pricing in an overwhelming chance of a 50 basis point, a supersized, I want to call it a double stuffed interest rate hike in the next meeting in mid-March. But of course, we've been watching the market action all week. It has been very, very choppy indeed.
Yeah, and Brian, you highlighted the CPI data that we got yesterday, but really we saw the sell-off accelerate into the close yesterday, largely on those comments that came from St. Louis Fed President James Bullard, who suggested that he would move much more aggressively moving forward here, a potential, 100 basis point hike by the end of the summer. And Brian, I'm curious to get your thoughts there because, even going into the most recent Fed meeting, there was so much speculation that led to a lot of choppy trade, especially in January. And it feels like we're kind of right back to where we were last month, because between now and March, there's going to be a number of analysts, speakers. I mean, so much speculation around just what exactly the Fed's going to do in March. And I think that just speaks to just the kind of jitters that are in the market right now, right? In terms of the uncertainty. At the end of the day, whether it is a 25 basis point hike or a 50 basis point hike, you get the feeling that investors kind of just want to know.
Yeah, certainly. But the challenge is that the Fed doesn't want to commit to offering any sort of forward guidance on how many rate hikes there's going to be or how they want to handle any sort of balance sheet roll off in the future. That's because it's really going to depend on specifically the number on inflation. The weirdest part about all of this is that people had a quick knee-jerk reaction to the inflationary numbers yesterday. But we have to remember the Fed's next meeting is March 15. And that means that we're going to get another reading on inflation before we're even expecting the next Fed meeting. So imagine what happens if the inflationary print, I'm not saying this is going to be the case, but if we do get an inflationary print that's actually below expectations covering the month of February, which will come out the week before the next Fed meeting, does that reverse all the expectation over a 50 basis point hike? Maybe people say, well, the Fed's just going to go for a normal size hike instead of a big gulp hike in that meeting. Well, if that is the case, this underscores how volatile markets are. That could be coming up until the last minute, the midnight hour of the next meeting. So the Fed has said very clearly, we don't really know exactly where inflation is going to go. We have our fingers crossed in the optimism that's going to come down later in the year, but they can't pinpoint exactly when that's going to happen, which means in the meantime, markets are really in the dark. They're in a tunnel system with no lights, with no direction. They have no idea where the Fed's going to go. And that's obviously one big reason for the volatility.
Yeah, no, I think that's a perfect way to describe it. And Brian, I know you've been covering the Fed for a while, but you get the sense that a lot of investors are really brushing up on the Fed mechanics over the last several months as they look to March and that rate hike to say, look, what does this ultimately mean for my portfolio? And long term, how should I be positioning myself?
Yeah, absolutely. And I think that, when it comes to the Fed broadly, it's always exciting for a reporter to see people getting interested in the Fed balance sheet. But obviously, in a time as tight as this, with inflation being on the minds of average Americans, obviously, you might wonder if it would be better under different circumstances. But let's talk a little bit more about how the Fed is weighing on markets with JJ Kinahan, Chief Market Strategist over at TD Ameritrade. JJ, it's great to have you on the program this morning. I mean, we were just talking about the importance of the Fed. What's your forecast with how the Fed is going to react given the numbers that we've seen? Consumer sentiment also coming out this morning, well below expectations and a notable downshift from the prior month at 61.7. How do you think these weigh on Fed actions this year?
Yeah, Brian, I think, first of all, they're all just data points. I don't think they look at any one particular point and say, this is the one, so to speak. You look at the trend overall. It's like the employment numbers, you don't just look at one report, you look what's happening over time. But I think you guys are both hitting on the real fundamental point of what's going on right now. And that is, there's so much uncertainty as to what the Fed is going to do. It's making it very difficult on investors. I've had a fairly long career. I don't ever remember a time where we've seen such a wide span in terms of what the Fed's going to do as far as hikes or raises. Usually our argument might be like, they're going to do 2 this year. No, they're going to do 3 this year. Right now, the span is 4 to 7. If you look at the CME Fed Watch tool, they're talking about 5. If, Goldman Sachs just joined some of the others in saying 7 this year. So that's what's really making this so difficult, is the wide volatility within the Fed raise numbers is not something that the market's used to. And I think that's why you're also seeing sort of these hair trigger reactions one way or the other. As far as yesterday's action, the one thing that I will say, even though VIX had a pretty good percentage upside move, it's still pretty contained at this 25 and under level. And the other thing was, if you think about the stock market action yesterday, obviously we were crazy in the 2 years, adding 15 basis points on the day, which is, 25 basis points. The 10-year adding 15 basis points, moves you don't normally see within one day. But the stock market itself, although it was a pretty dramatic sell-off, it was very orderly. So I don't see a sense of panic in the market as much as I see people trying to reprice stocks and say, what does this mean for stocks longer term?
So JJ, is now the time to be doing that? I mean, to Brian's point earlier, between now and March, there's going to be a lot more data points that come out, a lot more speculation, and things are going to be moving choppy alongside of it. Do you hold cash and leave it on the side, or do you put your money to work right now?
It's interesting. Looking at one of our clients the last month is, for the first time in a while, we saw our clients starting to buy fixed income products, which it's a little bit of a change in behavior. What I mean by that is, before, they'd sell stocks and look to buy the next stock. I think what you're seeing right now is people who, when they're selling some stocks, are either going back in for a smaller amount than they did before, or are saying, hold on, let's get past this March meeting. Again, I think all the market really wants out of the Fed in the March meeting is some clarity about where they're seeing the rest of the year. Whether it's 25 basis points or 50 basis points, and again, the probabilities of a 50 basis point, as Brian just said, supersized, it has gone up significantly over the last few days. That being said, it's a little bit out of character for Chairman Powell to do something like that. He tends to be much more methodical if you look at his tenure so far. But we will see that at the end of the day. I think that we would just like some indication of, based on where we're at right now, all other things being equal, what is the Fed seeing for the rest of the year? And you said it in your opening comments. Any type of clarity will calm the markets down.
Let's kind of shift gears to the retail approach then. I mean, you made a good point of the fact that it's just people repositioning. It's not your typical risk off, and that does make sense because you're not seeing yields fall as equities come down. It's actually the reverse kind of positioning here. So when we talk about where people are positioned, TD Ameritrade has the IMX, the Investor Movement Index, that kind of tracks where people are going within equities. What are you seeing on that front? Where are stocks and names and brands that people are gravitating towards and also away from?
Yeah, sure, Brian. And then again, this measures not a survey, it's what people actually did in the month. And so what we're seeing is on some of the buys, that what was most interesting to me is Microsoft. because Microsoft and Apple are two stocks that people tend to turn to in uncertain times. And Disney, which they bought ahead of earnings, which worked out well. We also saw a few maybe surprises. Square, I guess called Black now, not a company that people normally purchase. So seeing unusual activity there was very interesting to me. Rivian, we see the retail client very drawn to this EV market overall, something we continue to see in NVIDIA. Has been a stock that our clients have been very fond of, if you will, for the last year or so. In terms of stocks that they were lightening up on, Carnival Cruise Lines was certainly one that our clients, ExxonMobil, which may surprise some people, but given the great move that we saw in energy, not really surprising to see people taking profits in a stock that is very widely held in our base overall. So that one, not a huge surprise. And then Walmart, Visa, and a company that I think really is among those that people are really trying to find out what the value is, as I was making the point earlier, Zoom being one of the stocks that people saw.
All right, JJ Kinahan, TD Ameritrade Chief Market Strategist. Thanks for stopping by this morning, and have a great weekend.
Have a great week.
All right, let's shift gears now to the trending tickers on this Friday morning with Yahoo Finance's Inez Ferre, who's been watching all of the market action. A lot of movers, including obviously those that reported earnings. A firm Under Armour, I understand, on your radar.
Yeah, that's right. Let's take a look at a firm right now. The stock is down about 11%. You can see that on our Wi-Fi interactive board. Yesterday, a firm had, to back up for a second about how their quarterly results were released, they inadvertently tweeted a small portion of those results. Gross merchandise volume more than doubled, revenue up 77%. Then the company released its full results before the market closed. Its revenue outlook missed expectations, and that's why you saw the stock tanking. It actually closed 21% lower yesterday, and now today seeing another 11% drop. A firm has a partnership with Amazon, and that's expected to be a growth driver, but there's been some questions in Wall Street around the revenue from that partnership with Amazon, and specifically what's called the take rates, and essentially that's a yield on each transaction. As far as Street reaction is concerned, Jefferies downgraded the stock to underperform. D.A. Davidson, though, upgraded the stock to a buy. And we had on Michael Linford, CFO of a firm, who just spoke with Julie Hyman and Brian Sozzi, and he said, look, acquiring more customers is definitely the focus. Scaling the company is the focus ahead of reaching short-term profitability. So scaling the network on the consumer counts and also on the merchant counts. He said that those investments pay off over time. Looking at Under Armour, that stock is also under pressure. This is after the company reported its quarterly results, beating on the top and the bottom line, as you can see there. But management speaking about the supply chain issues and basically the material impact that this will have on the spring and summer season. And maybe beyond that, gross margin is expected to be down in the current quarter, and supply constraints are likely going to reduce revenue by about 10 percentage points.
And as we're also watching shares of Zillow here, actually getting a pop in this session, despite the company posting an $881 million loss and that now extinct, we should say, home flipping business.
Yeah, Zillow seeing its biggest daily gain in a year right now. Revenue came in above expectations for the company. Its loss per share came in better than expected. Its first quarter revenue outlook came in better than what the street had been expected. And you may be seeing a pop here also because Zillow has been getting rid of some of its inventory, that inventory in part because of its part of that iBuying program. And selling properties has been faster than expected for the company, and they've received more money for some of these properties. So the net impact really of winding down that inventory, restructuring costs, the iBuying operations, that's expected to end up being cash flow positive. Brian, Akiko?
Inez Ferre with the wrap up. Thanks so much for that. Coming up, we're going to have a conversation with Congressman Ed Perlmutter. He's going to be just joining us to discuss the latest on Capitol Hill as lawmakers' signature marijuana banking bill passes the House but faces an uncertain future in the Senate. That's coming up next. Momentum is growing in Congress to ban lawmakers from individual stock trading. Both House Speaker Nancy Pelosi and Senate Majority Leader Chuck Schumer publicly expressed their support for some form of the plan this week. But lawmakers still remain divided on just how far that ban should go. Let's bring in Colorado Congressman Ed Perlmutter joining us today. And Congressman, always good to have you on the show. You have been on the record saying that you think there's enough checks in place right now to keep lawmakers in check when it comes to stock trading. But it sounds like you're kind of open to exploring an expansion of this ban. How far do you think it should go?
Well, there are several bills that have been proposed in the House, and I don't know how many in the Senate. So I'm open to reviewing those. But I think, quite honestly, we have a lot. We have transparency through the Stock Act, and any transactions have to be reported within a certain period of time. That was done. Congressman Tim Walz, now governor of Minnesota, that was his bill, did that a few years ago. There are plenty of insider trading laws on the books that I think keep people in check. So we'll see what people propose. I guess I'm going to be a tougher sell on it than some others are. I don't know that it improves things any, and I want to see what they, how they advocate for their bills.
Congressman, you were one of those lawmakers that were named in that Business Insider report that essentially said you didn't necessarily disclose the sale of a trade by your wife, specifically on Alibaba stock. And you've said, look, this was an error. We meant to disclose it. But I wonder if that oversight or that specifically points to the fact that those checks in place right now are not sufficient enough. In other words, even if it wasn't malicious by any means, there's a lot of lawmakers, I'd imagine, who would say, look, that was an accountant error. I'll disclose it next time.
So, my wife got a little pension from her teacher retirement account when she retired, and she started trading these things with a broker who trades for a bunch of people. Popped up that she had $1,000 of Alibaba. And I asked her, I said, do you really have to have that? And so she said no, and contacted her broker to sell it. And it was in the middle of a kind of a time period. And we ended up reporting it 3 days late, but within the 30-day grace period. So it's one of those things that kind of catches you up, but that really isn't what has me reluctant about in voting for a stock ban act. I don't think, I guess I am more trusting than a lot of people of the other members of Congress and senators that they're not going to trade on insider information. And there was some concern that some members of the Senate did that when we went into COVID a couple of years ago. And as it turns out, after investigation, they did not. So Akiko, I think that, my wife ought to be able to trade her, $50,000 that she got after a lifetime of teaching. And we reported, and we were 3 days late, but within the grace period, and we will do our best to follow those rules and those laws. But I think banning it outright, for me, that goes too far.
Congressman Brian Chung here. I want to switch gears to marijuana banking. This is a major issue in your state, but the federal lack of legalization for this business has made it difficult for dispensaries to handle any sort of cash that they have. It's really difficult for them to use traditional banking services. You've been trying your entire congressional career to get something done on a bill that would allow banking services to be provided to these businesses. The latest movement, as I understand, is that you're trying to include this, or it is already included as an amendment to another large bill in the House, the America Competes Act. How optimistic are you that this is now finally the time that this will get passed?
Well, as Akiko will tell you, I'm always a pretty optimistic guy. And I think, again, we're going to keep putting it on pieces of legislation until the Senate actually takes it up. As you were saying, it's not been my whole career, but 8 years of my 16-year career, I've been working on this since Colorado legalized marijuana back in 2012, 2013. And we passed it now 6 times out of the House with a huge bipartisan vote. every Democrat and at least half the Republicans have supported safe banking. And I guess I am confident that the Senate will take it up. Now, Senator Schumer and Senator Booker and Wyden would like to have a big comprehensive bill, which I support that. But I question whether they have the votes to get something of that magnitude through the Senate, which has not even had a hearing really on marijuana in 50 plus years since it was made illegal under the Controlled Substance Act. But we're going to keep working with the Senate, working with Schumer's office, working with Booker's office, working with Steve Daines, a Republican who is championing this bill in the Senate, and we're going to get it across the finish line. That I am really pretty confident about it. Whether it's with the Competes Act or something else, we're going to get it done.
Yeah, you still have that optimism, but Congressman, I know you're keeping count, as you said, 6 times, and then 6 times the Senate came back and said, no, not this time. So why do you think there's been so much resistance? Is this about a lack of urgency?
It's so remember, I passed it first, and I think Akiko, you and I talked about it a few years ago when the Republicans were in charge of the Senate, and Senator Crapo at that time, basically said the bill is too big and too broad. So the Republicans were, kind of in shock that something like that would pass out of the House. Now with the Democrats in charge, from Schumer and Booker's point of view, the bill is too limited and too narrow. So, but they're in support of it, but they just want to try to get some bigger pieces to it. And if they can add research, if they can add some criminal justice reform, if they can add, some taxation components, I'm all for it. But we need to get something passed and onto the president this year, and I think we will do that. I'm pretty confident that it's going to happen. And I think this is the bill that's going to break the ice, and then other things can be added or advocated for over the course of the next few months or years.
Congressman, zooming out, that marijuana banking provision is attached to the larger Competes Act, which is focused on R&D here in America, improving infrastructure. In the absence of the Build Back Better plan, which collapsed last year, I mean, how are you as optimistic as you are with marijuana banking on other types of infrastructure measures that Congress and the House are now trying to attack piecemeal, as opposed to the more perhaps ambitious one-go approach last year?
So the Competes Act, and I think the Senate may call it Make It in America Act or something like that, really is both a research and development as well as a manufacturing bill to make sure that we manufacture our goods here in America, that we bring back manufacturing from abroad. We saw many of the supply chain disruptions were because so many things are produced abroad, and we want to bring that home. And I think we will. I think this bill has a lot of support. I serve on the Science Committee and the Financial Services Committee, which have parts of the American Competes Act. A lot of bipartisan bills are within that bill. And I am, again, I think that there is a real need for America to step up when it comes to competing with the rest of the world, and particularly China. So I think there is a big need. I think that the Senate, we will conference it, and I think there will be some major piece of legislation dealing with chips, dealing with manufacturing, dealing with science and R&D, and hopefully also the Safe Banking Act to come out of a conference. And so, Brian, I think we're going to get this particular bill or some sizable portion of it through both houses and on to the president.
All right, Congressman, well, if that happens, then we'll have you back on here live on Yahoo Finance. Congressman Ed Perlmutter, Democrat from Colorado, thanks for stopping by. Coming up on the other side of this break, crypto regulation in the crosshairs. We'll speak with the head of Wyoming-based crypto bank Avanti about the future of regulation as Bitcoin rebounds from those January lows.
View today, the U.S. is urging Canada to use its federal powers to ease border disruptions as COVID-19 protests threaten to delay deliveries of goods and services. Demonstrators with the so-called Freedom Convoy have largely halted traffic along the bridge that connects Windsor, Ontario to Detroit, calling for an end to COVID-19 vaccine mandates for truckers. That has led Toyota, Ford, and General Motors to all halt some of their production as they struggle to source parts and supplies. The Ambassador Bridge remains a critical economic pathway with 25% of all U.S.-Canada trade passing through there. The White House says Homeland Security Secretary Alejandro Mayorkas and Transportation Secretary Pete Buttigieg are working closely with their Canadian counterparts to ensure the flow of goods. In an update this morning, at least one lane of traffic along the bridge has now reopened. Well, the teenage star of Russia's figure skating team is tested positive for a banned substance, putting her quest for gold in doubt. The International Testing Agency said 15-year-old Kamila Valieva tested for a banned heart medication that reportedly improves endurance in athletes. Now, that has upended the women's skating competition, where Valieva is considered the favorite to win gold. The IOC has not given a timeline for its own investigation. Valieva was part of the Russian group that won a gold in figure skating's team event this week. The U.S. took the silver in that event. And finally, in Russia, in explanation for that very long table used during that bilateral meeting between French President Emmanuel Macron and Russian President Vladimir Putin, Reuters reports the French leader kept an extra long distance after he refused a COVID test by Russian authorities to prevent officials from obtaining Macron's DNA. Sources tell Reuters Macron did take a French PCR test before leaving Paris and then took another antigen test conducted by his own doctor once he arrived in Russia. Macron's refusal meant he had to keep a distance of 20 feet from Putin per Kremlin protocol.
That photo is so large. The table's so large you couldn't even see them on the sides of what we just showed on the screen. Shifting gears now to the Omicron wave, which appears to be fading. We're seeing mask mandates in a number of states that have been strictly imposing such mandates, actually lifting or lowering their restrictions. But it's also a trend elsewhere as well. We're seeing Sweden, Denmark, Norway starting to ease up as well. So for the recap on all of this, let's bring in Yahoo Finance's Anjali Kemlani, who's been following the story very closely. Anjali, it seems like things are easing up, not just here stateside, but around the world as well.
That's right, Brian. And there is some concern from health experts and scientists about this move. We know that in Europe in particular, they're removing testing mandates for all inbound international travelers. That's something that we know that airlines have been pressing the White House for here as well. In the most recent interview with Yahoo Finance, CDC Director Dr. Rochelle Walensky said that is unlikely to be repealed anytime soon. And we know that even with the mask mandates dropping in some of the states, there really is still some concern about what that means. And it's important to point out that in some of the states, they are specifically saying that masking will remain in effect or is recommended for those who are unvaccinated. And that matches sort of what we are seeing in Europe as well with that removal of the testing mandate for vaccinated individuals. So really an emphasis on those that are vaccinated as we continue to see the Omicron surge subside.
And Anjali, there are a lot of parents who've been waiting for the results of that FDA review of COVID-19 vaccines for those under 5 years old. When are we expecting to get that?
Well, we're actually waiting for the details. The first look at the data that the advisory committee for the FDA is going to have to contend with right now today, that's supposed to drop. And that will give us a peek into what the thought process is behind the administration and the agency specifically asking Pfizer to submit for an emergency use authorization, even though they're still conducting a trial to figure out what is the best level of protection for the age group 2 to 4 years old. They are looking at the filing is for ages 6 months to 4 years right now. And that meeting is expected next week. And it puts Pfizer again ahead of the pack when it comes to vaccine authorizations. Meanwhile, we also got some news from Novavax yesterday with their clinical trial data of a 12 to 17-year-old adolescent group. Positive report there, 82% specifically largely against Delta, is where they show they didn't, the trial was conducted well before Omicron took hold, so no major data there. They also noted that there was no heart inflammation issues reported. That has been a concern for younger, specifically males, in the mRNA vaccines, and they do anticipate filing for that adolescent EUA in Q1. They already have the 18 and up pending in front of the FDA, but no word on movement there. And of course, all of this just to wrap on vaccines, to point out that we're still dealing with some hesitancy of vaccine uptake here in the U.S., not just with kids, which is still just about 20% of those eligible, but also in the adult group. New York City workers are looking at a deadline of today. The mayor saying that about up to 4,000 city workers could lose their job if they're not vaccinated by end of today. Back to you.
All right, Yahoo Finance's Anjali Khemlani, thanks for the headlines on that front. We'll have more market coverage on the other side of this break right here on Yahoo Finance Live. It is time for our Crypto Corner presented by Intuit TurboTax Live. With the macro picture including, it's really remaining a part of Bitcoin's story over the last month or so. You can see the big ups and downs, currently at about 43,500. It's going to be very interesting to see what Bitcoin does as the Fed actually begins the process of tightening later on this year. So let's bring in Caitlin Long, Avanti Financial Group CEO and founder, for a little bit more on the story here. Caitlin, it's been a rocky month, let's just say, for Bitcoin and crypto investors at large. What do you see as the biggest story for crypto in 2022?
Oh my gosh, we're only a few weeks into the year and there have already been a huge string of crazy headlines, which is normal for this industry. And so I think, to be honest, no one can predict what it's going to be, but at a macro level, we will continue to see big institutions come into crypto. Those of us like Avanti who are building for the next bull market are building critical infrastructure that big institutions require in many cases before they will come in. We've seen some institutions like hedge funds and family offices come in, but the big money like pension funds, endowments, and foundations is still largely on the sidelines. They're waiting for the good infrastructure that they're used to dealing with, namely bank infrastructure on the custody side, to be implemented. And that's where Avanti is playing, and we're optimistic that we'll be able to bring that.
Caitlin, we always like to talk to you about what's happening on the regulatory front. And I know the New York Fed just released their report on stablecoins. You had a pretty detailed response to that on Twitter, which basically sounds like there's a bit of good and bad in there.
Right. Yes, there's a lot of wonkiness to the money market plumbing that relates to specifically to stablecoins, which are a U.S. dollar instrument. It's really a new type of U.S. dollar payment instrument that can move U.S. dollars faster, better, cheaper, more transparently than traditional payment systems can. And it's all happening outside of the banking system. And so how it's integrated into the banking system is the specific question that has been studied quite a bit by central bankers, especially the Fed. And the New York Fed, which operates the Fed's trading desks, releasing that paper this week, it really was a big step forward. There is still a desire on the part of regulators to have only insured leveraged banks issuing these instruments. And I laid out, despite the big steps forward that paper implicated, that in fact, actually, you don't want leveraged banks to be the ones that issue these crypto instruments. They settle very fast, and the traditional financial system is designed for slow settlement. And those two things are fundamentally incompatible. There's a lot more bank run risk if you have leveraged banks that are at the core of the financial system issuing these instruments. And the main reason is because they're leveraged and they do what banks typically do, which is borrow short and lend long. And if you start to see mass withdrawals in the span of minutes, which could happen with these fast payment instruments, that does increase the risk of some financial system instability.
And it's so important to note that the stablecoin space is still growing. It's not like it's a massive scale enough for systemic risk. I know that's something that some people have pointed out, but I want to kind of switch gears here and just kind of ask about the personnel that's going to be down in D.C. When you think about Sarah Bloom Raskin as the Fed Vice Chair of Supervision facing a Senate Banking Committee vote next Tuesday, the Federal Reserve doesn't have as direct of a say on the regulation of especially unbacked cryptocurrencies, but did you see anything from her commentary that suggests there might be things to watch for in the regulatory framework as it relates to crypto if she is ultimately confirmed?
Not specifically from her, but as you know, in all of there are 5 Fed nominees, including Chair Jay Powell, that are coming up for vote next week. And in many of the hearings, it came up. Chairman Powell, of course, talked about it, as did Governor Brainerd, and made some specific comments about them, specifically related to where Avanti is, which is a special purpose depository institution that is purpose-built to be a bank for crypto custody, again, solving some of these institutional infrastructure needs of big traditional fiduciary asset managers. Those have not been approved yet. And both Chair Powell and Governor Brainerd did make comments that they are making progress. And Avanti has been very patiently working with the Fed. There are big policy issues that have had to be resolved, and we're optimistic that we will get through those.
And kind of related, but also not related, Sarah Bloom Raskin was part of Reserve Trust, which was a Colorado chartered trust company that applied and did get a master account with the Fed. And this is kind of inside baseball FinReg stuff, but it's relevant because Avanti has also gone through the process of applying for a master account. Give us an update, first of all, on how that's going. And then secondly, what are the obstacles to getting around this? Because there was some political interest in the way that maybe Sarah Bloom Raskin had gone about conversing with the Kansas City Fed, which clarified that there was no backdoor dealing here, but ultimately they did end up getting it.
Well, this has been a bit of a black box for years, and the different Federal Reserve banks, that there are several reserve banks that each independently have been making decisions about who gets access to what's called a Fed master account. You've got to be a depository institution to be able to get access to a Fed master account. That's what the Federal Reserve Act specifically says. And So fintechs that are not depository institutions cannot get access to a master account. Those, like the Wyoming Special Purpose Depository Institutions, are expressly depository institutions and therefore eligible. But it is a bit of a black box process. The Fed I believe it was April, put out a number of guidelines for public comment. It's coming up on almost 9 months, and they're still sitting out there, not finalized. And it is all part of the same question because you've got to be a bank under the law, specifically a depository institution under the law, to be able to get access to the Fed's payment system, and the extent of the discretion that the Federal Reserve has, and if so, what criteria are allowed to be applied, are open questions. And there's been a lot of discussion among those in the banking world about disparate treatment of the different applicants over the years for specific master accounts.
All right, well, still pending, but we'll have you on for the updates as you get them. Caitlin Long, Avanti Financial Group CEO and founder, thanks again for joining us. Coming up on the other side of the break, inflation might be felt at your Super Bowl party this weekend. We'll break down the cost of your chips and guac after the break. Welcome back to Yahoo Finance Live. If you haven't done your grocery shopping yet for the big game this weekend, you might be a little bit surprised by some of the prices you're going to see for the snacks or whatever else you're laying out for the weekend. Take a look. Guacamole, potato chip prices up 1% year over year. Salsa up 6%. So let's get a little bit more commentary on what we should expect to see in our basket of groceries this weekend with Michael Swanson, Wells Fargo Chief Agricultural Economist. Michael, you say that the cost of your Super Bowl party could be going up by 14%. I have noticed anecdotally for the bagel bites that I plan on rolling out on Sunday in the Brian Chung Consumer Price Index, that's been going up by like 10%. Give us the breakdown on what's getting more expensive this year.
Well, start out with the pain point. It's the protein. If you're going to fire up that grill Beef has been all-time record highs. We're seeing chicken wings really through the roof right now. We know it's a big seasonal item here, but compared to last year, well up, 20% in some cases or higher. And it's interesting, the guacamole that was a bargain about 4 weeks ago when we put together the research, Omicron really hit the truckers hard, and we're seeing some real spikes around the country on that particular item as well. So that was one that was very unpleasant to discover recently as we worked through the numbers.
Yeah, Michael, we were joking this morning that it should be an all vegetarian Super Bowl because the meat prices are just so incredibly high. What are some other things that you're looking at right now? You ran through avocado, which, I have noticed every time I buy mine at Trader Joe's. But what are some other factors that you're seeing? I mean, chicken wings, obviously something that people are looking at. I mean, how high can prices go? And are we seeing people maybe cut back a little because of those prices?
Those are great questions. It's kind of a two-step process here. One is, we're at $24 trillion on the GDP. That's a lot of money moving around this economy. So people do have the money, and so they're going to spend it. It's pretty much the definition of inflation. They have the money out there and have that demand. And so it's like you said, there's some real pain points out there. The protein in particular has been really impacted. So yeah, there's some bargains. You just have to really kind of draft carefully off that menu board that you're looking at.
Michael, arguably more important than the food itself are the drinks that you'll have. Give us the update on beer and other types of beverage prices. Those going up as well?
Not as much, about 3 to 4% when we checked BLS's numbers. And it's interesting, that's kind of pain for the brewers. Their aluminum costs are through the roof, their labor, their freight, all those things are through the roof as well. But too much competition. We've seen a lot of hard seltzers come into the market. And we're not seeing kind of the demand along with the craft beer expansion that we had. So they're really suffering under oversupply, even though their expenses are through the roof as well, just like everybody else's.
Well, Michael Swanson, Wells Fargo Chief Agricultural Economist. It's great to have you on today. Enjoy your Super Bowl Sunday. We will have special coverage ahead of the Super Bowl. That's coming up in our next hour here on Yahoo Finance. We've got some special guests lined up for you, including LA Mayor Eric Garcetti, Hall of Famer Troy Aikman, as well as the CEO of FanDuel, Amy Howes. You certainly don't want to miss that. That is coming up at the top of the hour. But coming up on the other side of the break, Facebook parent company Meta releases its Super Bowl ad promoting what else? The metaverse. We're going to reveal that commercial with a cameo appearance from an animatronic dog. That's coming up after the break.
Creepy.
You are looking at a preview of that ad from Facebook's Meta Platforms, looking to take the metaverse mainstream this Super Bowl weekend. The company unveiled its ad ahead of the big game. And Brian, I have to say, okay, we'll talk about the business side for Facebook, Meta, in just a bit, but I actually like the ad. I feel like it really does point to this transition into the metaverse. My only question is, every time I look at what's in the metaverse, I don't know why we can't get the full body yet. I want to know how long it's going to take for us to see our full bodies in the metaverse.
Well,
do you notice it's just the head?
Right, Meta's conclusion is probably, I guess, that legs are weird. But look, I mean, I think let's just back up for a second, right? Spoiler alert for those that haven't seen the ad yet. You'll see it on Sunday anyway. It's this washed up animatronic, like Chuck E. Cheese looking goofball dog that ends up getting retired from his job forcefully because the arcade closes, and then he gets like thrown out of a car at one point, and then he ends up finding an Oculus and then finds a new life in the metaverse. But like the whole theme of the ad is like, this is, I feel like Miles Odlin here, this is like a thing for losers. It's like people who are like dejected from society and then like find a new life in the metaverse. Like, I don't know if that's the theme that they were going for. I mean, it was cute, I guess.
That was not my takeaway, I have to say. It was like people who still wanted to hang out after things closed down, so then you could actually go and meet them in a virtual universe.
They lost their job. It's jolts. It's actually a labor market story, really.
Always tie it back to the labor market. You know, we should point out, by the way, VR headsets, sales of VR headsets have actually been picking up. You know, obviously there's been a lot of attention focused on the metaverse since Facebook announced their name change to Meta. You're looking at the price tag right now, $299 for a Quest 2. I'm going to say I have one at home, and it's incredible to see how quickly that technology has advanced. And I don't want you to count me among those losers who are putting on a headset. I won't be putting on a headset during the Super Bowl. But I think it's kind of an opportunity for Facebook. I mean, if you think about the most recent earnings report, they broke out Facebook Reality Labs. The number wasn't necessarily good. It was a loss of more than $10 billion for the last year. The company said it's going to take about 15 years to see the full universe. But step one for Facebook is getting those headsets in the hands of people so they actually can explore the metaverse.
I think it's cool now because you have one. That's my last comment. I changed my.
There you go. I'm not working for Facebook, by the way, but it is pretty eye-opening. I have to say, the content is not there fully yet, but when you put on the headset, you realize what the potential is. So, one of many ads we're going to be watching for this Super Bowl Sunday, but we're going to talk much more about the Super Bowl on the other side of the break. We've got an hour-long special for you and some pretty big guests here. You're looking at LA Mayor Eric Garcetti, FanDuel CEO Amy Howe, and then, of course, Hall of Fame quarterback Troy Aikman. All that is coming up ahead after this short break. Welcome to this Yahoo Finance special, looking at the business around the big game. And of course, Brian, we are counting down to Super Bowl Sunday with the LA Rams and Cincinnati Bengals meeting for the first time in the big game. Los Angeles is going to be hosting the event for the first time in 30 years. But for the Bengals, the wait has been even longer. The team hasn't played in a Super Bowl since 1988 when they lost against another West Coast team, the San Francisco 49ers.
And the hype is real. Average ticket prices blew through previous records, according to data from TickPick, although it's been coming down a little bit as of the last day or two. But although prices could drop ahead of Sunday, anecdotes of parking spots more expensive than the seat itself really underscores the droves of people heading to LA for the historic matchup. And that's not the only place where money is flowing. Record amounts of bets are expected on the game nationally, with sportsbooks just a tap away. And of course, there's money in it for Los Angeles, a city that 7 years ago had no NFL team at all.
Yeah, certainly. We've got all the angles covered for you over the next hour with a great lineup of guests. We've got LA Mayor Eric Garcetti talking about the economic impact the big event is expected to have on the LA region. We're also talking about the explosive growth of sports betting. FanDuel CEO Amy Howe is going to be joining us later this hour. And finally, a conversation with Hall of Fame quarterback Troy Aikman. We're going to be talking to him about the state of the NFL and the scrutiny around the league's hiring practices.
A packed hour that we have ahead of you, but let's get started and jump right into it with Super Bowl ticket prices elevated as the Bengals and Rams fans try to figure out if they want to be in front of the TV or in the stadium in Inglewood. Yahoo Finance's Dave Briggs has been following all the action. You know, Dave, we talked about this yesterday, the expectation that as you get closer to the game, some of those ticket prices might drop. Are we already starting to see that?
Yeah. Hey, guys, good to see you. I said yesterday, I think these tickets are going to crash. It'll be Deflategate 2, and we are seeing it. I told people to go out there, get a ticket to Los Angeles, wait it out. Don't jump on these early tickets. And you won if you listen, because they are falling. Just 2 days ago, we were seeing an average buy-in price, which is the cheapest pair of tickets, which was around $5,000 per ticket. It dropped about $1,000 in 24 hours to about $3,400. It dropped again about another $1,000. And just now on the NFL Ticket Exchange website, Ticketmaster, we're now at $2,850. So I think you're seeing $1,000 approximately drop each of the last 2 days. Frankly, I think we'll see another $400 or $500, and we'll settle somewhere around that $2,000 to $2,500 per ticket buy-in range, which is out of our too rich for our blood, but way down from the numbers we saw earlier in the week.
Yeah, Dave, now I'm starting to wish that we had a conversation earlier on the week, because I did look at ticket prices, flights to LA. And if you're talking about the potential payoff maybe coming right up to the game, I mean, you're saying there could be a ticket to be had.
I think if you're walking up to SoFi Stadium that morning, I think you'll be under $2,000, which is a massive savings over what we saw earlier in the week. Now, look, we always see prices fall a little bit ahead of the game, but this one's different in that I just don't see the demand out there. And I think that's because you don't see a hot national property. You don't have the Cowboys. You don't have the Patriots. You don't have Tom Brady. And quite frankly, nothing against the stars in this game. Huge fan of Matt Stafford and Joe Burrow and OBJ and Cooper Kupp, just to name a few, Jamar Chase. But you don't have a real household name. You don't have someone that really puts butts in seats. But what you really need for this game is someone like the Cowboys, Steelers, Packers, or Tom Brady to really keep that demand high. And I just don't see it. I don't feel it. I don't see the numbers dropping or falling in terms of the number of tickets sold. They're just still hanging out there. And the problem is California should be a home run having the Rams in it, just not a diehard fan base, probably because that franchise left, went to St. Louis, came back. I think this will be a huge springboard for football in Los Angeles, but that is not a football town by any means.
Dave, a lot of narratives around the game itself, as you laid out, but also around the platforms that you'll be watching it on. NBC carrying it on Sunday, but they're juggling the Winter Olympics, and it kind of underscores the priorities here that they flew Mike Tirico from Beijing back to Los Angeles in the middle of it all. How do ratings numbers kind of come into play here for specifically NBC when they're also trying to launch Peacock?
Well, you hear a lot about the ratings right now. I think Peacock's going to see a huge boost because they're not seeing it with the Olympics, which are down about 40% night to night from the 2018 Winter Games. So I think the Olympics will see the big boost here from what they've seen over the last couple of days, and that will really help Peacock. Maybe that pregame show will help Peacock. But I've seen some huge numbers predicted out there for the ratings, in particular, Predict HQ, who will have on Yahoo Finance later in the program. They believe 117 million people will tune into this Super Bowl. That would shatter the all-time record of 114 million that watched the Patriots and the Seahawks in 2015. I hate to be the wet blanket here. I just don't see it. And again, it goes back to having a real cornerstone franchise or one of the league's signature stars. I think the numbers will stay similar to what we saw last year, which was around that 90 million mark. Still a huge number. We shouldn't make too much of it. A $90 million fan viewer figure is still a huge audience, but you had Tom Brady against Patrick Mahomes, and I know COVID played in. There were no fans in the stands last year. We were all burned out. But two of the biggest stars in the history of the game were in that Super Bowl. We don't have it this year. And I don't hear, just anecdotally, the buzz that you typically hear about a Super Bowl. So I'd expect a similar number, around 90 million viewers. But what does NBC care about? 30-second commercials, averaging $6.5 million per 30 seconds. That's a record, and that's what NBC cares about, and what they should, frankly, care about.
Yeah, certainly. Maybe making up for the lack of viewership with the Olympics too. All right, Dave, we're going to check back in with you a little later this hour. But, Brian, I think he brings up a good point here about the stars not necessarily being in this game. But I would argue, I would counter that saying that, like, if you're talking about the big names like a Tom Brady, in many ways, no offense to Tom Brady, that's kind of the old guard. And so this is the game that the NFL at least sees as a way to bring in a new generation. And we're not just talking about the players, obviously Joe Burrow just in his second year in the NFL, but also the coaches here. We've got a face-off between Zach Taylor and Sean McVay, both of which are in their late 30s, and we haven't seen a matchup like that before.
Yeah, and I think there was some statistic that an NFL conference championship that didn't have either Aaron Rodgers or Tom Brady hasn't happened since 2009, and it happened this year. So it does feel like there's a bit of a changing guard here. But just kind of largely, I think when it comes to the viewership numbers, I think it's actually the Bengals that are going to be bringing people in who maybe have not watched previous Super Bowls when you consider Joe Burrow being a rising star within the league. But the Rams really got blown out the last time they were in the Super Bowl. So people who might be looking at this and go, oh, Sean McVay simply can't do it. Maybe this is going to be different, obviously, because you have a different quarterback there. But I think it really is the fresh face coming out of Cincinnati that could be pulling people in. So we'll see. I'll obviously be tuned in.
Yeah, I'd be curious to see what the makeup of the fans are, too. I mean, yes, you could argue it is a home game. But at the same time, Dave makes a good point that this is not LA is not a football town yet. It is a basketball and baseball town when college football is doing great. There's a lot of sports to compete with. So I'd imagine the Bengals is going to have, their fans are going to have a big presence, but something to watch for come Sunday. All right, coming up on the other side, LA Mayor Eric Garcetti joins us to discuss what the Super Bowl means for the local economy, with the region hosting the big game for the first time in nearly 30 years. Before we go to break, though, let's take a look at the records of both the LA Rams and Cincinnati Bengals. The Rams went 12-5 to capture the NFC West, while the Bengals won the AFC North at 10-7. We'll be right back. Well, Super Bowl 56 marks LA's return to NFL prominence. The city didn't even have an NFL team until the Rams returned to LA in 2016, followed by the Chargers. With a hometown team in the big game, the LA region is expecting to get a big economic lift. I spoke to Mayor Eric Garcetti earlier this week to discuss LA's journey back to the Super Bowl.
It's such an amazing week. I think that LA can lay claim to being one of the greatest, if not the greatest sports city in the world, and certainly will be the capital of the sports world this weekend. But it really reflects, I think, the spirit of a city that for a long time put its values out there, that we weren't going to necessarily subsidize a stadium, but we wanted the NFL, and the NFL couldn't afford not to be in Los Angeles with this market, with this kind of West Coast capital, with the entertainment industry. And I think that's reflected in what we're going to see this weekend, which is, one of the greatest halftime shows ever, our own team in the Super Bowl, which for me as an LA Rams fan is like a dream come true. But when you think about what's going to be in this stadium, not just football, but the Olympics and Paralympics, the college football championship, WWF, all these things that are going to kind of put this place on the map, it shows that LA is very much back, but also that we do things that are next level. It's pushing the idea of a stadium, the enjoyment of sports forward in a way that also benefits the people who live here too. And that's been a really important part of the story.
How big of an economic lift are you anticipating from the Super Bowl alone? I mean, there's some estimates out there that have put it up well over $200 million.
Yeah, and that's a low ball. We think that the $1.3 billion in nominal dollars just overall, but at least $500 million directly to our economy, just tax revenues. There's, $22 million estimated to come that we'll be able to put into city services and to be able to help not just the city of Inglewood, which has been such an amazing place for the stadium to be, but for us in the city of Los Angeles or surrounding it, our hotels, all of our venues, a lot of places that almost closed up because of the pandemic or just reopening, who've had the toughest couple of years, can earn enough in a week when a big event like this comes that they can, pay the bills for 2 or 3 months. And so we're very excited too that the NFL has focused on local businesses, over 250 small businesses, many of them women-owned, veteran-owned, minority-owned, to be able to let them know how they can become medium-sized and even big players in the future, and not just have the NFL come into a town and occupy it, spend on themselves and leave. They're really spending on LA, which is a beautiful thing to see.
Let's talk about where the economy is right now. As you alluded to, I mean, LA, one of those cities that got hit pretty hard over the pandemic, something like 770,000 jobs that were lost in the first few months alone back in 2020. Your unemployment rate has come down, but it's still above what we're seeing nationally at just over 8%, I believe. How much of this money that we're seeing from these opportunities that have come with these big sporting events have actually trickled down?
We know that Los Angeles's kind of hospitality industry is a core industry, whether it's tourists coming, whether it's events like this or the Oscars, Grammys, it's a key part of our economy. And while we go into usually a deeper hole when there's economic downturns, we also accelerate out of them faster than anybody else. Recently, analysis from Bloomberg showed us that Los Angeles is leading employment growth of every major city in America post-pandemic. more than cities in Texas, more than New York, Chicago, more than California at large. So we're not just benefiting, from events like this. I think we've been very strategic about making sure that we spread between neighborhoods and industries what this prosperity looks like. And on the business side, that's employment growth. Our publicly traded companies have the highest increase of their valuation post-pandemic too. So both the business and the worker side is really headed in the right direction. And we see, you don't have to look at macroeconomics. It's conversations with Angelinos who say, oh, my flower shop got boosted. There's more people eating who came out of town. We welcome folks from Cincinnati, even international travelers as they begin to come back. We're feeling that in a way that really does spread to our individuals and not just to the large corporations here, but especially those mom and pops that are the lifeblood of our main streets.
With that said, you and other leaders in the city have gotten a lot of criticism for this divide that seems to be growing. If we're talking specifically about the Super Bowl and SoFi Stadium, you've got the residents of Inglewood on one side where we still see a poverty rate in double digits, and then those this weekend who are spending, in some cases, hundreds of thousands of dollars to get into SoFi Stadium for the Super Bowl. How do you ensure that, if we're talking about one specific project here, how do you ensure that the economic benefits, the recovery from the pandemic, are more equal?
Well, I share those same concerns. I've devoted my life to, economic opportunity and public service, addressing that. And, the story really of the past 30 years was disinvestment in South Los Angeles and Inglewood and places like that. I'd much rather have investment and try to tackle how we can make sure that's equitable than not have any investment at all. Because we know when people disinvest, crime goes up, we know poverty goes even higher. But whether it's bringing public transportation, and we're very excited in the coming year to open up public transportation that'll go straight down almost to the stadium and then to LAX with the Crenshaw LAX line, or LAX and the building of SoFi. LAX, we're spending $16 billion to welcome the world and our country to come to LA in the future. But those jobs, 27% of those local construction jobs, a percentage almost unheard of, come from local folks that we've trained in the crafts. These are good middle-class jobs for folks who live in Inglewood, to purchase a home, to be able to stay in their neighborhood, to be electricians, plumbers, carpenters, iron workers. I just toured yesterday the People Mover, which is our train to the planes at LAX. For some reason, LAX has never had public transportation go directly to the airport. And it looks like a Roman aqueduct. And, talking to some of the laborers that were up there, they just said how it changed their life. Some of them had served time. Some of them had been homeless. Some of them, there's women that are working who traditionally aren't in the building trades. And it's transformed their lives. And they have queued up work now for the next 40 years because we're building 15 rail lines, welcoming the Olympics and Paralympics. So we're really trying to be strategic, that these things aren't just about the big spenders who come in for that weekend. This is about the lifetime residents that are here for the long haul.
We've got just a few minutes left here. I have to ask you about the game. Obviously, you're rooting for the Rams. I'd imagine you're going to pick them to win. What do you see as the keys to the game?
I'm absolutely rooting for the Rams. I feel like an 8-year-old all over again when I went with my dad to the Rose Bowl to watch them play the Steelers. I think that their poise and their maturity really has been demonstrated in the playoffs. It seemed some people were wondering with a new quarterback, would we be able to gel as a team? We have such amazing talent, such connection. And I think the key is the Rams don't lose your cool. There's an amazing quarterback in Joe Burrow's on the other side. There's a lot of underdog sentiment for a great team from Cincinnati, and we love having them here. But this is our destiny. I've been very lucky as mayor. We've won a Stanley Cup, we've won WNBA, won the NBA championship, the World Series, an MLS Cup. All that's missing is a Super Bowl. And for us to write this, Hollywood couldn't script this story. In our own backyard, the most incredible stadium ever built, with a Rams that are surging, an amazing coach, an incredible team, and a city behind them. I think it's going to be the crowd. Hopefully there'll be a lot of Angelinos there really playing their role. And then, Matthew Stafford having that poise that we've seen and the amazing team behind him. Last thing is our defense. I think in the moments when we've fallen behind, Aaron Donald rallies that crew and makes the game-changing plays. So I think it's going to be close, a lot closer than people think. Rams are good coming from behind, so not going to worry if we fall behind, but this is our moment, and I think the Rams are going to pull it off.
You heard her right there. LA Mayor Eric Garcetti saying the Rams are going to come from behind in the big game. You know, Brian, we've been talking so much about this being the return of the Super Bowl to LA. The last time it was held there was nearly 30 years ago. But the mayor has really used this event to say this is kind of the start of what should be a pretty busy 5-6 year run for the city of LA in terms of hosting sporting events. You've got the MLB All-Star Game at Dodger Stadium this summer. You've got the College Football National Championship game being played in SoFi Stadium next year, and then WrestleMania. And then waiting at the very end of all of this is, of course, the 2028 Summer Olympics. And the mayor has put a lot into that, not just as an event, but really as a way to build out infrastructure as he sees it that's necessary to upgrade the city.
Yeah, and I think the infrastructure is such an interesting thing here because Los Angeles has so many different venues. I mean, even if you just zoom into that kind of 2 mile by 2 mile square in Inglewood, California, right across the street from SoFi Stadium where the Super Bowl is going to be had on Sunday is the Forum, which was a big bastion of basketball in the city of Los Angeles that's effectively going unused by the two major sports teams, which are at the Staples Center, now the Crypto.com Arena. But then the Clippers, which are the better NBA team in LA right now, are going to be moving over to the Intuit Dome, I think is what it's called, which is going to be just south of SoFi Stadium. So that whole complex is really building up. But then you talk to Eric Garcetti about how he remembers games happening in the Rose Bowl. I mean, teams have been playing in so many different places, even just inside LA. And, you know, for those that haven't already caught that, Akiko might have an LA bias, you being from LA. I mean, you've seen that history over time, right?
Yeah, and it is pretty incredible, to your point, Brian, because the city is so spread out that you've now got this hub in the city of Inglewood with the Forum, with the new arena for the Clippers, and with SoFi Stadium. But, you know, it's worth noting that has kind of come at a cost in many ways. Those residents in the city of Inglewood will say, you know, look, this is all great. We're glad development's being made in our city, but it's not necessarily trickling down to the average resident. And that's been a big point of contention. Obviously, Eric Garcetti, the mayor of LA, James Butts is the mayor of Inglewood. But that's a thread I think that's going to continue to be discussed over the years here as LA continues to build out for the Olympics, because it really is about investments, but also an equitable investment in being able to build the infrastructure that benefits, especially the low-income communities.
Yeah, well, from LA to gambling, we're going to take a look at the record number of Americans on the other side of this break gearing up to place their bets on the Super Bowl. The American Gaming Association expecting over $7 billion, with a B, dollars to be wagered on the big game. We'll have the FanDuel CEO joining us to discuss on the other side of this break. With sports gambling going online in so many new states between last year and this year, there could be a record amount of bets placed on this year's matchup. The American Gaming Association forecasting over $7.6 billion to be bet on Sunday's game. Let's bring in Yahoo Finance's Josh Schaefer, who's got the breakdown of what to expect in terms of the gaming volume. Josh.
Yeah, Brian. So the American Gaming Association, as you said, expecting $7.6 billion this year. That's up more than $3 billion from last year. So a big uptick. And they're expecting 31.4 million Americans to bet on the game. That's up 35% from last year. I spoke earlier this week with the American Gaming Association CEO, Bill Miller, about the increase in betting interest from last year. And he really cited legalization and the genuine interest from bettors to bet by legal means. Part of this is because they like the marketing deals, the promotions, the apps they're seeing from these companies, and the way that they're able to use that in an easier way than maybe the illegal means that they're used to. And more states in general are just opening up legal gambling. We can see on the map here that we now have 31 markets that are going to be available for some level of sports betting on Sunday. That's 10 more states than were available last year. So it's growing and growing. And Miller predicts it's going to grow more this year, leading into next year's Super Bowl. 3 states right now are legal but not active, and 7 states have legislation filed where it might change in 2022. He said some big states to watch moving forward are Florida and California. Those major big states with huge populations. We just saw last month with New York, $1.6 billion in about 3 weeks of gambling when New York opened up. So those big markets have been huge for these gambling companies. And I did want to hit on some other more fun numbers at the end here, just kind of what's going on with the game and the gambling. So we saw Action Network release some numbers that we have about where the money lies for the game, who's betting where. Seems like more people so far are betting on the Rams. The Rams are 4.5-point favorites. That seems to be where people are kind of hedging their bets. And then we have some other more fun ones. The MVP, I know a lot of folks here on the show are fans of Joe Burrow. He's at plus 230 odds to be the MVP. And then Rams receiver Cooper Kupp comes in at plus 550 odds. These are odds out on FanDuel. And a final fun bet for you guys that I personally love. I think it's great. The Gatorade. You can bet now. This is how these gambling companies are growing so much, guys. You can bet on pretty much everything. You can bet on the Gatorade. What Gatorade is going to be dumped on the winning coach. You can see you got orange and blue in there. And then if you're really looking for that value play, way to make a quick buck, you can go purple Gatorade at plus 1,180. That's $10 to win $118. Not bad if you ask me.
Yeah, but at the same time, Josh, purple is absolutely the worst Gatorade flavor. But thanks again for breaking all that down for us. Yahoo Finance's Josh Schaefer. Well, let's bring in one of the sports books in the middle of it all. Amy Howe is CEO of FanDuel, actually joining us live from the Radio Row at the Super Bowl. And also Yahoo Finance's Dave Briggs, also back in the stream for this conversation. Amy, it's great to have you on Yahoo Finance Live. I want to ask you just about the broad expectations as Josh was laying out. A lot of volume could be coming in. Do you have any projections, expectations for usage of your app on Sunday?
Yeah, we sure do. Listen, this Super Bowl is going to be the single biggest sports betting event in history. So that just gives you a sense of the magnitude of what we're coming into. On our platform at FanDuel, we're expecting upwards of 7 million bets. We think 50% of those are going to be player props. We just talked about some of those. And it just makes for a much more engaging experience, right? It's not just about the outcome of the game, but you have skin in the game on who's going to be the MVP, who's going to score that first touchdown. So it's just going to be unprecedented volume. And we saw that during the playoffs too. Our playoff volume was 4 times what we saw last year. So it's gonna be a banner weekend for the business for sure.
Amy, Dave Briggs here. Looks like Pat McAfee having a good time behind you. Not sure what he is drinking.
Pat is having a good time. He's drinking iced tea, just to be clear.
I'm curious, how big is the female demographic in sports betting? And I saw a study that actually suggests women are far more successful than men when it comes to sports betting. What do the numbers show?
Yeah, well, as you can imagine, this is a topic that I care deeply about. If you look at the statistics, 50% of sports fans are women. If you look at the sports betting population, it's actually much lower than that. It's really, you're showing 33%. Our numbers would suggest it's even lower than that. But there's a huge opportunity, right? When you see just how much the sports fans over-index. It's a big priority for us. But listen, we talk about the fact that Online sports betting is in the early innings. On this topic, I think we're in the pregame show, but there's a lot that we're doing to really try to own this. One is we're supporting female athletes. We were the first to support the WNBA with a great relationship with the Women's Tennis Association. So, I believe it starts with fundamentally supporting that female athlete. And then in terms of reaching the consumer, we've done some great things. We've partnered up with The Gist, trying to find ways to make sports betting less intimidating to the female consumer. So lots more runway there, but I think there's a really exciting untapped opportunity that we can go after as an industry and as a company.
Amy, let's talk about where you are in the state of California, because online betting, or sports betting, I should say, is not legal yet. There is a push to try and get it on the ballot come November. And you had 3 California tribes come out this week attempting to block that initiative, saying they'd set aside $100 million for it. Talk to me about the potential you see in California, how significant that market is, and the challenges you see to legalizing online sports betting there.
Yeah, California represents a huge market, and the American Gaming Association just put out a study that said that 80% of Americans want sports betting to be legalized and regulated, and that's exactly what the residents of California want. We've been working very closely with the Native American tribes. FanDuel, along with a number of other operators, are supporting California for Solutions, and that money is going to homelessness and mental health. And we're very busy collecting the number of signatures that we need to get that on the ballot for November 22. So cautiously optimistic, but that's exactly what the residents want. They want to be participating in this in a very safe and legal and regulated way, as you're seeing in 14 of other states right now. So optimistic.
Amy, Dave here again. So sports betting apps are going all out to lure new customers, and FanDuel's promotion has really got some attention. Several friends have reached out to me. I'm a proud user of FanDuel and said, explain to me this 56-1 odds. It can't be real. It must be too good to be true. Can you explain how that works?
I can. It's a great promotion. You have to remember that NFL and Super Bowl specifically is our biggest acquisition event of the year, and so we're going to be more generous for this event. But basically, if you spend a $5 bet and your team wins, we're going to boost that odds 56-1, and you're going to win $280 if you pick the right team. So that's for new users that sign up. But we also have a great risk-free same-game parlay promotion that any user on the platform can get. So there's lots of ways to participate. And candidly, even if you're not in one of the 14 states that are legalized, you can participate in fantasy sports and our great bingo event. So there's opportunities for everyone to really elevate that sports experience in the Super Bowl specifically.
Amy, and last question here. Once you onboard people, perhaps through your promotion, how do you keep people on the app? Because it seems like loyalty is going to be an issue with so many competitors out there. How do you keep people coming back to FanDuel after those promotions are no longer around?
So we're laser focused on making sure that we have the best product in the marketplace. We have been the home of same game parlay for now several years. For NFL this year, we had 80% of our NFL actives tried either a parlay or same game parlay. So we're going to give them the most innovative product, and that's what keeps them coming back for more. And at the end of the day, we also need to make sure that we have a safe platform that's easy to use, and we're incredibly proud. We've made it through the NFL, where we had record volumes that surpassed last year's Super Bowl, and the stability of the product was really terrific. So it's all about a great product and a seamless experience.
Amy Howe, FanDuel CEO, racing for a very busy week. Enjoy the game. Wishing you the best of luck.
Thank you so much.
This weekend. Coming up, this year's Super Bowl could reach a massive audience of 117 million viewers. That's at least according to data from Predict HQ. That would mark a 21% jump from last year. Dallas Cowboys NFL Hall of Fame quarterback Troy Aikman is going to be joining us on the other side of the break to discuss all of that and much more. We'll be right back. Well, the Super Bowl kicks off Sunday amid growing scrutiny over the NFL's hiring practices and its lack of diversity. The league has just 5 minority head coaches, raising questions about effectiveness of the Rooney Rule, which was intended to promote diversity. And all this comes as the NFL faces a lawsuit from former Miami Dolphins head coach Brian Flores. Let's bring in our next guest, Troy Aikman, Dallas Cowboys NFL Hall of Fame quarterback, joining us from California today. We've also got Brian Sozzi joining in on the conversation. Troy, this was kind of the big question that NFL Commissioner Roger Goodell got earlier this week about what more the league needs to do to promote diversity within the league. But it feels like there's 2 narratives going into the game this weekend. On the one hand, the NFL is seeing huge ratings, certainly some big name games here, close games during the playoffs. That's a positive. And yet it feels like the question about culture is still clouding all of that.
Well, I think you're right. And when you look at the hires, I guess, and where the minority head coaching is, really probably across the board, even at the general manager level and executive level, that compared to a few years back, we have fewer head coaches, at least, minorities. So I know that Roger Goodell, he's addressed it, trying to improve that. The Rooney Rule, as you mentioned, was put in place to help minority candidates. Has it been as effective as what they would have liked or had they hoped when it was implemented? No, it hasn't. The solution to that, I'm really not quite sure. I'm sure the league has taken a good hard look at it, and the commissioner with his leadership will do everything he can to change the tide.
Hey, Troy, it's Brian Chung here. As a follow-up to that, this is not something that a rule can fix itself, as we've seen from this incident. You've been in the general manager's office. You've been in those locker rooms. This seems to be an issue about culture. So even if there isn't, let's say, for example, a rule that can fix this immediately, what's the framing need to be like in the management and in the locker room to make sure that this does improve over time?
Well, I don't have the answers to that. I'm a football analyst and I broadcast football games. Trying to address diversity at the executive level and how the hires are being made, whether that's at the NFL level or at the club level. I know that it has been addressed. It's been talked about. There's been discussions about incentivizing teams for minority hires. I don't have the answer to that. I'm not paid to have the answer to that. So I just try to do what I'm paid to do, and that's called football games for Fox, and let those that are in those positions of hiring handle that part of it.
Troy, a lot of focus, a lot of attention on Joe Burrow. How does he stay grounded ahead of a big game like this? Take us inside what he could be thinking today.
Well, it's an exciting time for both of these teams. It's culminated in a great season. It's culminated into a Super Bowl appearance. And who would have imagined, especially after the last couple of seasons that Cincinnati has had, that they would be representing the AFC. But Joe Burrow, of course, has been a huge part of that. I think it's a great story. I'm a huge fan of his. I love that Cincinnati's done what they've been able to do and has re-energized a fan base that hasn't had a lot to cheer about, in quite a number of years. And so to be able to win some playoff games, get to the Super Bowl, Joe Burrow, who is, along with Patrick Mahomes and a few others, becoming the face of the NFL, and just love the way he presents himself, the way he represents the NFL. And I'm excited to watch him play, as I am Matthew Stafford. He grew up in my backyard there in Dallas, Texas, where I live, right where I went to high school, right where my home is. And so he's a great story as well, with the expectations on him once he made the trade and went to the Rams, and after not having won a playoff game, and now here he is where they expected the team to be when they made that trade back in the offseason. So I'm excited about all of the storylines. You never know what's going to happen in a game like this. There's a lot of emotion, a lot of adrenaline, and I'm looking forward to watching it, as is most of America.
So, Troy, you live in Texas now, but you've got a lot of ties to LA, where the game is being played this weekend. Obviously, you played college ball at UCLA, but you also won the Super Bowl MVP for the last Super Bowl that was played in LA. I wonder how you look at how the sports landscape has shifted in that particular market. And what does this Super Bowl mean in terms of trying to accelerate at least NFL's expansion within the city? The mayor we heard from earlier today said, look, this is a city of champions, but the reality is football is not the top game in LA, at least yet.
Yeah, it hasn't been. Of course, right now in Los Angeles, it's the Lakers and it's the Dodgers, and they've been without an NFL team for a number of years. And so there's a generation of fans that haven't had a team locally to root for. And that's why we saw what we saw with the San Francisco 49ers when they came to town and were playing in such a meaningful game there in the postseason. But I think that game, I think NFC Championship game was a big game for the Rams to win in order to create interest in football and, more importantly, in the Rams themselves, and now to be in the Super Bowl. I think that, Stan Kroenke with the stadium, and I think the Rams and Sean McVay and all that they've done, Kevin Demoff as well, there's been a lot of good things that have happened for this organization since they came from St. Louis. I think they've done their part, and slowly I believe they are recapturing that fan base. I grew up in Cerritos, California prior to moving to Oklahoma, and the Los Angeles Rams were my team. And so they, in my opinion, are where they belong because it's where I knew them to be when I was a kid, and they've played some really good football. So I think that, like you said, LA's not a lot unlike a lot of other cities around the country that LA likes supporting winners. Dallas is the same way. Most cities like to support those teams that are successful, and the Rams are certainly having a lot of success.
Hey, Trey, last time I spoke to you, you were getting ready to, or you were just about to launch your 8-beer line. I've since seen some photos of you tending bar. What appears to be in various places in Texas. How's the launch going?
It's going amazing. I mean, it has been a long time in the making, as we talked about, over 2 years. Finally launched on February 1st. We're on draft and in cans, on premise, in select bars and restaurants across the state of Texas. We'll be on grocery store shelves, convenience store shelves beginning in the spring. But people are excited. They understand what the beer is all about. It's for people that are go-getters, that wake up with a passion and a purpose. And as we talked about back then, there's no adjuncts and no fillers, meaning there's no corn, no syrup, no rice, no added sugars, 100% organic grains, 90 calories, 2.6 carbs, and we didn't sacrifice any taste in building this. It's something I'm real proud of. And so far, the response has been what we had hoped that it would be. People are as excited about it as we are.
The teams here are going to be slinging those back on Sunday. Final question here. 4-point favorites for the Rams. Who are you taking in the Super Bowl? And also, who do you have as MVP?
Wow. I don't at all. I don't have a rooting interest. I hate that, this is a game, as I said a moment ago, you just hate that somebody has to lose. If I don't want to be the diplomat here. If you said, hey, who do you pick? If you had to pick somebody, I'd go with the Rams. I think they're obviously an all-star team. They've got a great pass rush. They're playing at home. There's some familiarity, of course, with the stadium. I think that there's an advantage in that regard. But as I mentioned, because of what Cincinnati's been able to do in the postseason, nobody has really counted on them to be able to come through and win the games that they've already won. I would not be surprised with any outcome. I've been a part of 3 of these games. Anything can happen. We've all witnessed that in prior years. The MVP is going to be one of the quarterbacks. It usually is. So I don't think I'm going out on a limb on that one.
All right, well, maybe that takes Cooper Kupp out of the running, but Troy Aikman, Dallas Cowboys, NFL Hall of Fame quarterback. Thanks for stopping by Yahoo Finance, and Brian Saucy, thanks for joining for the conversation as well.
Appreciate you.
Coming up on the other side of the break, scoring a touchdown on market returns. We're taking a lighthearted look at how past Super Bowls stack up against the stock market next. welcome back to Yahoo Finance Live. You know, usually when we bring in Yahoo Finance's Jared Blickery on the show, he's drawn some squiggly lines on a chart showing us some vomiting camels, some death crosses, if you will. But today, keeping in the theme of the big game on Sunday, Jared's actually going to walk us through some statistics about some predictive analytics of the football game to the markets themselves, thanks to S&P Global Market Intelligence. Jared, tell us about some of the odds and some of the numbers that you look at, including the over-under on the total amount of points scored. What does that tell us?
That's right. S&P has really done a number here, no pun intended, just looking into some of the possibilities and really interesting. Let's go to the Wi-Fi Interactive. You can see here, if the final combined score, that's the both scores of the teams combined, if that's greater than 46, the market, that is the S&P 500, tends to be up 16% almost. Now, if it's less than 46, the market's only up about 8.2%. Looks to me that they used a little bit of cherry picking here. I've done some of these optimizations myself, but nevertheless pretty interesting. And here's another stat. Locals rule, the designated home. When the designated home team wins, guess what? The market's up almost 17%. And when the road team wins, it's up only about 9%. And by the way, the Bengals are the designated home team this year, even though the LA Rams are playing in their home city at SoFi Stadium. So going to be really interesting to see who wins, given the fact that both are basically the home team right here. Now, we also have, going back to Cali, when the Super Bowl is played in California, stocks tend to be up almost 16% in those years. And there have only been 10 states in which the Super Bowl has been hosted, and California trails only Florida in terms of market returns. And I'm going to be writing about this today. You can read it at yahoofinance.com over the weekend, and I'm going to lay out exactly which states produce the best returns. Also want to take a look. Oh, that's another one we haven't gotten to yet. I'll tell you what, I'm going to go back to the beginning. I just want to add a couple more stats here. The market performs better on average after an NFC win, returning an average of 13.8% versus 10.7% after an AFC win. And by the way, both the best annual return, that was 37.6% in 1995, and the worst return, that's negative 37% in 2008. That was a global financial crisis. This occurred after an NFC victory. So I guess you got to pick and choose what you want in this market. You want to be up 37% or down 37%, Brian?
Yeah, Jared, I'll pick it up here. A lot of things to think about. More data to think about ahead of the big game. You can catch, of course, read Jared's article on our site. Coming up, we asked, you answered. We're going to reveal which team you think will be crowned the NFL champion next. Before we go to break, though, let's take a look at the average cost of a Super Bowl commercial. A 30-second slot will set a company back $6.5 million. time now to show you the weekly results of our weekly Twitter poll. And this week, natural question, who do you think is going to win the Super Bowl come Sunday? And this was an almost even split here. 50.5% of those who voted saying the Rams, 49.5% saying the Bengals. We've got just a few minutes left in our special here, but Dave, I'm going to put you on this spot. Who are you taking this on Sunday?
Initial reaction was the Rams have to win this game because their defensive line is among the best in the league and the Bengals' offensive line is among the worst. But then I dove into the numbers and it just hasn't mattered. The Titans got to him 9 times. The Chiefs have one of the best pass rushers in the league. They only sacked Joe Burrow once. I think Joe Burrow and that young, confident swagger, this is the youngest team ever to play in a Super Bowl, below 26 years on average. Bengals are not intimidated in this moment. Joe Burrow's never intimidated. Bengals win on the upset.
Josh,
you agree?
Yeah, I'm going the opposite way of Dave here. I got the Rams for some of those reasons he mentioned. I like the Rams defensive line against the Bengals offensive line. I think in a Super Bowl that might matter even a little bit more as the pressure maybe mounts on a younger Joe Burrow. We've seen him be pretty steady thus far, but I'm not so sure when it's really the Super Bowl and that moment matters as much. Can he step up again? If he can, it would be amazing, right? And I think the other thing, too, to think about is who the Rams have in the secondary. When you look at a player like Jalen Ramsey, what he might be able to do to Jamar Chase, the Bengals' top receiver, and how that might hamper Burrow. I think the Rams' defense is good. And then don't forget about Cooper Kupp and Matt Stafford on that side of the ball. Should be fun to watch. I think it'll be close for everyone gambling. It'll be close to that point spread at 4 points for sure.
For me personally, dangerous to take the under against Troy Aikman. I think Cooper Kupp deserves the MVP this year. I'm going to take the Rams on this one, also because of Jared's stats that show the home team, the NFC team, and the returning champions are all good for the market. Who's going to root against that? I got the Rams.
Brian, all of this makes me really nervous because I don't like to offer predictions in a game I actually really care about. So I've got the colors on. That
Bias.
tells you who I'm picking, right? I'm from LA. Got to pick the Rams.
LA.
All right.
Well,
We'll be
3-on-1 right there.
Yeah, surprising, but I'll see. It'll be a close game. I think that I'm not going out on a limb saying that. That does it for all of us in our hour-long Super Bowl special. Much more to come here on Yahoo Finance Live as we count down to the big game on Sunday. Keep it right here.
Kohl's faces intense pressure to sell itself as new bidders emerge. The activist investor at the center of it all is here to tell us what's next in the fight for change at the struggling retailer. Another tough quarter for Blue Apron as the meal kit pioneer struggles to post a profit. We speak with Blue Apron's CEO about her recipe to turn things around. And are you ready for some football? Super Bowl champ Joe Theismann is here to give us his pick for Sunday's big game and why fans of the Washington Commanders should embrace the new name. Hello, everyone, and TGIF. Welcome to Yahoo Finance Live. I'm Alexis Christoforous here with Karina Mitchell, and let's get a look at the market action right now because stocks just piling on the losses in the wake of that surging inflation report yesterday. And in fact, today's consumer sentiment report showed that 8 in 10 consumers now believe inflation, more than unemployment, is the most serious problem facing the nation right now. The S&P 500, by the way, on track, Karina, for its worst weekly performance in about a month.
Yep, absolutely. And Alexis, investors really trying to grapple with what the Fed is going to do when it comes to rate hikes and what it's doing with quantitative tightening. We haven't heard too much about it. Goldman is the latest to forecast 7 rate hikes this year, along with Bank of America. I just have to point out that Jamie Dimon back on January 14th said that we could see 7 rate hikes. So there's a reason why he is paid what he is paid. So looking at the major benchmarks, you've had a chance to take a look. They're all at about session lows right now. The NASDAQ is a laggard, down 144 points. Take a quick look at the various sectors. We have some winners. Energy, by far the biggest winning sector today, after a report from the IEA saying that oil markets are going to continue to be tight, and WTI right now is above $92 per barrel. Utilities also a big winner, and financials and consumer staples. Over to some of the laggards, and we will see that consumer discretionary and tech are among the biggest losers, along with real estate and consumer services as well. So some of the losers there. And then want to check on some individual stocks that have been making moves today. Under Armour coming under pressure after underperforming, and the stock is down. You can see there more than 9%. The Athletic brand reported adjusted quarterly profit of 14 cents a share, more than double what the street was looking for. It also continued to see strong demand and offset rising costs by passing along those price hikes to the consumer. However, it did say gross margins will fall in the current quarter due to freight and supply challenges. We've heard that story before. Over to Zillow, it posted an adjusted quarterly loss of 42 cents per share compared with the estimate of $1.07 loss. The real estate website operator also reported better than expected revenue. That's despite an $881 million loss on its now shuttered home flipping business that, as you know, has underperformed. That share is up now by 17%. And then want to take a quick look at fintech company Affirm, known for its well-advertised buy now, pay later options. It did tumble. It's now further sinking. It's down now by 17%. The firm accidentally released those quarterly earnings report earlier than intended, which showcases a whole different other set of problems for that company. The stock under pressure amid projections of higher transaction volume, but revenue that is light. And then just want to take a quick look, if we can go over to the bond market and see what is happening there. The 10-year yield is now at 2.2%, the 30-year yield at 2.33%. And just to point out, the 2-year yield up above 1.56%. So the curve is flattening. Alexis.
That it is. And we know that sometimes that is raising a recessionary flag. Let's talk more about the markets now. Bring in Joyce Chang, JP Morgan's chair of global research. Joyce, always good to see you. So, you know, we got that hot inflation read yesterday, and since then, Goldman Sachs now upped its estimate for rate hikes from the Fed to 7 this year alone. We know the Fed has been trying to play catch up when it comes to inflation, but what are your thoughts there? And is 7 rate hikes a little bit of overkill?
Well, we have 5 rate hikes this year, but we have 2 in the first quarter of next year. So I think a lot of these forecasts are coming in the same ballpark. And it's the rapid rise in inflation, but it's also the tighter labor markets. And it's not just the US numbers. We also saw that inflation came in a lot higher than expected in Europe as well. So when we take a look at this in aggregate across the globe, we now have about 70% of central banks, hiking rates. So it's, more of a global phenomena right now. But I think the balance sheet reduction will begin in July. It's a given that we're going to have the rate hikes, and the quantitative easing in March. And we think that you could see about, over $1 trillion a balance sheet reduction between now and the end of next year. That's equivalent to about another 25 to 50 basis points of tightening. So this cycle is beginning. And for a lot of people who've been in this industry, still have a lot of young people in this industry. I mean, it's the first hiking cycle that they're going to witness.
How true. And, I'm glad you brought up the Fed's balance sheet runoff because, the interest rate hikes sort of steal all the spotlight, but equally as important, and some people might even say more so, is this QT. My question is it adequately priced into the market right now in the way 5 rate hikes is for equity investors?
Well, we don't have the precedence for QT. Like, what is the optimal size of the balance sheet? So I think that the market is waiting for more details. They want to know how the caps are going to build up. How do you get to the maximum cap? Those are lots of the questions that we're actually fielding right now. Now, we do think that, this will build up, sort of more on an autopilot, and it will be around 1.2 trillion in reduction by the end of 2023. So I think that markets are still trying to absorb all of this, but the attention is going to remain very much on the rapid labor market tightening conditions. And we have U.S. unemployment coming down to 3.5% later this year. In the euro area, we've also moved up the ECB. We now see a hike before the end of the year, beginning in December.
So with a more hawkish, not only Federal Reserve, but really central banks, it seems globally right now, the bond market is busy reacting. We saw the yield on the 10-year already touch 2%. A lot of folks were predicting that would happen late this year. So what's your prediction for the 10-year yield for the balance of 2022?
So we're at 2.35 at the end of the year for the 10-year yield. So I still think that there is more of a further move to go, that you kind of have that the 10-year has been sort of low. And so that this is 2.35% is not that far away, but what we're seeing is that we're getting a lot more questions about the investability of bonds right now. We're seeing in our negative yield index that we've had just a massive reduction. I mean, really the amount of negative yielding debt in half. So we're getting more questions on the valuations between fixed income and equities and how we're looking at fair value as yields are rising.
I just want to switch to the geopolitical landscape for a moment, because the Biden administration has made quite clear they're discussing sanctions, export controls with Russia regarding the Russia-Ukraine conflict. How are you baking that into your predictions for stocks and bonds this year, and how might that play out in the oil markets?
Well, I think the Biden administration has made it very clear they're taking a different approach to sanction. If there is a military invasion, which is not our base case scenario, they're not going to take a gradualist approach. So if it was a 3 or 4 out of 10 back in 2014, they're talking about really going in, much more, at the top of the sanctions ladder, and with export controls on strategic sectors that would, hit critical infrastructure. Now, I think that, we see these geopolitical risks as being very asymmetric, even though it's not in our baseline, scenario. We have a forecast for oil to stay at around $90. And that is going to continue to support the energy sector, where we've had a longstanding overweight, and we have seen the outperformance since the beginning of the year. But everybody is really focused on the timeline right now. That with the Winter Olympics coming to an end, with some discussions between Russia and China, all the geopolitics. It's not just U.S., Russia, and Europe. It's also China that is being thrown into the mix on all of this as well. And so whether this is really the peak period where the risk is rising. Now, we don't have it in our baseline scenario that you're going to see a military invasion, but you could see more concerns about cybersecurity, and also that we are not seeing a breakthrough in any of these negotiations. So I think that you will continue to see more upside pressure on energy prices here.
All right. And then lastly, do you think that the sell-off that's been so aggressive here since the start of the year, is it overdone a little bit? And where are you seeing some opportunity for bargain hunters?
I think it is overdone because you have certain sectors that are pricing in a recession, and we're far from that. We're going to have a softer first quarter of the year because of Omicron, but we see a healthy rebound in the second quarter of the year for the U.S. economy to 5%. So if you look at things like small cap, that's a 20-year low. Some cyclicals as well. So I think there is value there. We're still underweight on the tech sector, but small caps in particular stand out. We also think there are opportunities outside of the U.S. So China is desynchronized from this as the rest of the world is hiking. They still have some modest easing in place, mostly on the credit side. And we do think that with the underperformance of China last year, there is room for China and emerging markets more broadly to catch up.
All right. Joyce Chang, JP Morgan's Chair of Global Research. Thanks for your insights. Have a great weekend. And a reminder to all our viewers that you can step up your investment strategy starting today with a free 14-day trial of Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek ad-light experience. You can check it all out today at yahoofinance.com/plus. Coming up, here's a treat for you. Super Bowl champ Joe Theismann is here. We're going to talk a little football ahead of Sunday's big game. Don't go away. The Cincinnati Bengals will take on the Los Angeles Rams on Super Bowl Sunday, where the Bengals hope to bring home that Lombardi trophy for the first time in franchise history. Joining me to talk all things football is Super Bowl champion quarterback and NFL MVP Joe Theismann. Joe, it's great to meet you. Welcome to Yahoo Finance.
Thank you. It's great to be with you. I've been listening to the show. I love to learn and understand equities, and it looks like things are changing a little bit in the equities markets.
Absolutely. I'm glad that you are a fan of Yahoo Finance. We want to talk a little football, Joe, because we had such thrilling playoff games. And, I personally would love to see the Bengals pull this out, but I just really want to see a good competitive game. What's your pick for Sunday?
Well, first of all, I think your wish is going to come true. I think it's going to be very competitive. And really, when you look at the playoffs that we've had over the last 2 or 3 weeks, you have to think that this game is going to be that kind of a football game. I think it's going to be a very close game. The Rams are favored by 4.5. I don't think they can win by that many. I think it'll be a much closer football game. I am picking the Rams. This is the earliest I've ever picked a team. So I am going to go with the Rams in this one. I believe that they'll win, and I think they'll win by a field goal. So if you're a Cincinnati fan, don't get mad at me, because if the Bengals win, I don't think anybody would be surprised. I know it's their first opportunity. The Rams have been here just a few years ago and didn't quite get it done. So now they're back again to have another shot at the brass ring. But I think it's going to be a terrific football game. If any, like I say, if the playoffs are any indication of what we may see in this Super Bowl, it should be a classic.
For sure. Excellent matchup for sure. I want to stick with the Super Bowl for a minute, because I don't know if you know, this year is set to become the biggest legal gambling event in football history. People are expected to wager something like $7.6 billion on the game, Joe. So if you were playing today, how would you feel about people betting on you?
I wouldn't care. I mean, you really can't worry about what people are doing or betting on you or cheering for you. It's all about the teams going out there and doing the best you can to win a championship. You've invested so much time in this year, so much pain, so much injury, so much angst to be able to get to this point. All you could really and should focus on is winning a football game. And the reason why, you use the term legal betting, because we didn't have legal betting for so long. So we should be setting records all the time. People love to bet on football. And I do believe this, as a part of technology moving forward, I think we're going to see handheld devices in the stadiums in the not too distant future, where people will be able to bet whether it's going to be a pass or a run, or whether they'll pick up the first down or not, or whether the punt will be 42 yards or 47 yards. I think all those different propositions will wind up coming into the game as we move further and further with the development of technology in the world of gaming.
Yeah, technology has changed the game so much, Joe, since you were on the field. I think you're onto something there. Of course, you won the Super Bowl in 1983 with the Washington Redskins, now the Commanders. With the history you have with the team, did they consult you at all about that name, and what are your thoughts on it?
No, they did not consult me about the name, but I am fine with it. As a matter of fact, I raised a little bit of fervor a few days before the announcement when I said that the name would be the Commanders. I called 4 different people in the organization asking them, what's the name going to be? No one would tell me. So everybody says I leaked the name. I don't know how you can leak something you don't know. So I didn't have any idea what the name was going to be. I just like the Commanders. I think it speaks well to the Washington area, as we refer to it as the DMV, the District of Columbia, Maryland, and Virginia. And to me, it speaks to the Washington itself as a seat of power when it comes to the military, which I honor tremendously. And I think this football team has a chance to create their own legacy going forward. They'll never take away the championships we won as a Washington Redskin, and we have that as our legacy. Now it's a chance for these young guys to have a new legacy going forward. And one of the key elements to this change with our name is the fact that we kept our colors. We're going to be the burgundy and gold still going forward. So I think the fans of the history of the game and the history of the Washington, quote unquote, Redskins can still hang their hat on that. Now it's the new guy's chance to be able to create a new future.
Yeah, well said, Joe. Look, you suffered one of the worst career-ending injuries in football back in 1985 against the New York Giants. Here we are decades later, and the league still grappling with player safety, including the debate over brain injuries. What more do you think the NFL could do to improve safety for players?
I think the NFL is trying to do everything they can. You look at the rules. You get penalties now for hitting somebody too hard. They try to protect areas. They want to be able to protect it, but it's a contact sport. It's a violent sport. That's what it is, especially at the professional level. And you're going to have injuries. You're going to have injuries walking across the street. The potential is there. Not that they're the same, but I think the league continues to strive to make it safer and safer. The developments in the way they use to construct helmets now, the ability to be able to do that. And part of it's a darned if you do, darned if you don't situation, because if you make the helmet safer to get hit, that means you make the safer helmet to be able to hit somebody with it. But they'll continue to emphasize the rules. They'll continue to ask the coaches to emphasize the rules. They have a lot of meetings, not only during the course of the year in training camp, stressing exactly what they believe is going to be the right kind of hits and not. It's still going to be a contact sport. And I would hate to see the integrity of the game completely annihilated because it's not touch football. It's professional tackle football. And we can continue to do the best we possibly can to be able to protect the athletes.
You know, Joe, when you see how much more QBs are protected today, do you wish you were playing now? It's a very different game than 40 years ago.
I'd still have my own teeth. Are you kidding me? No, no, so Joe, really. I think they reach a point. It's a little bit absurd. I mean, when a quarterback gets pushed to the ground, that is not roughing the quarterback. Okay, when you get your teeth knocked out, I didn't get a penalty when Byron Hunt took my teeth out. That to me would have been roughing the quarterback. But I think there are some rules that, I mean, they protect them. There's a degree I agree with, but it goes to a point sometimes where I just shake my head and say, wow, it's like they want to make it two-hand touch for the quarterback.
Right. I got you. I want to ask you, though, just sort of about the state of the NFL right now, Joe, because there have been so many controversies, plaguing the league, everything from race issues, sexual assault. There were even accusations this year about throwing games. What does this do to the NFL's image? And is Roger Goodell the right person to help the league navigate through all of that?
Well, I think there's a new set of circumstances now as we look at the league for Roger to move through. I'm not familiar with a lot of them. I really can't comment exactly on any of the things that you mentioned because I don't know enough about it to make those comments. I do know that the league will do everything it can to be able to make it right, to be able to be the diverse organization that they want to be going forward. And that hopefully the opportunities will be presented to everybody who is qualified to be able to be a head coach in the National Football League and some of the other things that need to be dealt with. But those are all things, I guess you could say, above my pay grade when it comes to the National Football League. But I believe the National Football League will be here and we get a chance to celebrate. I believe it's going to be an incredible football game on Sunday.
Hopefully you can watch it as a fan. Is it easy for you to watch as a fan? I mean, you're so close to the game. I'd have to think that's a little tough.
No, because I can't take the 23 years out of broadcasting out of me. And I bet you're the same way. When you happen to watch another channel and somebody talk about finance, you sit there and go, well, I don't know if I would have said that. Well, I'm not sure I would have said that.
You got it.
I sort of look at it as an analyst. I really, I'll listen to the announcers and I'll say, that's a great point. And the other one was, well, what did they not tell me about this situation? So you can't take the analyst out of us, I guess you could say.
And I think that's a good thing. Although I don't know, my husband might think differently watching the news with me. NFL great. Joe Theismann, it was a pleasure. Thanks so much and enjoy the weekend. Enjoy the game.
Thank you. Good to be with you.
Karina, back over to you.
Okay, and there you heard it from him, a pick for the LA Rams to win, and he did not leak the name. All right, we're going to move the goalpost a little bit. Coming up after the break, a closer look at the business of online learning. Coursera CEO joins us next. Welcome back. Online course provider Coursera reported fourth quarter earnings after the bell Thursday that came in short of analyst estimates. Yahoo Finance's Akiko Fujita joins us now with Coursera's CEO Jeff Maggioncalda for more. Akiko.
Thanks so much for that, Karina. Jeff, it's great to talk to you today. We're seeing the stock down just a bit, but let's walk through the numbers in your most recent quarter, because you did have revenue growth of nearly 40% here, but your net losses did widen in the quarter. How do you think investors should be looking at these numbers right now in the context of where the company is in its growth trajectory?
Yeah, well, first of all, thank you for having me. I love talking about the business, and more important, the reason the business exists. We're just hitting our 10-year anniversary here. So it was founded by Andrew and Daphne, two Stanford professors. And their thought was, we got to provide high quality access to education everywhere in the world. And 10 years in, we're making our way. You're right. We grew for the year, we grew revenues 41%, all organic. We posted 38% revenue growth year on year in Q4. That was up from 33% year on year revenue growth in Q3. So we saw a nice tick up. And on the spend side, we've said, since we went public last year, the way we try to pace our spend is we don't want to be super twitchy and try to go back and forth on spend based on what's happening with revenues. We try to manage our adjusted EBITDA as a percentage of revenue on an annual basis. And where we have some, upside on revenue growth, we try to invest more in growth for the following year. So we kind of pulled forward some of our expenses for next year. We're investing heavily in R&D. We're investing in our direct sales force, but it was all according to plan, the adjusted EBITDA spend in Q4.
And you've highlighted the three pillars for the company. I want to point specific one here because you saw a lot of strength on the enterprise side. Revenue, they're up about 70% year on year. Talk to me about the conversations you're having with these companies, because this push to upskill was something that existed pre-pandemic. Where do things stand right now? And what are you seeing in your pipeline that suggests where things are shifting?
Yeah, well, so the enterprise segment is growing fast. We did 72% year on year in Q4 to Q4. And that's a pretty good sized business now. It's 31% of our revenues. We have three pieces to that. There's Coursera for Business, which is the more mature one. That was the first one that we launched, serving institutions who are, employers who are trying to upskill and reskill their employees so that they can do things like data science and cloud computing, machine learning, agile business practices, et cetera. That has been a big market. The estimates are something like $365 billion is what companies spend on training. We see that going up as companies try to go faster and faster to accelerate their competitiveness by bringing in and training new skills. But there's two pieces to the segment, the enterprise segment, which is Coursera for Government and Coursera for Campus, which is for universities. We're seeing a very different landscape post-pandemic with governments and campuses. Governments are realizing that they really need to reskill their citizens to have a healthy economy and good employment rates. And frankly, universities are realizing that the world will never be the same. Not all the students are coming back to campus. There'll be much more of a hybrid mix between on campus and online. So we think that the pandemic has fairly durably shifted the appetite for online learning from governments and campuses.
This, of course, Jeff, comes at a time when we've seen a record number of Americans leave their jobs. 4.3 million people left their jobs in January, which is kind of in December, which is kind of off the high that we saw in November. But in terms of what this means for Coursera, how big of a tailwind does that provide?
It's been pretty good. There have been a lot of folks who've been wondering, and we didn't know for sure, what would the year after the pandemic look like, 2021, in our consumer segment. So this is the segment that allows individuals to come directly to Coursera.org. We saw good health. We grew 28% year on year revenue growth in the consumer segment. A lot of that is being driven by entry-level professional certificates. 2 years ago, we had 2. Today, we have 18. And these are certificates designed for people with no college degree who don't have any prior experience in a career thinking, I want to switch to a different career with more flexibility, better pay, and better long-term prospects. These are jobs in IT support, UX design, project management, social media marketing, a lot of the digital jobs. And so we're seeing a really outsized appetite for people who come to Coursera to get these professional certificates to change careers and get a better job. Also, we have something with the American Council on Education where if you get these professional certificates, you can earn credit towards a college degree. So it's a pathway to a job. It's also a pathway to greater learning opportunity with a college degree.
And really quickly, Jeff, we always like to ask you what skills are most in demand right now. When you look at the courses that are being offered, whether that's, from Google or, a university, what are you seeing right now? What's the most in demand?
A lot of people want to learn Python. Like a lot of people want to learn Python. A lot of people want to learn Java. A lot of people want to learn machine learning. And there's a certain part of that which is deep learning. This is AI. These skills are really, really valuable. There's an emerging field called ML Ops, machine learning operations, which is how do you set up your enterprise in order to be more consistently able to build and maintain your AI models. We also see a lot of interest in blockchain, distributed finance, Web3 is becoming a bigger thing. So, and this is kind of it, why I think the growth factors are so durable is that it's based on rate of change and things are just changing faster and faster. As soon as we think we got our arms around one topic, something totally new comes up, like the metaverse or Web3 or decentralized finance. And so, I think there's always something to be learning and it's just getting faster and faster.
Yeah, it's always fascinating to see that visibility from your end. Jeff Maggioncalda, Coursera CEO, good to talk to you as always. Thanks so much for joining us. Karina, I'll toss it back to you.
Okay, great interview. Thank you so much. And we've got another big interview coming up after the break. The activist taking on Kohl's. Hear what he's calling for now that there is more takeover interest in the struggling retailer. Stay with us. Welcome back to Yahoo Finance. We'll want to get you a check of the markets on some breaking news that we have just received. The U.S. believes that President Putin has decided to invade Ukraine and communicated those plans to the Russian military. That's according to 3 officials. 2 administrative officials say that they expect the invasion could come as soon as next week, echoing what Secretary of State Blinken has said previously. So we see that the markets did take a drop on those. The major benchmarks all lower at this point. All right, we are going to shift gears and now bring in our next guest. Activist investor McCallum seeks to take over Kohl's board with the nomination of 10 directors. Yahoo Finance's Brian Sozzi is joined by McCallum CEO Jonathan Duskin for more. Brian, take it away.
All right, thanks so much, Karina. Jonathan, always good to get some time with you. So you had a very interesting Thursday. Come out here in the morning, nominate 10 new directors to Kohl's ginormous 14-member board. Now, they came back a little bit after that saying what you have proposed is, quote, unjustified and counterproductive. How do you respond to that?
Not an unusual response from the company, right? I don't think very many boards would say that replacing the board members was justified, right? Of course, they're going to be defensive here. Obviously, we think it's way overdue. We ran a campaign last year. You know, we were, I think, very reasonable. We added 2 directors. We gave it some time to play out, and unfortunately, we had probably one of the worst years, for any retailer last year, for Kohl's from a top line perspective, from a stock performance perspective. And when we see the maneuvers they've made, putting in a poison pill, rejecting bona fide offers, we hear the level of interest that's out there. We really see a board that's, we think, behaving somewhat disingenuously. They seem very self-serving, very entrenched. They seem intent on protecting their jobs over creating shareholder value and exploring ways to create shareholder value. So we really do think control is warranted here. Again, we tried to work very constructively with them over the last year. We waited patiently, and unfortunately, it has not gone very well. And I think time for material change is upon us.
Isn't it supposed to be a board's job, Jonathan, to maximize shareholder value? And as someone with a lot of retail experience, such as yourself, and a lot of activist experience, what is it about this board that they could be looking away from wanting to take some pretty decent offers out there?
It's really hard to know. I don't sit in the boardroom. I think it probably stems from the idea that they might be overly optimistic about the company's plans. Remember, this is a company whose stock price has been in the same place for 2 decades. This is a company that put out a very rosy plan, a strategic agenda, the greatness agenda, they called it, in 2014, missed those objectives by a wide margin. They rolled out a plan in October of 2020 to generate material shareholder value. Obviously, that didn't come to fruition. So it's always hard to know, but from the outside looking in, it appears there's a board that, hope always springs eternal. They always think value creation is just around the corner. And I don't know that they have the right expertise on the board and the right experience on the board to really objectively analyze a plan and understand it at a detailed level enough to judge whether or not it's viable.
Well, I recognize one person on that list we're showing right now, Jonathan. That's you. You nominated yourself to join the Kohl's board. If you were to join the Kohl's board, what would be some of your first actions?
Well, I think it's really important to have a shareholder representative in the room. I've worked with a lot of great operators over the course of my career, and they bring a ton of experience and a ton of wisdom and knowledge about the industry. And I think they're really able to separate between, what are the right initiatives and the wrong initiatives and how to prioritize the initiatives. But I do think it's really important to have a shareholder perspective in the room to look at every initiative through the shareholder's lens. I think a shareholder brings a certain urgency that sometimes, even the greatest executives in the country might not share the same sense of urgency, particularly when shareholders have suffered for as long as they have. As for the first thing, I would do, I think we have to get under the hood and do one of 2 things, understand what the internal plan to create value looks like, and understand what these offers look like, and determine, what the maximum, reasonable sale process might be able to generate, and compare that to what we think we can achieve on a standalone basis. Obviously, we've pointed to the real estate value here is something we think is a suppressed asset, but unlocking the real estate value is really not great unless you're going to turn the business around, right? You want to be able to buy your stock back today with the proceeds from the sale leaseback, knowing you're going to have an improved business into the future. And so I think it's really incumbent upon myself and whoever else is in the boardroom at that time to make sure we have a plan that can generate material shareholder value. And if not, then look to see what the best possible price we can achieve in a sale through a sale process is.
You know, I mentioned before the last time we spoke to just a couple weeks ago when you put out another letter, but you know, you have considerable experience in activist investing. You know, I went back and I looked at what you did at Bed Bath & Beyond, drove a lot of change there. You know, what do you think this is your toughest activist battle yet?
I don't know. It's a tough question. You know, company that I'm the lead director of today, a company called City Trends. You know, we ran a campaign in 2017. I joined the board as one director. And it taught me that it's really hard to be, you know, a small minority in the boardroom and make a difference. And, you know, I think perhaps that's what happened to the directors we added last year. You know, there are 2 directors of 14. It's really hard to effectuate change when you have such a large and cumbersome, unwieldy board. So is it the toughest? You know, I don't know. In City Trends, we came back and ran another campaign and ultimately replaced the majority of the directors and, you know, went on to generate tremendous shareholder value. In Kohl's, you know, it's difficult. We've tried to engage constructively with them. That obviously hasn't worked. They told us under no uncertain terms would they consider adding a shareholder representative or adding any new director to the board at the beginning of the year. And we were somewhat shocked by that, considering the performance, and disappointed. You know, I think the facts speak for themselves. So maybe in one regard, it's not a difficult campaign. I think all shareholders or a lot of shareholders are seeing the facts and the numbers the way we're seeing it and are going to demand change. And I think everybody's curious to see what a real robust sale process might be able to yield in terms of price. You know, they rejected these offers they got, and they used the plural of offers, so we know it's more than one. And obviously Leonard Green was rumored or reported to be interested as well earlier this week. And you know, they rejected these offers in 2 weeks. It's really hard to think that they ran a robust process. It's hard to think that they gave the interested parties information that might inform their bids, that might be able to get them to raise their bids. It's hard to imagine they were able to get access to management and really do a deep dive here and see if they could offer more for the company. So you know, we'll wait and see how this develops, but we were obviously disappointed by that.
Been fascinating to watch this one play out. Always appreciate you hopping on with us to talk about it. McKellum Capital Management CEO Jonathan Duskin. Have a great weekend. Enjoy the big game. Karina, back to you.
Okay, thanks a lot, guys. Over to you, Alexis. What's coming up?
Coming up, we've got Blue Apron. Their shares extending yesterday's sharp sell-off on the heels of weak earnings. How close is the meal kit company to turning a profit? We'll ask the CEO next.
Welcome back to Yahoo Finance. Some more breaking news to tell you about now. Pfizer reportedly postponing application to the FDA to expand its use of that COVID vaccine for kids 5 years and under. For more on this, let's bring in Yahoo Finance's Anjali Khemlani. Anjali, what do you know?
That's right, Karina. So the company announced just now that it is pulling its application, a rolling application to the FDA, which was set to hear through its advisory committee the data for kids 5 and under. So that's 6 months through 4 years. And what that entailed was really a buildup after December, when the company found that in the age group of 2 to 4 years, that 2 doses of the 3 micrograms of its vaccine was not sufficient enough, and they were going to be testing a 3rd dose 2 months after that. Now, that data is not expected until April, which is when the company believes that it will have sufficient data to supply. This really throws some concern on what outside experts have all been saying, which is that the unusual request right now by the FDA, if you recall, Pfizer did submit this at the request of the FDA in order to get the submission rolling. And when we spoke to CDC Director Dr. Rochelle Walensky earlier this week, she explained that the reason being that they were looking at it more as the way the adult booster situation happened, where 2 doses would be given first, and it would give them a sufficient amount of time to then study the data and then administer those 3rd doses in kids. But as it stands right now, Pfizer is saying that they want to submit it all at once, and so it's likely we'll have an update for you on whether or not the advisory committee meeting set for next week is still going to take place. Back to you.
Okay, Yahoo Finance's Anjali Khemlani, thank you so much for that update. And Pfizer stock is flat on that news. We want to take a look at the broader markets to see what the major indices are doing. They are still at or around session lows. Dow is off by 486 points, S&P down by 79 points, the NASDAQ lower by 333 points. And want to take a check of the oil market as well and tell you that crude oil prices, WTI, now above $93 at $94.13 there, and Brent also up at 94.71. All right, and we will turn things over now to Alexis. Okay, we take a quick break and we will come back on the other side of that with an interview with Blue Apron. Stay with us.
It's been a tough couple of days for Blue Apron. The stock is lower one day after suffering its biggest sell-off in about a year and a half after the meal kit pioneer reported a wider loss and a drop in revenue. Joining me now, Blue Apron CEO Linda Findley. Linda, good to see you again. I dug in a little bit more. I saw orders decline 4.7% and customers were down about 4% last quarter. What drove those results, and are you seeing some signs of improvement this quarter?
Yeah, so what actually happened was pretty intentional. We guided to a slight reduction in 2021 because of the fact that we were able to close this funding in November at the end of last year, where we said we were actually turning our investment to 2022 and starting to build out more of the long-term marketing infrastructure for customer growth. And in the first 5 weeks, we're seeing early signs of success with that, with more than 10% growth in registrations and reactivations of our customer base above last year, which was a pretty big quarter lap. But we expected a certain amount of transition in Q4 because of the fact that we were lapping a pre-COVID or a during COVID time before. And so what we were looking at was on the 2-year stack, as we come out of the pandemic, how did we do? And so we grew significantly in revenue over a 2-year stack as we're leaning into this investment going into Q1 and 2022 and beyond.
Want to ask, though, about food inflation, because we found out yesterday in the CPI that food prices overall are up about 7.5% over the past year. And I saw that average revenue per customer grew by nearly 2% last quarter. Was that really a symptom of you needing to raise prices? What was behind that?
Well, actually, we've had 7 consecutive quarters of higher revenue per customer, average order value, and orders per customer. And that was really driven by product innovation. A big part of the strategy was before, when we couldn't quite lean into as much marketing, we leaned heavily into product innovation to create value per customer and started wanting to increase retention and engagement of each of those customers by increasing that value. So we're pretty proud of the fact that we hit a higher AOV number, even with some additional promotions that we started to launch going into 2022, and continuing to just aggressively think about laying the right foundation for long-term sustainable growth. So it's less about food inflation, which actually we have a decent amount of insulation in our business model about how we manage food inflation, and less about price increases. We did increase our prices, but most of what you're seeing is actually based on the value-added products that we've been putting in to further engage customers as we now layer customer growth on top of it.
Mm-hmm. So look, early in the pandemic, you and I talked when Blue Apron turned that surprise profit, its first as a publicly traded company. And since then, the company has struggled to repeat that performance. Are you putting any kind of a timetable on return to profitability?
So we haven't put it a specific timetable, but we are very committed to a path to profitability. And we've said that in every quarter, every time we've been talking about our investment levels. We now have the opportunity to drive significant investment because of the funding that we raised at the end of the year into layering customer growth on top of these really great customer engagement metrics that we've been putting up for 7 quarters in a row. With that growth in the top line, then we'll be able to continue to scale into that level of profitability. So what we've said is very intentionally, this year is going to be a year of investment, but a year of smart investment. And we're going to make sure that we're really focusing on growing that customer number, which has been less of a focus the last few years, on top of that strong value. And we will continue to update the markets as we look towards guiding towards when we turn to profitability, but it's definitely still a priority for us.
You mentioned that $78 million capital raise back in November. I know a good chunk of that money is going to go towards your big push moving forward into marketing. I know your background, heavy marketing coming from Etsy and Alibaba. Why is that the right place to focus money and attention as opposed to other areas in the business, as opposed to other ways of acquiring customers?
Well, first of all, we're actually fairly lucky because of some of the previous building of the company. We have a great, robust operations structure that allows us to scale with very little capital investment there. So that is actually ripe for this expansion, and it's been great in helping us handle this complexity as we introduce new products. But we are going to be investing some in technology as well, because both marketing technology and the site in general has a lot of opportunity to expand and increase our accessibility to partners and other places for growing our customer base. But marketing is where we can put our most efficient dollars going forward because of the fact that we built this great product that has these engagement levels. This is the right time to lean into, again, efficient marketing spend, which we know how to do, on top of that great product that we've been evolving to scale marketing going forward. So, we've been lucky that we have a lot of infrastructure that already works for us. And now this is really the time to say go on marketing.
Linda, what would you say, though, to some shareholders who are concerned, about the viability of the company going forward? I mean, is a strategic merger or even a buyout by a larger food-related company something that you and the board would consider?
Well, I think it's really important to think, first of all, about that profitability question, and also about the comment you made earlier about when we hit profitability in 2020. It was great to hit profitability. That's fantastic. There was a lot happening in the pandemic at that particular time. But a big part of what we're focused on right now is leaning into growth that's sustainable and long-term for the long-term vision of the company. And what we've seen even in Q4, we've put additional investment in Q4 and in Q1. Yes, it creates a cash burn, and we are guiding to a cash burn, but that is not actually an ongoing cash burn. You can't take some of the metrics from Q4 and say this is what it's going to look like going forward. There's actually going to be several quarters where we have seasonal levels of cash burn that are significantly lower. So it all blends into a right level of investment for growing the company. As for thinking beyond that, it's really about how do we bring the most value to shareholders? And we're going to make sure that we're always paying attention to what in the market is going to do the best for us and for our shareholders and continue to grow the business.
All right, Linda Findley, CEO over at Blue Apron. Always good to see you. Thanks for stopping by. Karina?
All right, thanks a lot. We've got much more market action coming ahead, especially after stocks slip on news of increased tension between Russia and the Ukraine. We'll follow that story and give you more details on the other side of the break. Stay with us. Markets sliding to session lows on a report that the U.S. believes Russia will invade Ukraine and that Pfizer is delaying its vaccine application for kids under 5. A closer look at the market moves straight ahead. Freight and shipping issues have roiled businesses over recent months, and the latest wave of transport stoppages tied to a state of emergency and blockade of a key bridge from Canada into Detroit is fueling the fire, an expert weighs in. And our Jared Blickery speaks to a 29-year-old phenom, an influencer, an investor, real estate broker that owns a cool $20 million each in real estate, assets, and stocks. Want to be like him? We'll tell you how to do it. All right, welcome back. I'm Karina Mitchell along with Alexis Christoforous. We have just about 2 hours left to the end of trade today, and markets deep in the red over news that there are increased tensions between Ukraine and Russia. We want to get more on that, so let's go straight to our Yahoo Finance's Jared Blickery for more. Jared, oil is surging on that news. Things are getting tense.
That's right. And energy is about the only thing catching a bid right now because of crude oil. And of course, OPEC Plus relies on Russia as a swing producer, along with the rest of the world. Let's go straight to the Wi-Fi Interactive, where we can plot the day's intraday price action. It's been very severe here. We've seen a lot of volatility this year, but once a key level in the S&P 500 went, we saw a pretty quick decline there. And you can really see that on these candlesticks. Let me just show you what's actually happened over the last 10 days, because the markets have been in kind of a holding pattern here. And you can see breaking this support, which is roughly in this box right here, just extending those declines. And if you take a look at a 2-month chart, we really don't have much support until 4,400. That's kind of a key decision area. But now that we've broken this area in here, it looks like we want to test these lows. So we'll have to see what comes of this. Also want to chart what's going on in the bond market. On the very short end of the curve, we've seen those yields plunge by about 10 basis points. That's the 2 and the 3 year. You take a look at what's happening in the 5 year, that's down 7 basis points. So reversing that huge run up we saw yesterday on those inflation prints. So what is the market saying right now as the yield curve flattens a bit more, or excuse me, expands a bit more? Well, it's going in the wrong direction. We have those shorter term rates going down, and maybe the Fed won't act as quickly. You would think that might provide a bid in the market, but right now there is a lot of chaos and confusion. Want to get to crude oil because, as I said, that is the only thing basically catching a bid right now. Well, that and gold, I should add, and you can see that is at a new high water mark for the last, 7-8 years. You'd have to go back to late 2014 to see a price this high, $93 with WTI, $100, very short while away, or excuse me, not that far away here. You can see gold punching up. I want to take a longer term view. This is a 1-year chart of gold. We are right back up to the November highs. And given the sideways price action, you might think, well, is it going to test this this level that we have up here by the 2000 mark? Very, very possible if this continues. I should add that when we have these geopolitical tensions, you usually do see a knee-jerk reaction in the stock market to the downside. However, they tend to be short-lived. Geopolitical concerns alone typically don't drive stock market action over the long term, but with the Fed tightening rates, with everything that's happening right now in an election year, not to mention we have the Olympics going on right now. Is Putin going to invade the Ukraine while the Olympics are going on in Beijing? What does that do to U.S.-Sino relations? Just lots of questions here. Let me take a look. We can see tech is down. That is the biggest laggard here. That's down over 2.5%. So is consumer discretionary. So is communication services here. Now, these are the sectors that house the growth stocks. We can see Apple's down 2%, but Amazon really taking it on the chin, down 3%. Tesla down 4%. Nvidia's down 6%. So really seeing a lot of the growth names getting hit, even though we're seeing that decline in yields. I've said it before, when we see bond market volatility, a lot of times that just leads to a spillover in equities, whether bond yields are going up or down. Market's really not liking this situation, at least for right now. Do want to reiterate, this tends to be short-lived, but there's an incredibly complex backdrop that we really have to consider here.
Absolutely. And we know how much the market dislikes uncertainty, and we've got plenty of it. Want to switch gears and get a check of Pfizer right now because we know it's delaying its vaccine application for kids under 5. How is that impacting the stock, if at all?
Yeah, let me just go through some of the news first. The FDA is postponing a meeting on the Pfizer vaccine for children under 5 years old. Now, this is because this is the advisory committee meeting, and this is after Pfizer said that new data has emerged regarding its EUA, that's its emergency use authorization request for the COVID-19 vaccine, and that's in children 6 months through 4 years. And that came in an emailed statement from the FDA, reading from a Bloomberg report right now. The meeting was originally scheduled for February 15th. The delay has been to give the FDA time to consider added data. And in a separate statement, Pfizer and BioNTech announced plans to extend their rolling submission to amend their EUA of their COVID-19 vaccine for children 6 months through 4 years of age. And those companies expect to have 3-dose protection data available in early April. Let me see if I can find our pharmaceutical heat map, and I have it right here on the Wi-Fi Interactive, and we can see a lot of dark red here, or a lot of red here, not a lot of dark red. But looking for Pfizer, let's see, there we go. Stock down about 0.5%. We did take a little bit of a leg down on the news, but really considering everything else that's going on, healthcare being a defensive sector, really not too much of a reaction here. Guys?
Okay, Jared Lickery, thank you so much for that report. I want to switch gears now. Freight and shipping issues have roiled businesses in recent months, and the latest controversy between Canadian truckers protesting at the border isn't making matters any easier. And now Ottawa has declared a state of emergency over a key blockaded U.S. bridge leading into Detroit. I want to bring in our next guest to help us discuss this and break things down. Aaron Terrazas, Convoy Director of Economic Research. Aaron, thanks so much for being here. Just want you to weigh in on, this latest move between the U.S. and Canada. They're such strategic shipping partners. They really need each other. And, the bridge being blocked right into Detroit, which obviously is a key distribution point for automakers. So exacerbating chip supply issues, in an industry that is already reeling.
No, that's absolutely right. This blockage definitely comes at an inopportune time. The auto industry was just beginning to ramp back up production from the chip shortages. You look at auto production, there was just getting back to pre-chip shortage levels. This is obviously going to disrupt that. You think of all the spillovers to the rest of the economy. Auto industry and the auto supply chain is about 3 to 5% of truck movements nationwide. Anytime you block that corridor, that's going to have a spillover effect. And I think this is just yet another example of the shocks that the trucking industry and the freight industry have been grappling with over the past couple of months. Usually this time of year is a seasonal lull, but between the winter storms, both on the West Coast and the eastern half of the country in January, and then the Omicron surge, it just hasn't been able to catch a breather.
And Aaron, I want to switch gears now and talk about the logjam and backups, out in the West on the ports there. And typically there's a slowdown during the Lunar New Year. So I'm wondering if that has helped alleviate any sort of gross backlogs that you've seen. According to the Marine Exchange of Southern California, they say there were 78 ships in the queue on February 9th compared to 109 1 month earlier. So are things easing? Is the worst over?
I think all the data suggests that the situation, particularly in the port of Los Angeles and Long Beach, is improving. You start to see that the number of ships arriving is trending downward. I think the number of new ships coming into berth this week was about 17. That's in line with 2019, 2018 averages. That's a totally manageable level of imports. That said, the number of containers moving through the port is still very high. If you look at some of the delays on the inland side, once those containers are getting off the ships, you are starting to see improvement there. A year ago this time, the amount of time that a trucker was waiting to load a container and load kind of to move on inland was about 90 to 95 minutes. Right now, it's about 80 to 85 minutes. So, 10 to 15 minute improvement, reduction in wait time for those truckers loading their vans at the Port of LA.
And then shipping is quite seasonal. So when do we have this slack period, and when do you see freight and port issues normalizing a little bit more?
Yeah, so in a normal year, you start to see freight volumes pick up again in spring and March and April as produce season gets underway. We're already in an early produce season coming out of Florida. We're in a La Nina year. A lot of California is in drought, and produce season does tend to start earlier in drought years, just because you have a sunnier, kind of warmer climate in January and February for things like lettuce coming out of the Imperial Valley. So, we're already starting to see the initial inklings of produce season, and that's basically going to drive the freight market through June and July into August.
And then what do you see as the next big risk on the horizon? Because I know labor negotiations are ongoing with the PMA. So what are the sticking points there? And then what are businesses and, shippers doing to be proactive about that?
I think that's absolutely true. Anyone in supply chain right now is trying to look around the corner to see what risks might be on the horizon. And I think in March, we're going to see a little bit of a catch up from the Lunar New Year delays, and also shippers and manufacturers and retailers trying to get ahead of potential labor action at the ports later this year in April and March. Those contract negotiations are up for renegotiation in late spring. And so I think everyone's going to try to get ahead of that curve, even if it does not materialize. Beyond that, I think there are a lot of improvements that we're seeing. The industry has certainly learned from the pandemic, and I think some of the changes and learnings from the pandemic are going to be enduring. Just one detail is there has been a dramatic growth in drop and hook volume. That's basically disconnecting the front of the truck, the tractor, from the trailer. So the trucker doesn't have to wait while the trailer gets loaded, unloaded, saves the trucker as much as 3 to 4 hours in wait time. Every 1% of volume nationwide that shifts to like a drop and hook model is about adding 10,000 drivers, the equivalent of adding 10,000 drivers to the system nationwide. That can make a big dent in all the driver shortages that the industry has been talking about.
And then, Aaron, I want to ask you really quickly, rising inflation hasn't stopped imports. We saw that in our record deficit last year. When do you think that growth starts to slow? Particularly, China growth is slowing, and now there's this big wave of Omicron there that may have an impact. So do you think that we see slowing growth into the second half of this year, let's say?
The baseline expectation among economists is certainly that growth starts to slow. It's hard to imagine a third consecutive year of record consumer spending in the economy. Obviously, there's not going to be that same degree of fiscal or monetary support. So there's obviously downside risks on the consumer side. That said, there's probably upside risk on the industrial side, a lot of supply chains ramping back up. And keep in mind that, with diverging monetary policy and central bank policies between the United States and China, we could start to see, even more tailwinds to imports as the Chinese currency becomes, a little bit less strong, and kind of capital flows towards the United States kind of keep the dollar relatively strong. So that could actually propel volumes through these ports moving forward.
Okay, we will leave it there. Thank you so much for your perspective, Aaron Terezis, Convoy Director of Economic Research. Alexis, over to you.
All right, thanks, Karina. The wind coming out of the sales for buy now, pay later favorite Affirm. Coming up, a closer look at the payment space with Jeffrey Sloan, the CEO of Global Payments. Welcome back, everybody. Inflation, not the only thing on investors' minds today as they turn their focus to geopolitical concerns. Stocks sharply lower, but off their worst levels of the day. There is concern and reason to believe that Russian President Vladimir Putin may take action against Ukraine. And we're seeing that play out in both the equity and commodities markets. Right now, the Dow is off 318 points. But interesting to note, there are a handful of Dow components in the green, and Chevron is the biggest winner. In fact, Chevron is right now at an intraday high as the oil markets now respond to this fluid news that could be coming between Russia and Ukraine. There you see Chevron up better than 2%. And want to get you a quick check of the oil market, because we keep seeing crude oil sort of wanting to make this march closer to $100 a barrel. Today, up 3.5%, now atop $93 a barrel. We're going to get much more on oil for you a little later on with Ines Ferre. But first, want to turn to Global Payments, because that company announced yesterday its best quarterly and yearly performance in the company's history. It expects another record year in 2022. Joining us now is Global Payments CEO, Jeff Sloan. Jeff, always good to see you, and thanks for being back. Certainly impressive growth last year. I know you made some big commitments in restaurants and healthcare. Just tell us briefly what drove those results.
Well, Alexis, thanks for having me again. So I think we were on a path toward accelerated digitization pre-pandemic. And to be honest, the last number of years have further accelerated the trajectory we're already on. So let me give you a couple examples. So in 2021, we facilitated something like 300 million omni-channel orders through quick service restaurants, meaning you can order a hamburger from your phone and get paid with your face or your thumb, and actually get it delivered to where you live or where you work. That's up substantially, up 50% year over year. We did the same thing with telemedicine, 2.5 million teledoc visits last year, up from really de minimis prior to the pandemic. So we really are the beneficiaries of innovation in the ecosystem, and the disruption that's come with COVID-19 has really accelerated many of the underlying trends toward electronic payments.
And then what are you doing as far as acquisitions and B2B business strategy as well?
We're really excited about our positioning there. We announced an acquisition of Mineral Tree, which is a accounts payable cloud SaaS business, in September of 21 at our investor conference. That integration, as we reported on yesterday, is going very well. We think at over $600 million of annual revenue, we already have one of the largest B2B businesses around the world. And we're getting a lot of market share and traction, doing it in a way that's very profitable, which is very much distinctive to us. So super pleased about where we are in B2B, and I think provides avenues for growth for really the next 5 to 10 years in our business.
Jeff, during the pandemic especially, we saw the buy now, pay later trend really gain momentum. And I'm just wondering how much of that you're seeing at Global Payments, and also what is the fastest growing segment of your business right now?
It's a great question, Alexis. So we announced yesterday that we facilitated over 2 billion buy now, pay later transactions at Global Payments just last year, just in 21. That's up probably 50% year over year, $31 billion of volume and 50 million virtual cards. So I think we're right in the nexus of buy now, pay later. The difference with us is we do it in a responsible, regulated way where we're not taking any credit risk. So that's really up to the financial institutions and the neobanks and the fintechs that really provide that service. Where we're seeing the most demand for that, Alexis, is really online. Our e-commerce business that we described yesterday was up 20% year over year and 20% up in the fourth quarter. That trend has continued, as we said yesterday, into January. So that's where we're seeing that. You don't see a lot at the physical point of sale for the pure reason that people don't want to wait in line and worry about whether it gets approved. It's much easier to do that online, but that's one of our biggest businesses, about 30% of the company, and is growing, as I said, very rapidly.
And then I want to go back to your business for a second. And, you are considering a sale of NetSpend, again, prepaid debit card. Why is now the right time to consider doing that?
So it's very much along the lines of what we described in our B2B focus. So that business has two halves. B2B, we're actually going to retain, and that's about 130 million of revenue in that business. The remainder of NetSpend is really business to consumer. That's a business that we inherited through our merger with TSYS in 2019. We're really not a direct to consumer business. We're very much a business to business kind of company. And as a result, we think the time is right for us to invest further in B2B, and that's why we're taking a look at our business at NetSpend.
Of course, at the core of all this, Jeff, is keeping these transactions safe and secure. How much are you investing in Do you have proprietary IP that sort of helps you do that and differentiates you from other B2B payments companies?
Well, Alexis, we're a technology company at our core. We'll spend this year between CapEx and OpEx something like $1.7 billion in our technology footprint. We spend upwards of 9 figures a year just on security alone. So it's a very big business for us. We have exclusive and unique partnerships with AWS in our issuing business and Google Cloud in our merchant business to ensure that we're at the very forefront of cloud-based technologies. We announced a new partnership yesterday with MasterCard to allow you to post payments, check your transactions, make sure they're all your own online on a real-time basis through the AWS cloud. That project is exclusive with us with MasterCard through the end of this year. So we think we're really on the forefront of evolution of technology investing in payments.
Well, certainly a great report and some nice guidance as well. Jeff Sloan, CEO of Global Payments, always good to see you. Karina, back over to you.
Okay, thanks. Coming up, a divide over cryptocurrency. Circle, stablecoin issuer, is taking aim at central bank digital currency in a new campaign. Details ahead. Welcome back to Yahoo Finance. I want to get you a market check right now. The Dow is off by 300 points over fears that Russia could soon take military action. The White House warning that Russia could invade Ukraine during the Olympics and urging Americans to leave Ukraine if they are there. And Jake Sullivan, National Security Advisor, saying that an invasion could come any day now. I want to take a look at the oil market as well to see how that is reacting, because oil prices have surged on that news. See there that WTI is now above $93 and Brent is above $94. All right, we will shift gears now and bring in our Yahoo Finance's Jen Schonberger. Stablecoin issuer Circle launched an ad campaign promoting stablecoins over a central bank digital currency. That is China's CBDC is on full display at the Beijing Winter Olympics. It also comes after a White House meeting this week tied to stablecoin regulation. And Jen, you spoke with Circle CEO Jeremy Allaire about all of this, correct?
Hey, good afternoon, Karina. That's right. Stablecoin issuer Circle out with a brand new ad campaign saying, quote, central bank digital currencies carry the specter of privacy erosion, making cyber threats and technology upgrades a taxpayer burden rather than the motive of free market drive and well-regulated competition. At the same time, this week, Treasury Undersecretary Nellie Lang testified before the House Financial Services Committee, saying that a central bank digital currency could determine how stablecoins coexist, and said that depending on how the Fed designs one, assuming they proceed with one, it could actually supplant stablecoins. I put that question in an exclusive interview to Circle CEO Jeremy Allaire. I asked him whether a CBDC poses a threat to private stablecoins. We also talked about the digital currency space race. Take a listen.
I was very appreciative of Undersecretary Liang's testimony. I think she is doing an excellent job of thinking through for the U.S. federal government and obviously shepherding a lot of other parties around this. What's the right approach to supervising and establishing a framework to regulate firms like Circle? And I think we have obviously come forward and are in the process of looking to become a national digital currency bank. And we believe, of course, that dollar digital currencies that are operating at internet scale that work to improve both not just payments but overall kind of financial and economic system improvements. It's a huge opportunity for the United States. And I think what's interesting to see is we're starting to see policymakers, including the Undersecretary, emphasize that this is here to stay. This is growing, and I think there's an acknowledgement that there's a here and now, and that's very apparent to a lot of people. And then there's some theoretical things, like theoretically there might be, a government project in the future. And I think across the board, I think increasingly people, including in her testimony, in the Undersecretary's testimony, is very clear that these innovations are going to coexist.
You mentioned earlier in the interview that you have applied for a bank charter. And during the hearing this week, in fact, Treasury Undersecretary Lang was asked whether the OCC should approve a bank charter for Circle. Curious how that application process is going now and what you're hearing from regulators. And has the FDIC given you any assurance that you would receive deposit insurance and become FDIC insured?
So what I can share is that we are in a process, and it is going to take it's a long process. And I think, we actually have not formally submitted our application at this point in time, but it is something we're in the pre-application phase, and there's a lot.
What's holding you back, Jeremy?
We've got a lot going on, which is one just general the physics of everything that we're doing. I think. I think the second is I think the government, the federal government, I think is coming up to speed on stablecoins, blockchains, digital assets, the sprint, as I know you were referring to before, and I think are just trying to understand, okay, where's this going to fit in terms of the kind of charters that might apply. And there's open questions, and this was also in, I believe, some of the Undersecretary's testimony about, this isn't necessarily about FDIC insurance for a fractional reserve bank, but is it possible that there is some insurance framework that's more specific to the risks of the reserves and liquidity of a stablecoin? So there's things to work out, and that will take time, and it'll be, I hope, collaborative. As I think that both the U.S. government and private sector try and figure out how to do this right.
The Olympics are underway now in Beijing. And of course, China is testing its digital yuan, its digital wallet. At the same time, as we've been talking about, the US Federal Reserve is looking at the pros and cons of issuing a central bank digital currency. Where do you see the US right now in the digital currency space race? And how do private stablecoins fit in there?
I mean, our view is firm, which is that the US is winning the digital currency space race. Today, the preeminent digital currency on the internet is the dollar. Just looking at USDC alone, there are hundreds of different digital wallets that support this in hundreds of countries around the world. Exchanges all around the world support convertibility of this. It supported $2.4 trillion in transactions on the internet last year, and is really growing. And there are robust and growing ecosystems around it. And so, I think if you look at a vision for what we want, which is open, accessible, interoperable, a standard and technology that people can innovate on top of without permission, that's the kind of dollar I think we want to win in this space race and on the internet, as opposed to something that is tightly controlled, government administered, and the like, which is what China's initiatives really represent. And so I think the US is winning. I think the question is, can the US really get some energy behind this and ensure that this kind of market competitive open model, which has been, I think, how the West has approached the internet over the past multiple decades, can they approach that in the convergence of the internet and the financial system?
That was a great interview, Jennifer. All right, Jennifer Schonberger, thank you so much for that informative interview. We will leave that there. Alexis, I'll throw it over to you.
All right, coming up on the other side of the break, we're going to take a deeper dive into oil. It is rallying today as the market seems to believe Russia is moving closer to invading Ukraine. We're going to speak with an oil analyst about what that means for all of us and gas prices right after this. Markets selling off on reports the U.S. believes Russia will invade Ukraine any day now. That news also driving oil prices higher. Yahoo Finance's Ines Ferre here now with a closer look at the energy market. Where do things stand right now, Ines?
Yeah, Alexis, and we saw WTI settling at $93.10 a barrel, absolutely spiking after some commentary from Jake Sullivan, National Security Advisor. You also had the U.S. Secretary of State saying basically that a conflict could begin any time now. Jake Sullivan saying that a conflict could begin next week during the Olympics, that the U.S. has seen new forces arriving at the Ukrainian border. The U.K. also urging its citizens to leave the Ukraine while commercial flights are available. So certainly that deteriorating situation in the Ukraine is what drove these prices higher, quite a bit higher, with Brent crude up more than 3%. WTI had gone up more than 4% at one point, a 7-year high. Brent crude touched $95 a barrel for the first time since 2014. And earlier this week, we had seen a pause in oil prices. You had Iran that's moving closer to reviving its nuclear deal that would lift sanctions on exports. And you had some producers, though, from OPEC Plus that haven't been able to meet supply targets. So we have seen prices rallying over the last 7 weeks, past 7 weeks that had been in rally mode. You did see a pause earlier this week, but today quite a bit of a leg up higher because of those tensions between Russia and the Ukraine.
All right, and Ines, I know you were speaking to an analyst last week, and we've been talking about oil hitting 100, but then now with all of this, if there is an invasion, could that potentially be exacerbated? How high could oil go?
Yeah, we spoke to Troy Vincent from DTN, a senior market analyst, and he said that if there is a hot war, you could expect to see prices go up by anywhere between 10 and 15%. And as far as $100 a barrel of oil, he said, look, it's not inevitable, but it's certainly very easy to get there. But if there's a hot war, expect to see prices go higher.
All right, we want to stick with oil now. Thanks so much, Ines Ferre. And National Security Advisor Jake Sullivan speaking at the White House briefing just moments ago, issuing this warning for all Americans now in Ukraine.
We are continuing to reduce the size of our embassy footprint in Kyiv. And I now want to take a moment to echo what both President Biden and Secretary Blinken have already said. We encourage all American citizens who remain in Ukraine to depart immediately. We want to be crystal clear on this point. Any American in Ukraine should leave as soon as possible, and in any event in the next 24 to 48 hours. We obviously cannot predict the future. We don't know exactly what is going to happen, but the risk is now high enough, and the threat is now immediate enough, that this is what prudence demands.
And we are seeing the markets react swiftly. Oil prices spiking, so are energy stocks. In fact, Chevron hitting an intraday record high today. I want to bring in our guest now. This is oil analyst Pavel Molchanov at Raymond James. Pavel, thanks so much for being with us. Some on the street are now calling for crude oil to easily hit $120 a barrel if Russia does indeed take military action against Ukraine. What are your thoughts?
Russia is one of 3 countries in the world, the others are Saudi Arabia and the United States, that each provide 10% of the world's oil. And of that oil that Russia produces, about half goes into the European market via pipeline. By definition, those pipelines in the event of war would be at direct risk. Not only physical damage from bombing, either accidentally or deliberately, but purely for safety reasons, they would not be able to operate even if neither side is trying to target them. However, the even more significant effect on energy would be natural gas, and specifically natural gas in Europe. 3/4 of Russia's gas goes into the European market. So countries like Germany, the Czech Republic, Bulgaria, Romania, Hungary, all of them are highly reliant on Russian gas. Those pipelines would be either shut down or, in the worst case scenario, outright damaged in the event of an all-out military confrontation.
The IEA already reported today that global demand is expected to hit a record 100.6 million barrels per day this year. So how does this exacerbate that? What sort of pressure does it put oil under in that case?
Well, if prices were to spike in the event of war into the triple digits, that would actually pressure demand, because we know from what happened, for example, in 2008, 2014, that when prices experience pretty dramatic escalation, demand is negatively affected. But of course, the counter to that is supply would drop even more sharply. So prices, would not stay in the triple digits forever. Let's be clear. But in the run-up to a war, and certainly during the war, yes, I think $120 a barrel is not at all out of the realm of possibility.
What would that do to prices at the pump? Because we already see they're at a 7-year high. I was checking AAA. National average for gas hit $3.47 on Wednesday. That was up just 7 cents in the past week alone. If crude were to get to 120, and we know crude makes up such a large part of gasoline, what could that, would we be looking at an average of $4 a gallon in the U.S.?
Yeah, so $20, an extra $20 per barrel corresponds to approximately 50 cents per gallon, all else being equal. Now, that's a lot, particularly when it's happening in an abrupt time frame, right? Not over a multi-year or multi-month period, but as a matter of days or weeks. So in that event, it would be very unpleasant for an economy that is already experiencing high inflation. But I would emphasize that the impact of high oil prices would actually not be as severe in the United States as in those countries that are particularly dependent on imports. So think about Japan, India, Germany, France, that have no domestic oil production whatsoever. They are completely reliant on imports. Their economy would be even more adversely affected by a spike in oil to $120.
And that is why our President Biden, has been speaking to European leaders ahead of any possible invasion. He has been speaking to them about how he could offer support and what can be done to help protect those European economies. So what exactly can be done? And if gas prices, people here, Americans are already complaining that they're high. If they do spike higher, does that mean that we will, release reserves from our reserve system here?
In the 1970s, after the Arab oil embargo, all of the industrialized countries signed what's called the International Energy Treaty, which includes an emergency stockpile sharing program to be used, I emphasize, in the event of emergency, which war with Russia would undoubtedly be. The last time this was utilized was actually to help the United States after Hurricane Katrina in the middle of the 2000s. And so it stands to reason that if and when pipelines from Russia were to be shut down and there would be a physical shortage of oil supply in the European market, other members of the IEA, the US included, Japan, Korea, Australia, would be called upon to support their European partners with emergency stockpile sharing. This would not prevent oil prices from spiking, but it would prevent outright fuel shortages. In other words, rationing, at the pump, the way many of us remember from the 70s.
Wow. All right. Lots to keep our eye on. Pavel Molchanov over at Raymond James. Appreciate your time today. All right. We are following all of the market moves today. There are plenty of them. We are near the lows of the session right now in the equity markets. In addition to oil spiking, we are, of course, seeing a spike in the so-called fear index, the VIX, higher as well. More on the markets for you right after this. Welcome back, everybody. A tough one on Wall Street to end the week. Stocks now at their or near their lowest levels of the session, as there is concern that Russia might pull up the heat on Ukraine and actually take military action any day now. We're seeing the reaction over in equities, commodities, oil in particular reacting as well. Jared Blickery here now with more on the market action and a very special guest. Jared?
That's right. We do have a special guest, Kevin Paffrath, a financial analyst, also a YouTuber whose name is Meet Kevin. And Kevin, really excited to have you here. Watched a few of your videos. We got to begin with the breaking news. We saw the market kind of tank here on news of a Ukrainian invasion by Russia. We've seen this lead up, but also markets really might have expected something like this to happen in a couple of weeks when the Olympics are done, just kind of ratcheting up the tension. Markets still kind of reeling after trying to digest yesterday's hot CPI inflation print. So I'm just wondering, how are you putting all this together?
Yeah, absolutely. Look, the Ukraine issue is just fuel to the fire of what's really happening to our markets. So right now, you've got two choices. One, you think that the Federal Reserve is going to guide us into a soft landing. They're not playing the violin on the Titanic. Don't worry, everything's going to be fine. In that case, buy the dip on this Ukraine fear. It's more fear, and those are opportunities to buy. However, if you think the Fed is not going to lead us to a soft landing, that they're not going to be able to handle the wage price spiral that has just started, decoupling from supply chain inflation, well, then maybe this is just more fuel to the fire of our economy heading into a recession. And 2022 might be one of those years to just sit out.
Well, and let me just follow up on, you had something interesting that I was watching in one of your videos, and you're arguing consumer spending could get a significant boost from the child tax credits, which are set to be released in bulk to certain participants or recipients this year. Outline your reasoning, because I find this absolutely fascinating.
Yeah, absolutely. So usually on our tax returns, we can get a $2,000 per child tax credit. And that was increased to between $3,000 and $3,600, depending on the age of the child. Half of that money has already been distributed via the monthly payments that started between September and ended in December. The other $1,500 to $1,800 are still coming. They come as a refundable tax credit when folks file their taxes. Now, since higher income families probably are paying more in taxes when tax time comes up, they're probably not going to see much of a benefit from this extra $1,500 to $1,800 per child. But here's where it matters. Higher income families are the ones spending like crazy right now anyway. We're actually seeing income or spending rather by income fall for those making less than $60,000 per year. Those are the folks who are most likely to get this large boost from this $1,500 to $1,800 refundable tax credit. Even individuals who pay very little in taxes will be able to get this since it's a refundable tax credit. That means we're really creating in March and April an opportunity for folks, especially lower income folks, to get a stimulus check. That's the largest stimulus check that they've ever gotten. So while we're worried about inflation, we still have the Federal Reserve printing $30 to $40 billion a month digitally, of course, and we have this $1,500 to $1,800 per child stimulus check coming, which again, largest check that we've ever had.
That's pretty interesting there. And I just want to follow up on the Fed now because as you said, the Fed is still buying bonds, but they're going to hike rates in March. We don't know exactly how much, most likely 50 basis points right now. But also, quantitative tightening is on the horizon. They said they might begin that a few months after. My point here is the monetary transmission pipeline here can take 18 months, and all of this from the wind down in the bond buying to the raising of rates to QT is happening in a very short period of time. So I'm just wondering how you see the potential effect of QT if it's enacted sometime this year.
Yeah, well, I agree with you regarding your 18-month time frame. I think interest rates are going to have a little bit of a quicker effect on the market. But here's the thing. All you have to do is look at the balance of reverse repos, all of the extra cash that we have in our system. We've got over $1.5 trillion of extra cash floating around. And if we tighten to the tune of $90 billion per month, like you said, it's going to take certainly over a year to actually have a meaningful impact in a reduction of all this extra cash that's there. So I don't believe the tightening is going to be doing much for us. The bump in interest rates, ironically, in the short term, could potentially actually increase inflation. That's because we've got a lot of extra cash on household balance sheets and corporate balance sheets, but variable lines of credit, warehouse lines of credits become more expensive. So cost of goods sold goes up. And we know that businesses, at least based on this last earnings season, have all stated they have pricing power and they're raising their prices because they want to stay ahead of the inflation that's no longer transitory. So raising rates, while it's expected, is probably going to do little to quell inflation. If anything, could hurt margins for businesses, which could potentially lead to more inflation. What we really need to see is a reduction in demand. And that, I believe, is what the Federal Reserve is trying to do verbally. Like we know that Bullard came out yesterday. He's the biggest hawk at the Fed. What the Fed is doing is they're weaponizing him to prepare markets that, hey, maybe everyone should spend a little less because we're going through a tightening cycle. And they're hoping to reduce that aggregate demand because it's way too high right now and it's propelling the wage price spiral.
And real quick here, we just have less than a minute. What's your outlook for 2022, putting all these complex factors together?
Yeah, well, I believe we have a 60% chance that we're going to go into a recession. That's because I don't believe we're going to beat the GDP comps of last year. So we'll have a technical recession, 2 quarters of negative GDP. If that occurs at the same time as inflation is still high, we are going to have a freak out in financial markets because individuals are going to look at Jerome Powell and say, hey, come bail us out. Please bail us out. And he'll say, no, sorry, I have to keep tightening. So what should people do? In my opinion, you buy when the Federal Reserve U-turns. What I mean by that is they go accommodative or they stimulate again. That's the best time to buy. Really quickly, if you did that in the past and you bought when the Fed U-turned, you would have bought March 23rd, 2020, the bottom, December of 18, the Powell U-turn bottom, February of 2009, the bottom of the recession, Q1 of 03, the bottom of the dot-com bubble, and October of 1987, which was the bottom of the 87 crash. If you just buy when the Fed U-turns, you tend to do well. Wait for that time.
Kevin Paffrath, really interesting stuff here, financial analyst and YouTuber. Meet Kevin. Great to speak with you here.
All right, thanks a lot, guys. I think you were alluding to a little stagflation there, Kevin. Jared Blickery, thanks so much. We're back in a moment with more of this market sell-off.
Okay, welcome back to Yahoo Finance on this Breaking News Friday. We started the session worried about inflation and consumer sentiment hitting a low not seen since 2011, and then stocks taking a hit, now at session lows with the VIX higher and oil spiking on a possible military escalation and aggression between Ukraine and Russia. And want to take a check of gold and silver because it is surging after a hit. After all of this, so taking a quick look there, also higher. We're going to have much more on all of this after the break. Stay with our colleagues as they take you to the closing bell. But for Alexis Christoforous and myself, thank you so much for joining us. Stick around.
Stocks are on track to close out a volatile week in the red as tensions between Russia and Ukraine escalate and inflation concerns raise the specter of an even more hawkish Fed. And markets aren't the only ones taking note of inflation. Consumers are getting jittery about rising prices as consumer sentiment falls to the lowest level in a decade. We'll break down all of this and more with ClearBridge Investments' Jeff Schulze. Plus, big bets are rolling in ahead of this year's Super Bowl with legal sports betting now up and running in nearly 36 states. We'll speak with Bank of America analyst Sean Kelly about how the biggest players in the online betting industry are faring heading into the big game. And it's not just the Super Bowl airing on Sunday. The new series Bel-Air makes its streaming debut this weekend as a reimagined take on the Fresh Prince of Bel-Air. We'll have a chat with the cast of the reboot in a bit. It's Friday. We have an hour to go in today's trading day and week. I'm Emily McCormick.
And I'm Brad Smith. Good to be here with you, Emily. Let's get right into it as the major averages, they are negative here, and they have moved lower here acceleratingly on the back half of today's session. And this, of course, on the geopolitical tensions that we continue to see move forward as U.S. has reason to believe, the United States has reason to believe that Russia will invade Ukraine. The markets are certainly digesting this right now. And moving to the downside, you're seeing the Dow Jones Industrial Average lower now by more than 400 points. The S&P 500, you're also also seeing that down on the day by about 77 points, as you're seeing there on your screen, 1.7% in the red. And also the NASDAQ composite, you're seeing that down by more than 2.5%, 365 points in negative territory. And so let's bring in Yahoo Finance's own Jared Blickley, who is standing by with even more on this market activity going into 58 minutes left in today's trading session, Jared.
That's right. And let's get straight to the Wi-Fi Interactive, where we see the downslide continuing. Just took another small leg lower. Dow Jones off 400 points. And let us get straight to the charts. You can see we began the day slightly positive. It seemed like it was going to be a quiet Friday. Not so. The chances of Russia invading Ukraine have gone up dramatically and surprisingly here, especially since it's during the Olympic Games. How does that affect relations with China? Here's the NASDAQ off even more. It's down 2.5%. S&P 500. Let's see if we can get that 1.7%. And the NASDAQ 100, the biggest laggard here, it hit minus 3% on that dip down to those levels. Also want to take a quick look at the VIX. It is up significantly to 30, although not as high as it's been recently. Let me give a 3-month view here. We saw this spike to, I think it was just short of 40 a few weeks ago. That was late January when we had that steep sell-off, but surging right back up there. And then the bond market has been giving a lot of headaches to equities, at least recently, surging yesterday because of that huge 7.5% inflation print on CPI, and then another reversal today. And we know that when bonds get moving, so do equities, but usually to the downside when there's a shock. Doesn't matter which direction. 10-year T-note yield, that is down 7 basis points, and the 30-year down 4 basis points. Just want to show you a couple markets that are surging on this news. One is WTI, given Russia's energy independence and necessity as an exporter in the world, and also RBOB gasoline futures. Those are up as well. And then gold taking a big leg higher, taking out this January resistance. And let me just put up a 1-year chart, and you can see hasn't quite taken out the November highs, but probably going to gun for the 2000 level if we take that out. Now let's take a look at the sector action. Energy, not surprisingly, getting a big spike. In fact, that could be considered a defensive sector right now. That's up over 2%. Utilities in the green, but that's kind of a defensive mood as well. And then you see staples just about break even. So kind of a very, very defensive structure to the market. And then the biggest laggards are those sectors that house the mega caps. XLK is tech, XLY is consumer discretionary with Amazon, XLC is Alphabet, Facebook, Netflix, Verizon, et cetera. So let's check out the NASDAQ 100, and we can see Tesla down 4.5%, NVIDIA down 6%, and we're starting to see a little bit more dark red than we were even an hour ago. So we're going to continue this discussion into the close and definitely beyond, guys.
All right, Yahoo Finance's Jared Blickley, thank you so much for that breakdown. Let's bring in our next guest of the hour for more on the markets. Jeff Schulze is investment strategist at ClearBridge Investments. Jeff, thanks for joining us this Friday afternoon. I want to first start off with the acceleration to the downside we're seeing across stocks this afternoon. This latest drop coming amid news that the U.S. officials think Russia could take military action inside Ukraine as soon as next week. How big of an equity market threat is the current situation with Russia and Ukraine right now?
Well, if Russia does invade the Ukraine, it's certainly not the bottom of the market. You're going to see a continuation of this sell-off over the next couple of weeks. Certainly going to see the leadership that's persisting today with energy leading, and then more defensive leadership underneath the surface with some strength coming out of utilities and staples. But ultimately, I think that this is just a momentary sell-off for the market, at least from this vantage point. But what I think is interesting from this particular sell-off today is this is the sell-off that you have been seeing since the post-GFC era, where 10-year treasuries go down, you see defensive leadership, and that is not the environment that we've seen over the course of this correction since the beginning of the year, with 10-year treasuries rising, cyclicals outperforming defensives, and energy's at the top of the leadership board on both of these sell-offs. But this could be a period of maybe a greater risk-off environment if that does come to fruition. But again, there's a lot to be told on that story over the next couple of weeks.
Yeah, certainly, Jeff, and particularly what we had seen with some of the other sell-offs over the course of early in 2022 thus far. There had been an entry point that many investors were charting for themselves to get in at some of the discounted price. Do you imagine that will be a similar story here now, or is there something different at play?
I'm not sure that we're through the sell-off quite yet. Usually during midterm election years, you have a greater correction than the other 3 years of the presidential cycle with an average drawdown or correction of 19%. We got to 9.8% in January, and out of the last 21 midterm elections, 17 of those years actually saw a greater correction. So I don't think we're necessarily through this sell-off. I think we are going to have a lot of volatility as we work through the next couple of quarters. And the biggest driver of ultimately where the market bottoms, in my opinion, is how much more hawkishness is going to be priced into the markets. Back in September of 2021, there was a half a rate hike total price for this year. And so right now we have about 6.5 rate hikes priced. So you've seen 150 basis points priced in a short period of time. And I think this is really the primary driver of why the market's having indigestion at this moment. And it's not clear whether or not we're done with pricing in hikes for this year.
I also, sticking with the geopolitical topic and the tensions therein, do want to bring up a headline crossing from Reuters, which is that the Biden administration has made a decision to send 3,000 additional troops from the 8-2 Airborne to Poland in the coming days. I'm wondering, how headline sensitive do you think the market is right now to headlines like these and developments on the Russia-Ukraine front?
Very sensitive. Obviously, investors are shell-shocked from a very aggressive January and February. So I think people are selling first and asking questions later. So if this does continue to escalate, I do see some more near-term downness in the markets and some more selling pressure as we move through the next couple of weeks. But let's not forget, at this point in a market cycle, usually in the third year, you usually see multiple compression. You usually still see real rates rise, and multiples are around 20 times forward PEs. History would suggest that we still have a little bit of steam to come out of this balloon from a multiple perspective. So I think markets are pretty sensitive right now. And if this does escalate, there's probably some better buying opportunity as we make our way through the next couple of weeks.
As of right now, escalation looks like, from what we've heard, at least from the White House, sanctions. It also looks like even more of the talks among countries, especially allies, and particularly what should we expect in the market reaction in that instance as well?
Well, you're going to have a disproportionate effect over in Europe and the UK because they are quite reliant on the energy supplies that are coming from Russia. If you do see a cutting off of those supplies, that could throw those two economies into a recession. Obviously is going to have some implications for global growth, which I think will disproportionately affect the S&P 500 versus your Russell 2000 companies, which are a little bit more insulated, a little bit more geared towards U.S. growth. And if you look at leadership today, S&P 500 is down more than the Russell 2000. So if that does come to fruition, I think you want to be more heavily weighted towards small caps. I think you still want to have that energy overweight, but you also want to have that defensive tilt to utilities and staples, which is exactly the leadership that you're seeing today.
All right, we'll leave it there for now. Jeff Schulze is investment strategist at ClearBridge Investments, and we thank you again so much for your insight. Coming up, more than 30 U.S. states now have a live legal sports betting market. We'll chat the outlook heading into the Super Bowl on the other side of this break.
Welcome back, everyone. We're keeping close tabs on the major averages going into the market close here today. We've got about 48 minutes left in today's session and in the week's trading activity. And taking a look at the Dow, it is now lower by about 1.3%. We'll round that off to 448 points down, as we've also seen the S&P 500 move lower by about 80 points in aggregate over the course of the day, by about 1.8% right now. Also sitting lower, the NASDAQ composite down by about 2.6%, 373 points in the red. And this is all over accelerating concerns around Russia invading Ukraine. We're continuing to keep tabs on what the White House has to say, as they have had a press briefing this afternoon. And then additionally, you're taking a look on your screen right now at the Treasury notes, particularly moving lower. And as of right now, it looked like the 10-year was sitting at about 1.94%. There you're also taking a look at Brent crude and WTI crude prices, which have both spiked on the day higher. Brent crude touching $94 and actually at one point today touching above $95, and WTI crude also had touched above $94 during today's activity. We'll keep a close tab on all of this as we get closer to the end of today's trading session. Well, switching gears here, as Emily teased before the break, where the money reside, and where are people placing their bets for the Super Bowl. With 21 states that have legalized mobile betting options in some capacity, Sunday is anticipated to bring in peak volume across mobile sportsbooks. Here's what the CEO of FanDuel, Amy Howe, had to say ahead of Sunday.
Listen, this Super Bowl is going to be the single biggest sports betting event in history. So that just gives you a sense of the magnitude of what we're coming into. On our platform at FanDuel, we're expecting upwards of 7 million bets.
And joining us now, we have Sean Kelly, who is the Bank of America Merrill Lynch Managing Director and Senior Research Analyst. Sean, the significance here of 7 million anticipated bets for FanDuel and how that shows up, particularly from your perspective, in shareholder value for the gambling stocks.
Yeah, look, this event is really a breakout for the broader sports betting industry, and I think it's one that most of these companies will look at as an opportunity to really have their brands seen globally as this event will gather. So this is really a customer acquisition place, a place that these major sportsbook operators can see their brands getting noticed and getting out there in an attempt to get customers onto their platforms and a chance for them to learn and market to those customers going forward. So this event is really all about customer acquisition, getting their brands out there and getting known to a much broader audience. And again, and I think as you alluded to, this is going to be a record audience that has access to sports betting for the first time in a legalized fashion in many states, with over 36% of the U.S. population now having access to this in some form or another.
Now, Brad was mentioning that more than $7 billion expected in bets for the Super Bowl this year. But I'm wondering how much of that is actually going to trickle down to these companies' bottom lines or even their revenue figures, because we know that these companies have been rolling out just enormous promotional activity, like you mentioned, to try to make this a customer acquisition event. So how much in terms of the lucrativeness of this event are the companies actually going to be seeing?
Yeah, there's two numbers you need to be aware of in sports betting. The first one is the difference between wagers, which is the amount bet, and revenue, which is the amount that the casinos or the sports books hold or keep. And usually the number that they hold or keep is a single-digit percentage, anywhere between 5 and 7% of that broader wager number. So you're going to hear some very big numbers thrown around, especially this weekend, about how much is actually wagered. But remember, only a small fraction of that actually is generating revenue for the sports books. The rest is returned to customers. Beyond that, then you have to factor in their marketing costs and margins after that. And I think it's pretty safe to say that if you want to think about profitability of an event like this, it's still going to be a ways off. These companies right now are very much in a customer acquisition mode. They're very much in a marketing mode to get their brands and awareness out there. And they're very much looking out to future opportunities to scale their platforms to return those investments down the line. So you're not going to see much in terms of profitability. As a matter of fact, it's highly likely that these companies will incur material losses coming out of these types of very promotional environments. But it's all part of the plan. Realistically, these companies are there trying to get customers, knowing that there will be a payback to that acquisition down the road. And we think they do have a much longer term strategy in mind, even though they will likely post a serious amount of losses in the near term in order to actually in order to actually compete in the landscape right now.
And given the year-over-year growth in licensing and legalization for states as well, it seems that those marketing spends, to your point, they're going to continue to add up over these coming years as more states bring mobile betting online. For how long do you surmise that investors will be comfortable with seeing some of those high marketing costs continuing to eat into the profitability of these companies? And to what extent will they be able to kind of stomach some of those losses?
Yeah, I mean, this has really been, I think, the tale of this industry over the last 12 to 18 months, right? We saw the initial euphoria around growth and the opportunity, the total addressable market being sort of the buzzword that I think we've used for many high growth areas in the stock market. And then, of course, the reality sets in over, significant investment period and, a lot of upfront losses that might be incurred to succeed in a vertical that's going to be as competitive as one like sports betting. The answer to your question directly is, it's going to be several years until we see these platforms on the, like for the broad industry, widely actually achieve profitability. I think, we're circling 2024 as the year where the industry for a full year probably turns the corner to break even profitability is the way we would measure it. And we're going to see some operators that'll have months in 2023, and some of the first operators, the ones that are leaner, possibly even months in 2022, where they turn, break even or profitable for a period of time. But it's still a ways out, and we do think that patience will be required both on the part of investors and, frankly, on the part of the companies themselves to sort of reinvest in their longer term vision, their longer term strategy. Fortunately, they generally have the balance sheets or the backing and the cash necessary to support these broader marketing programs. So again, we do think there's a plan in place, but realistically, those who are looking for near-term turns and profitability, I think, are likely to be disappointed.
So from an investment standpoint, do you think a pure play sports betting platform like a DraftKings has more long-term upside and could outperform relative to a bigger, more diversified casino player like a Caesars Entertainment? Or how are you thinking about this longer-term opportunity?
Yeah, I mean, it will ultimately come down to the definition of longer term. There's no question in my mind that there is more growth attached to the pure play of online, of the online future here. You'd be hard pressed to name any consumer vertical that the internet has not disrupted, and gaming has been a bit safe because the truth is, due to regulatory barriers, it is not seeing the same type of competition that we've seen in other brick and mortar consumer spaces. But that's clearly changing now. So I think the pattern is set, and we know that the growth side is going to accrue to online. I think from our own recommendation and balancing standpoint at the moment, we felt more comfortable with the self-funding, more omni-channel approaches that the Caesars and Penn Nationals bring to the table, full well knowing that we were going to go through this euphoric high of a focus on growth, but then this realistic, I think environment that we're in right now, where profitability and some of the losses necessary to build these platforms, become much more of an investor focus. So we've been, I think, more focused on this kind of middle ground. But again, if you're looking for growth, I think the answer is very clear that these pure play platforms have a lot to offer. If you are trying to be more balanced as it relates to profitability, I think you want to look at more of these omni-channel players that have other business verticals that today are very much able to support these online investments going forward.
It'll be interesting to see which of these players have the most App Store downloads, perhaps at the end of this weekend as well in those rankings. Sean Kelly, Bank of America Merrill Lynch Managing Director and Senior Research Analyst, joining us here today. Appreciate the time and the insights, Sean. And coming up, everyone, Pfizer retracts its request to the FDA to approve a COVID vaccine for children 5 and under. The details on what went into the decision for the biotech company after the break.
Stocks are still in sell-off mode as U.S. officials warn Russia may be poised to invade Ukraine as soon as next week. That news coming amid ongoing concerns over soaring inflation and the potential of a more hawkish Fed. And as we can see, the three major stock indexes solidly in the red this afternoon with about 35 minutes left of today's trading day. The Dow Jones Industrial Average now down more than 500 points, or about 1.5%. The S&P 500 down nearly 2%, and the Nasdaq Composite down about 2.9%. Now, diving a bit deeper into the S&P 500 by sector action, we are seeing the tech-heavy information technology, consumer discretionary, and communication services sectors the laggards during this afternoon session, whereas on the flip side, energy and utilities, the only two sectors in positive territory. Utilities only in slightly positive territory as we head into the closing bell. Then taking a look at the bond market, we are seeing the benchmark 10-year yield reversing course, now down at about 1.9%. It had broken above 2% for the first time since 2019 just yesterday. So really seeing a bit of a reversal here amid some of this risk off move that we're seeing across the major equity averages. And then finally, also want to get a check of the energy markets as we continue to see West Texas Intermediate crude oil prices spiking amid tensions in Russia and Ukraine. But switching gears now, Pfizer and BioNTech announced today that they are delaying their request for the FDA to authorize their COVID-19 vaccine for children under age 5 as the companies wait to continue their clinical study and receive efficacy data on a third dose of the shot for children. Pfizer said in its statement earlier, quote, given that the study is advancing at a rapid pace, the companies will wait for the 3-dose data as Pfizer and BioNTech continue to believe it may provide a higher level of protection in this age group. Dr. Oni Blackstock, Health Justice founder and executive director, joins us now for this and more on the virus, as well as Yahoo Finance's own health reporter, Anjali Kemlani. Dr. Blackstock, thank you so much for your time this afternoon. With this announcement from Pfizer, on one hand, yes, we may get the 2-dose vaccine as well as this booster now authorized out of the Fed or out of the FDA all in one swoop. But at the same time, this is a blow for parents who had been awaiting the first 2 doses for their younger children. What do you make of this latest announcement and how this may impact the response that we're seeing to the pandemic?
Well, thank you, Emily, for having me on. And, I agree. I think there will be many parents out there, parents of children under 5, who will be very disappointed at this news. If it had gone through and it had been authorized, the rollout was scheduled for late February. Now we're looking at potentially early spring if the third dose shows itself to be effective. My sense and my understanding is that regulators in the FDA were concerned with just the data from the 2-dose regimen, the lack of efficacy in creating strong protection, a strong immune response in those children aged 2 to less than 5 years old. And so they felt more comfortable and confident in doing an evaluation of the data with that third dose. So I think in many ways, parents should feel, assured and more comfortable and confident once we have that third dose data and based on whatever the FDA decides. However, it definitely is a blow, I think, to many parents who will have to wait a few months longer. And again, those under 5 are the only group for whom there is not a vaccine that's currently authorized.
Dr. Blackstock, Anjali here. I want to dig into that just a little bit further because I know, everything around the submission has been basically a saga, starting from the FDA requesting Pfizer to submit for the 2 doses. We heard from FDA's Dr. Peter Marks earlier saying that the Omicron surge kind of spurred this request for submission. And now that that's subsided, it seems like they're willing to wait just a little bit longer for those 3 doses. And based on the timeline, like you mentioned, if it had started in late February, that 2 months window for that third dose would have been cutting it real close if data was supposed to come in by April. How do you think that this plays out in terms of just ongoing focus on how the Biden administration is handling this pandemic? Does this add to the confusion and frustration, or is this a good move?
Yeah, no, I think it's such a great question. There's been, lots of conflicting messages that have been given to the public. And I think, unfortunately, this is, one additional message that may find many parents and the general public confused. So I think it will be important for the FDA to message in a way that's very clear, really stating that they can be more confident about whether to make this recommendation if they have a full picture of the data. And the unfortunate part is that, Pfizer unfortunately chose, they had to select a dose for these clinical trials. And unfortunately, the dose they chose was on the lower side and unable to produce a strong immune response in those aged 2 to less than 5. However, hopefully with this third dose, they will see a strong immune response among all children less than 5 and be able to, the FDA can then make their recommendation and we can have this group that's been ineligible finally protected.
What's the time span that we would expect them to resubmit under and to put some more of that data forward?
Yeah, I believe my understanding is that the results should be available in April, in 2 months. And then that data would be immediately submitted to the FDA for its advisory group to review. And if they approved it, then it would move on to the CDC. So it's probably April, May that we will probably see a decision made on this vaccine.
Just in time for summer break. I want to ask you about the mask mandates and dropping of those, as well as what we're seeing in Europe with dropping of testing requirements, especially for vaccinated. It seems like there is a shift in attention in how policies are being created. CDC also weighing the idea of, putting in certain guidelines based on vaccination status. Where we stand right now, even with kids about 20% vaccinated, adults sort of stagnant there. Do you see any hope that maybe any of these policies could help come another surge, or do we still need to focus largely on vaccinations?
Right. Yeah. So, I think we've largely had a vaccine-centric, vaccine-focused approach here to responding to the pandemic in the United States. And then this confusion around the effectiveness of masking, and the sort of politicization of it has added to this. And then we're seeing many, states with Democratic governors rescinding mask mandates. So it gives a really confusing message at the same time that we're encouraging Americans to, who haven't been vaccinated, to get vaccinated, to get boosted. We're also sort of doing away with these other protections that we know, when layered with vaccination, can be highly effective. So I think it's an incredibly confusing message. And now it's going to be up to really individuals to weigh the risks and benefits, to understand what the level of transmission is in their community and decide whether they're going to wear a mask or not. It is encouraging that there are some states that have still continued to have mask mandates for schools. Although transmission tends to be lower in schools, we know that it still does happen, and children can take those infections home to their parents, to other caregivers. So there are lots of ripple effects in terms of transmission within schools. So, I think we'll see what happens over the next few months, but we're seeing, in the United States and across Europe, even in countries that still are at the peak of their Delta waves, or Omicron waves, we still see them lifting many restrictions that have been proven to be effective in lowering community transmission of the virus.
Dr. Oni Blackstock, Health Justice founder and executive director, and Yahoo Finance's own Anjali Kamlani. Thank you both again for your time this afternoon. Coming up, U.S. crude oil prices spiked to a fresh 7-year high, jumping further above $90 per barrel as tensions between Russia and Ukraine escalate further. We'll bring you the latest with Rebecca Babin, CIBC Private Wealth Senior Energy Trader, next. Stick with us.
25 minutes until the market close, everyone, and take a look at the major averages, all lower. And this is on news that there is U.S. intelligence that suggests that Russia is closer to invading Ukraine. We're continuing to track that, as well as any updates coming out of the White House. We do know that Reuters has reported that there have been an additional 3,000 troops that are also going to be sent from the 82nd Airborne to Poland in the coming days. That administered by the Biden administration, or authorized rather. And so as we are continuing to track the major averages, you're seeing them lower across the board. The Dow down 1.4%, S&P 1.9% in the red, and the NASDAQ composite down by 2.8%. And so with the major averages in decline, we're also tracking oil prices, and those are higher here. And we're going to get into the correlation here. But Brent crude oil, that at one point hit above $95. We've moved just a little bit off of that, but still up by 3.7%. WTI crude up 4%. Right now, that crossed above $94 a barrel. And so for more on this, we have Rebecca Babin, who is the CIBC Private Wealth Senior Energy Trader. Rebecca, good to have you here with us today. Russia's place as one of the top two producers of both oil and gas, certainly in focus. How high could oil prices spike to, in your estimation, amid the international tensions?
Yeah, so I think that's a big conversation that the market is trying to sift through right now. Ultimately, it depends on whether crude oil production is impacted by this invasion. And the reason why that's a question is because it would require the US to use sanctions against Russia that would inhibit their crude oil exports. Now, to be clear, they would still have buyers available to them like China, even if the US and Europe sanctions them. So it all comes down to how much of their supply is actually impacted by an invasion, and that's not entirely clear. There are estimates that are saying crude could go to $120 a barrel if we get an invasion. I think that's overestimating it because, again, it becomes down to how we respond to this invasion, and it'll likely come in the form of sanctions. The first place the US is going to sanction is Nord Stream 2, which is a gas pipeline, not necessarily a crude pipeline. Bottom line is it's still up for grabs right now, and what we're seeing is a reaction to this fear that this is coming, and there are estimates it could go to 120. I say we top out at probably just around 100, because I do think that there will not be as strict of sanctions as the market fears, because ultimately that hurts the US and our allies as almost as much as it hurts Russia.
If production were to be impacted by an invasion, could supply increases elsewhere offset the disruption to energy markets and put a ceiling on prices? What other levers are there that could be pulled?
Yeah, that's another one the market's been grappling with, and it's a really good question. So unfortunately, markets are really tight right now, and there's not a lot of spare capacity around to fill in this gap. There are basically two major players that could fill in. We've got Saudi Arabia and we've got the UAE, and then we have US shale. US shale is going to be on a lag. You can take it out of the equation for the next 2 to 3 months. It's probably not going to come up that fast. So you're really looking at Saudi Arabia and the UAE, who have the ability to do this. However, they have been unwilling to break out of the OPEC plus agreement that they established over a year ago and unilaterally increase supplies to fill this gap. Why? Because in 2014, we had a situation in Crimea that caused crude oil to go over $100 a barrel. They brought back supply and crude cratered in a very quick fashion. So I think history is their lesson. They say, you know what, we're not going to do that. We've seen this movie before. And frankly, if you're going to continue to negotiate with Iran, one of our arch enemies who is attacking us in drone attacks through the Houthis, we don't really see the need for us to step up and cap prices. I do think there is a diplomatic way for that to come to fruition, and Biden is starting to go down that route. But those are the two places where you'd have to see supply come from in the near term.
What type of timing would revolve around that and that decision that the administration would have to move through, as you laid out a moment ago?
Great question. I think it's probably weeks, not days. I'd say it's probably closer to a month, as opposed to, getting it done very quickly. These things just are not they're a lot easier to talk about than they are to do. And you have to be able to deliver, and you have to be able to engage on the diplomatic level. And as we've seen with Iran negotiations, as we've seen with Vladimir Putin, diplomatic conversations don't evolve quickly. They evolve very gradually. I do think in this case we could press it and maybe do a month, but I don't see it as being inside of that timeline.
The path of least resistance right now for oil does seem to be to the upside between these fresh geopolitical concerns and inflation and elevated demand. Are there any credible downside catalysts that you see for oil and energy markets in the near term?
Yeah, so I think in the near term, the path of least resistance is higher. And the bearish indicators are going to come from waning demand due to a tightening cycle in the US, and that hurts growth. It's going to come from the fact that shale is going to be increasing production, and it's obviously not going to happen overnight, but it'll continue to happen, and it'll come in the form of Iranian negotiations. So I think those are the three pillars of the bearish story. But again, they're not near term, and they're not super tangible at the moment when we're bombarded with headlines day over day about all the bullish signals. So I think the market is kind of just it's climbing that wall of worry as we get more of these headlines and we see more supply disruptions. However, I do think that bear story becomes much more prevalent in the second half of the year.
When you think about the industries that would be most readily impacted by these rising prices, what sectors particularly, I mean, when we think about how they have to make sure that they have enough fuel for their operations or enough oil for their operations, what are those sectors that would see the deepest amount of impact as a result of the prices sitting where they are right now?
It's typically the chemicals, the chemical companies that experiences the first hits. When crude oil is exceptionally high, or our power prices are exceptionally high, and they'll shut in and choose not to produce, as opposed to taking on these costs. And then it does filter through down every sector, but it'll go into food supply. It'll go into various other sectors, all the way down to consumer-based products, that we don't even suspect have crude oil in them will start to get implicated, but it'll start with chemicals.
Rebecca Babin, CIBC Private Wealth Senior Energy Trader. We appreciate the conversation, and thanks so much for adding the context and analysis around this as well. Well, another significant impact as a result of the Russian invasion of Ukraine that the U.S. is monitoring right now to see if that moves forward is the semiconductor industry. Now, Yahoo Finance's Rochelle Akufo has the context and the analysis. Rochelle.
That's right, Brad. A fast-moving story here. We've seen that U.S. officials warning that this Russian attack could begin any day now, potentially affecting the Olympics. You have NATO chief Jens Stoltenberg also warning Friday of the real risk for a new armed conflict in Europe. As the potential for this conflict escalates, we're seeing the three major indices have been taking a hit today, as we've been following. The White House warning now that chip makers need to diversify their supply chains as the U.S. braces for potential retaliation from Russian sanctions. That's if Ukraine is invaded. So why the concern for chip makers then? Well, market research group TechEd says the industry is heavily reliant on materials critical to chip making in Russia and Ukraine. Now, they found that over 90% of US semiconductor-grade neon supplies come from Ukraine. Now, over 90%, as I mentioned there, neon is a key material that's used for the lasers that actually make the chips, and that's a byproduct of Russian steel manufacturing. Also, 35% of palladium is sourced from Russia. Palladium is used in sensors and memory, as well as storing energy in broadcasting equipment, mobile telephones, computers, and other uses. Now, William Moss, who's a spokesperson for Intel Corp, said the chip maker was not anticipating any impact on their neon supply. But this development comes as the biggest semiconductor companies have mostly been trending downwards year to date, and with a lot of volatility due to pandemic-related supply disruptions and, of course, rising consumer demand.
And Rochelle, against this backdrop, where does this leave the chip manufacturers going forward?
Well, all is not lost. Semiconductors can still be manufactured, but it's the cost of the materials going into the chips that are going to be the problem. That's what's going to rise. Now, Applied Materials, the largest equipment supplier to the semiconductor industry, projects that between 2020 and 2025, the value of semiconductor content will jump 50% per automobile to about $690, and it will double for an average data center server to $5,600. TechEd also estimates that demand for all chip materials will rise by more than 37% over the next 4 years. Now, obviously, consumers, they want their smart goods, they want their interconnected Internet of Things for their cars, for their gadgets. So those extra costs, we'll have to see if they get passed on to consumers. And of course, fears of a Russian-Ukraine conflict when we already have COVID-related supply chain bottlenecks and inflation concerns only adding to the pressure. Guys?
Michelle Akufo, Yahoo Finance's Zone. Thanks so much for digging into that and the story there. And everyone, coming up, we're going to have much more. You're taking a look at the Dow as we go to a quick break, down right now by about 1.5%. We'll round that off too. We'll see you on the other side.
Welcome back. We're continuing to watch the market action as we see the three major stock indexes continuing their selling action heading into the closing bell. We're about 12 minutes until that point here during this afternoon session. But taking a look at the moves in the markets, the Dow Jones Industrial Average down by more than 450 points, or about 1.3%. We are off session lows, but still down sharply during today's session. The S&P 500 down about 1.7%, and the NASDAQ Composite down 2.6%. Now, taking a look at the sector action within the S&P 500, still seeing those tech-heavy sectors deeply in negative territory. Consumer discretionary, information technology, and communication services are the laggards on the day. Whereas on the flip side, we continue to see energy stocks leading to the upside, up about 2.8%, that sector specifically, and utilities also holding on to modest gains during today's session. Then taking a look at the bond market, still seeing U.S. Treasury yields moving lower across the curve, particularly on the long end of the yield curve. That benchmark 10-year yield is down by about 9 basis points, yielding just above 1.9% during today's session. It had broken above the 2% mark for the first time since 2019 just yesterday. Then finally, as we continue to track energy markets, we're still seeing crude oil prices moving to the upside as well. The U.S. West Texas Intermediate up further above $90 per barrel and reaching its highest level since 2014. Now, Now, I want to also zoom in on two stocks in particular that I'm keeping an eye on this afternoon, and I'll kick things off with shares of Affirm. Now, shares of the buy now, pay later platform are extending losses from yesterday's session and are on track for a record one-day decline today after the company offered a current quarter and full year forecast that fell short of expectations. Now, for the third quarter, Affirm sees revenue coming in between $325 and $335 million, with the midpoint of that range below the $334.8 million that consensus analysts were looking for. Now, the company's latest quarterly results were also inadvertently tweeted out a few hours early yesterday, contributing to some confusion and volatility around the stock then. Now, in terms of the market reaction to the results and guidance, Mizuho analysts wrote in a note, quote, investors were likely disappointed by a combination of low take rates for Amazon, higher charge-offs as a percentage of loans held, and insufficient clarity regarding core Affirm volume outlook. Shares of Affirm are down more than 50% for the year to date. Meanwhile, a different story for shares of Yelp. That stock is up and bucking the downward trend of the broader market after the company delivered quarterly results that easily exceeded estimates as more consumers dined out, used Yelp, and helped drive a jump in advertising revenue. Now, overall net revenue was back above pre-pandemic levels at $273 million for the fourth quarter, and Yelp also expects net revenue this year to come in at as much as $1.18 billion. At session highs, the stock was up as much as 10.9% for its biggest jump since November 2020. The stock has certainly pared some of those losses, now up by less than 4%, but again, it's still far outperforming the broader market, which is deeply in the red today. But coming up next, we have the countdown to the closing bell. Stick with us.
Welcome back, everyone. Taking a look at the major averages here. Dow Jones Industrial Average still sharply lower on the day, as well as the S&P 500 and the NASDAQ. And standing by with the key levels to watch going into the market close is Yahoo Finance's Jared Blickery. Jared?
Yeah, let's go straight to the Wi-Fi Interactive because we just hit a new session low in most of the major indices. Here we have the NASDAQ off 2.5%, had been down a little bit more. NASDAQ 100, by the way, reached 3% down. Here's the S&P 500 pretty similar situation in the Dow, the best off of the group, still down almost 500 points. And just taking another look at the VIX here before we move on to some of our heat maps, still just hovering under $30, not $30, the 30 index level, I will call it. Got to take a quick check of the 10-year T-note yield. You can see that's down over 3.5%. And now, as promised, here we get to some of those heat maps. The leaders in our, these are some of my sentiment indicators. Only cannabis and a high yield, not high yield, a low yield, a quality bond fund, LQD. Got the name wrong there. Sorry about that. But those are the only things in the green. And you can see semiconductors off nearly 5%. That's SOX index. IPOs off more than 4%. A lot of these are just kind of sentiment indicators. We have solar energy, Chinese stocks, software, all of these getting sold. It's really an anti-growth theme right now. And you can see that in the sector action as well, except for, well, including energy, because energy as a value stock, seeing some love here. Utilities also in the green. To the downside is those 3 mega cap sectors that are really getting eaten their lunch, or getting their lunch eaten. I think that's the right way to say it. All right, so we got each of these down over 2% or nearly 2%, as we can see there. Want to get a quick check on the, let's see here. I'm sorry, I just rejiggered my entire configuration. There we go. There are those Chinese stocks. And we're going to send it back to you guys so we can get to that final closing bell of this very, very long week.
Well, and Jared, before we let you go, we're also seeing the risk-off mood extend to Bitcoin. How are things looking for crypto this afternoon?
You know, it's funny. You talk about this being a non-correlated asset or a correlated asset. Just check out this chart on the Wi-Fi Interactive, because here's what happened today in Bitcoin. I'm going to put some candlesticks on. This looks like a very similar chart to what happened in the major indices. So definitely a risk-off movement here in Bitcoin. And let's just check out some of the other coins that we have working. Ether, Ethereum, that is now probing lows, not even off of it right now. You can see that's down over 5%. And then XRP Ripple, that is down about 8%, guys.
All right, thanks so much, Jared Blickery, for the breakdown there. Coming up, everyone, on the other side of this short break, we've got the closing bell for you as major averages are in decline across the board. Welcome back to Yahoo Finance Live, everyone. Major averages gave up their leads for the day and for the week. Brad Smith here with Emily McCormick, and hopping on for the market close to help break down this week's activity. We've got Greg Staples, who's the DWS Group Head of Fixed Income of the Americas, and Larry Adam, who is the Raymond James Chief Investment Officer. Great to have you both here with us today. We're going to be checking out the closing bell very quickly here. We've got just minutes left in today's activity, and taking another look at the major averages. The Dow Jones Industrial Average right now is looking at the close down by about 1.4%. We'll round that off to 474 points in negative territory. 82 points lower is the S&P 500. That's lower by about 1.8%. And also in the red, the NASDAQ composite lower by about 2.7%, 382 points in the red there. And this all accelerating off of U.S. concerns that Russia will invade Ukraine. We're continuing to digest any news that comes out of Washington. We've even got updates that the Biden administration is looking to send 3,000 troops there and positioning them. Here's a look at the closing bell.
And that is the closing bell this Friday, February 11th. As Brad was breaking down, we have all three major stock indexes squarely in the red to close out both today's session and the week. The S&P 500 down about 1.9%, the Dow Jones Industrial Average down by more than 500 points or 1.4%, and the NASDAQ Composite down by 2.8%. Those technology stocks, again, coming under pressure and underperforming against some of the other major sectors. But heading back over to our market panel, Greg, I want to ask you first, just based on the market action that we saw today, this acceleration into the close that we had on some of those headlines coming out about Russia and Ukraine. Do you think this move to the downside was an overreaction, or does this make sense to you given the current backdrop on the geopolitical and the inflation fronts?
Like, I suppose it depends on your view as to whether Russia is really going to invade Ukraine or not. I mean, it's sort of a binary situation. Either they do or they don't. And if indeed they roll in over the weekend, probably we aren't overreacting. But I tend to think they won't. I'm not an expert here. And if it turns out that things sort of stand down over the next couple of days, it'll, in retrospect, very clearly be seen as an overreaction.
Then additionally here, Larry, I mean, just thinking through the reality of where we've seen the movement on today's activity in stark reaction to not just, of course, the geopolitical and international tensions, but also on everything that we've seen take place over the course of this week, whether that be on the inflationary front, whether that be on James Bullard as well, and what he's signaled and the size of what the rate hike could be. You carry this all into next week, where we're also going to get some retail sales data, even more of the economic data coming forward, and earnings season continuing to move forward. What is the most important things for investors to be zeroing in on right now?
So I think you bring up a great point. I think the market's been very impatient, right? I mean, we've had rallies, we've had declines this week. You know, everybody was anticipating a good inflation number. You saw the market rally, and then what happened, right? It came in much hotter than expected. You saw it come down the other way. Obviously, you mentioned we've had some geopolitical tensions, and that's led to some increased volatility. But I think the market's going to continue to be on edge until we really get a clear, solid footing on what we see the Fed doing. And I don't necessarily know we're going to get that, until we get some of this data that you were referencing. Next week we get retail sales. We're going to get PPI. We're going to get some information about, what the Fed was actually thinking at their last FOMC meeting. I think all those things are going to be important as everybody tries to get an edge on what the Fed's actually going to do come March 15th and 16th.
And Greg, I also want to get your reaction to this morning's Consumer Sentiment Index from the University of Michigan. Now, the headline index was at the lowest level in a decade, but what really caught my eye was that consumers' one-year inflation expectations rose to 5%, or the highest since 2008. Does the Fed have the tools to keep these elevated inflation expectations from becoming entrenched?
We've seen, I think, more checkered data in the past. Obviously, we saw the sentiment number this morning. We saw mortgage starts earlier this week be a little bit softer. And I think the point is that the data is going to continue to be checkered. We've seen some hot data over the past couple of days with CPI and last week's jobs number, but it's not going to be consistent to that regard. The consumer sentiment that we saw today, I think, is probably a reflection of what they're seeing in terms of prices and concern that perhaps the higher interest rates are going to mean a cooler economy. And does the Fed have the tools to bring inflation down? They do, but it's going to take some time. When the Fed raises interest rate, it's not as if it's a dial that on the other side brings inflation down. It's a much more indeterminate, complex system. And ultimately, if they do raise interest rates, I think they will dampen demand, but they're not going to get inflation down to the level it was, say, in the fall of 2019 pre-COVID. It's much more complex than that.
Do you feel that the Fed will feel pressure of having to get a better kind of dampen on inflation or some type of measure that they can implore faster than even we're anticipating at this point in time? Do you feel that they're going to feel some type of pressure to accelerate their timeline?
I think the Fed's a little bit more of a political animal than they like to admit. They're a creature of Washington. And like right now, of the Fed Board of Governors, there are 3 vacancies that have to be approved by the Senate. And actually, Mr. Powell and Lyle Brainerd themselves have not been approved by the Senate. So I think there's a technical element and a political element as well that goes into play. They're sensitive to that, and that plays into their decision making.
Larry, are we seeing that we're at the point with inflation that this is in fact making consumers pull back on spending in a way that could dent economic growth and economic activity? Or are consumers still going to be accepting price increases, at least in the near term?
Yeah, I think for the most part, consumers are going to continue to spend, especially as, most of us have been still waiting for this second reopening, if you will. And I think as we go into the spring, you're going to continue to see spending accelerate, which will help this economy. But I do think that the negative side of what's happening over in Ukraine is that it could actually build the worst case scenario for the Fed, in the sense that you could see energy prices move higher, which if you start to see gasoline prices go north of $4 per gallon, I think that could crimp consumer spending. And then obviously if energy prices go higher, that could lead to further inflationary pressures. And that could be a double-edged sword that the Fed could be challenged by.
With the activity, Larry, that we saw accelerate in the back half of today's session, what would you be advising your clients, your constituents, and are there any type of rotation strategies that you would be employing right now?
So when you get these types of movements because of geopolitical concerns, I mean, historically, they've been, very temporary in nature. We would continue to look at these buyback as a potential buying opportunity when you see these types of pullbacks. We're pretty constructive for the rest of this year because we do think that growth will remain solid. We actually think that people are overestimating what the Fed is actually going to do right now from a raising rates perspective. And we think the S&P 500 gets up to 50-50 by the end of this year. So by today's metrics, that's like 13-14% upside. So we would be using it as a buying opportunity and, not trying to, time the market for the actual bottom. But I think this is a good time period to get in.
And Greg, what do you think about that? Do you think now potentially could be a buying opportunity for investors? And if so, where specifically are you looking?
Well, clearly, if we're looking about the equity market, I think we've got some choppy periods ahead. Longer term, we are very constructive on the market, but I think we've got to get through the first quarter, maybe, if nothing else, just get through the Fed March meeting, and where there potentially could be some activity there. But I think Larry's got it right. As long as you be measured in your entry points, look for days of weakness, I think you're probably going to be okay over the long term.
We thought it was going to be a smooth sailing session going into Super Bowl weekend. It was anything but that, and we're going to be tracking internationally as well as going into some key economic data next week. Greg Staples, DWS Group Head of Fixed Income of the Americas, and Larry Adam, who is the Raymond James Chief Investment Officer. Thanks so much for taking the time here with us today to break down the markets activity that we were tracking. Appreciate it. And everyone, we got to go back to Jared because he's standing by with his final take of today's activity and really where we netted out at the end of this week, Jared.
Yes, thank God it's Friday, right? Let's go to the Wi-Fi Interactive. And by the way, I just want to say some breaking news here that just crossed one of my screens. President Biden and Vladimir Putin are going to speak on Saturday. This just dropped after the market closed, so we'll see what comes of that. Maybe a little bit of good news there. Here's the NASDAQ down 2% this week, and not the biggest loss, but when you consider where it was only yesterday and the day before, that's a much bigger loss. And in the context of some of the bigger moves that we've seen, just par for the course for this year. Here's the Dow. You can see it's down 1%, and here's the S&P 500 down 1.75%. The only thing in the green that I'm seeing in terms of indices, the Russell 2000. That's actually up 1.5% today. So market currently dealing with a Fed that has to deal with the highest inflation in 40 years. Vladimir Putin potentially invading Ukraine. Going to be a lot to dissect this weekend, and Monday is going to be very important as well. Let's take a look at the bond market because that has been extremely volatile as well. Got that huge surge up on that CPI print on Thursday, and then we just reversed a lot of it today. That is a big move in the bond markets, and not surprised to see equities doing what they're doing. And here's the US dollar index. US dollar is now up about 0.7%. Doesn't seem like that much, but for the US dollar, that's a decent medium-sized move, I would say. Bitcoin, we took a look at Bitcoin, definitely a correlated asset in terms of what it did today. It dropped with equities prices on that news about the Ukraine. And here's WTI. Indeed, a nightmare scenario for potentially Chair Powell, because rising crude prices, that means higher inflation, and it does eventually weigh on growth. So a lot to go through here. Let me just actually dial up the sector action for the week. And let's see, I have to go back to my other page, and here we go. A 5-day view of the sector action reveals energy, materials, and financials. Well, financials is just about break even there. Those two sectors were in the green, and that's really all about the value trade. Tech just taking on the chin, down another 3%. That has seen the biggest losses this year, so going to be really important to see what comes of Monday. But until then, I'm going to be taking a much needed break, guys.
All right. Yahoo Finance's own Jared Blickry. Jared, we appreciate the breakdown there. And continuing on in that conversation, particularly around the oil impact to inflation, and then additionally on the international front, we want to bring in Yahoo Finance's own Rick Newman. Rick, first we got to start with Biden and Putin going to be speaking on Saturday. What do you make of that?
Well, we'd all love to be in that conversation. Don't invade, Vlad. Stop telling me what to do, Joe. Will this change anything? Probably not. Putin has many grievances. They've talked before, and it doesn't seem like a last-minute conversation is likely to change anything. But I guess it's better than them not having a conversation. This can, one of our prior guests said this, is a binary outcome. And I would just like to say, I don't think this is a binary outcome. We don't know what Putin really intends. And there are many, many different things he could do. He could do the full-on invasion that the armchair generals are all analyzing right now. He could blockade Crimea from the Black Sea to the south without invading, just to cause economic pain. He could conduct electronic warfare without a physical invasion. He could go in and back out. He could just menace Ukraine for months or even years and keep everybody guessing about whether he ever intends to go in. So I don't think this is something we're necessarily going to know the outcome to within a few days. And that in a way might be the worst case scenario for markets. If nothing happens, I think we will probably see energy prices relax a little bit. But if this tension just continues in any real tangible form, it is trouble for both the gas and the oil markets.
And Rick, these fresh geopolitical tensions are coming amid ongoing concerns over inflation here in the U.S. President Joe Biden has said previously that it's primarily the Fed's job to bring down inflation as part of its price stability mandate. But where's the Biden administration in its response now, as we had CPI inflation jumping by the most since 1982?
Biden's in a real jam. He needs to make it look like he's doing something, but there's just not much the president can do about inflation. I've been noticing on Twitter and other social media, there have been clips popping up of Gerald Ford in 1974 giving his big speech about we must whip inflation now, the famous WIN campaign, which was feeble and didn't work. And, Joe Biden's first term in the Senate was during when President Ford became president, and he gave that speech. So Biden ought to remember how embarrassing it was for the Ford administration to say we're really going to do something about inflation when it turned out there was nothing they could do. It did take the Federal Reserve many years to get inflation under control back then. But Biden's in not quite as bad a position as Ford was then. Inflation was in double digits in the 70s, and it peaked close to 15% in the early 1980s. But there's just not a lot he can do. He says he's doing things trying to make U.S. producers more competitive, more domestic manufacturing. None of that is going to make any difference to inflation in the short term. And this probably also further reduces the odds of this Build Back Better plan passing Congress this year, because the one key senator who opposes it, Joe Manchin of West Virginia, he keeps saying this will make inflation worse, not better. So we really better not do it. So I just don't think there's much Biden's going to be able to do all year. He's relying on the Fed to handle this problem.
All right, a lot to keep track of there. And of course, just to remind our viewers, we're going to keep tabs on whether the White House confirms that President Biden and President Putin of Russia are going to be speaking on Saturday. And then additionally here, while we have you, Rick, you got to break down the latest on the trucker protest for us. Where things stand right now, this is continuing to impact everything from automotive production to just the ability for the supply chain to continue to operate.
I mean, I think these guys should go home. They're not going to go home. They're getting Canada's attention and basically some of the world's attention right now, including concerns that these protests might spread to the United States this weekend. It's not clear what the truckers want. They say it's about vaccine mandates, unfair, that they say are unfair. I mean, we are all so tired of COVID and all the inconveniences and disruptions. There's nothing special about truckers. I guess they want to be able to cross the border without having to prove they're vaccinated or self-isolate, but everybody else crossing the border for any reason has to do those things. So there's no reason that truckers shouldn't be treated like everybody else. And come on, we have supply chain disruptions already, especially in the auto industry, where plants in Canada can now not get parts from the United States because these guys have shut down the bridge between Michigan and Ontario. Look, we do not need, this is basically an attack on the economy. This is the wrong time to do it. It's the wrong way to do it. And these guys should go home.
Yahoo Finance's Rick Newman, thank you so much for breaking down all of these stories. We'll continue to track them and bring our viewers the latest. See you, Rick. We'll talk to you later. All right, guys. And coming up on the other side of this short break, are you about to retire but trying to put together a strategy to beat inflation? We've got more as part of our retirement series brought to you by Fidelity Investments on the other side of this short break. Welcome back, everyone. Is there a correlation between the stock market and the Super Bowl? Our next guest has run a historical analysis correlating the key moments in the big game to equity market price action. There's even a Brady indicator. Well, perhaps that's not going to be in use this year. Ryan Dietrich, who is the LPL Financial Chief Market Strategist, joins us now. Ryan, because there's actually data to back this, who should investors want to win the Super Bowl?
Well, first off, full disclosure, right? You probably shouldn't invest in this. This is a fun thing this time of year that we do. But I'll tell you, you look back historically here, the NFC, when you look historically, the NFC does actually a lot better. The stock market's up 79% of the time when the NFC wins versus about 2/3 of the time when the AFC wins. And the returns are actually a little bit stronger also for the NFC. So you'd say, if you look at history, you might side with the NFC.
So Ryan, just taking a look at this data, were there any exogenous factors, common exogenous factors that were happening during years where the S&P was positive when the NFC teams did win the Super Bowl that we could potentially point to as something that perhaps was the underlying cause for the stock market rising?
You know, I wish that there was. Again, we looked. I mean, it's pretty fun. I do want to get something. I'll be right back here. Here we go. All right. So I do have to show you guys something. I am a Bengals fan. All right. So there's my Joe Burrow jersey. I've been wearing this. They've won every game since then. I'm originally from Cincinnati. Here's one for you. The AFC, though, I said it wasn't all that great long term. 10 of the last 11 times the AFC won the Super Bowl, the S&P 500 was higher. All right. So historically, as a Bengal fan, I had to find a reason to root for the Bengals. And lately, AFC wins have done very well. So it's a playful thing you talk about. You don't want to invest in it. I'll just say very quickly, though, guys, with the Russia, Ukraine, we looked at all the major geopolitical events that have taken place since World War II. Here's the truth, all right? You see about a 5% correction. I'm talking World War II, we're talking 9/11, all these major things. And in about 3 weeks, usually the S&P makes up for it. So it's very serious what's happening out there right now. We're not part of the world. But from an investment point of view, if the economy is still pretty strong, and we think it is, you probably want to use this as a buying opportunity potentially, and to root for the Bengals because AFC has done better lately.
Okay, and so as we're going into this game, naturally there are a bunch of other things that you've been able to track over the years. Yep. And the Brady indicator, because I brought that up, I just, for my own edification, would love to know more about that. I love that you grabbed your Bengals jersey, and you're probably loving that you don't have to face Tom Brady, or didn't have to face Tom Brady in the run up to getting to the Super Bowl.
That's a good point. I'm glad he's not there. You're right. But yeah, the Brady one's a fun one, right? So Tom Brady's made the Super Bowl 10 times. He's won it 7 times. Kind of a real simplistic thing we looked at was the Brady indicator. When Tom Brady wins the Super Bowl, the S&P does really well, like up almost double digits. It's when he's lost the Super Bowl, you've been down almost double digits. Again, this is totally random, but just more fun. But the Brady indicator would say if he were in the game, you'd probably root for him to win if you were a bull.
Ryan, on a more serious note, you brought up some of the geopolitical concerns that we're seeing between Russia and Ukraine right now. I'm wondering, indicators aside, what do the fundamentals and the macroeconomic backdrop tell you right now about what kind of volatility investors should be expecting, and whether we could potentially be seeing more days like today in the near term?
Yeah, here's the truth. We probably will see more days like today, not just on the 2% down, maybe 2% up. You know, we had last year gained 27%, only a 5% correction all year. Come on with you guys a couple times saying, listen, this year's not going to be, we're not going to be as spoiled. We think, you know, a 10% correction, maybe 2 this year could happen. And don't forget, midterm years historically are the most volatile of the 4-year cycle. You see a 17% peak to trough correction in a midterm year. But the truth is, again, earnings have been super strong this earnings season. I know Facebook dropped the dud, but earnings have been really strong. And I know that today's consumer confidence number wasn't that great with the Michigan consumer confidence, but what we're seeing, consumers are still spending, jobs are still strong. So the underlying pinnings of this economy, in our opinion, are still very, very healthy. I mean, look at the industrial metals. They keep going up. I know some of that's inflation. I think some of that's global demand. In fact, I think a lot of that's global demand. Copper wouldn't be bringing out the new highs, aluminum making new highs. I mean, those are positive signs in our view of the global economy. So this volatility could be here to stay, but we'd stick with the thesis. This is still a global bull market. Stick with cyclical value. That's still one of our favorite areas.
And so even as we're kind of taking a look at the major averages and where they finished on the day, we were having some discussion with our markets guests a few minutes ago, and particularly around whether or not there would still be some of that buy on the dip type of sentiment in play, considering now you have the added thread of the international tensions escalating to the extent that they have right now. And we'll see to what extent conversations take place over the weekend between the U.S. and Russia. What particularly would you be watching for on any type of buy on the dip sentiment in this regard?
Yeah, well, it's been interesting. You mentioned the market weakness we've seen. What's one thing we've seen as market weakness, right? We've seen yields actually go up. We've seen technology not be the safe haven that it's been before. We've seen financials and energy do well. So the message of the market, I hate to say this time is different, but really since a QE world 13 years ago, this weakness, we're seeing a different reaction. So I think investors need to be aware of that. But also, the S&P is just trading kind of, in between its 200-day and 50-day moving average, kind of just going sideways, really. We're almost gone nowhere since September. year. Okay, if you look at the S&P, honestly. So yes, it's not perfect. We're down for the year. Nasdaq's down, I think, 12% for the year after a big rally. So just some consolidation. The first and second quarter, again, of a midterm year, guys, is like two of the weakest quarters out of all 16 quarters of a 4-year presidential cycle. So just kind of be aware of these things. But still, when all is said and done, earnings are justifying things. Technology earnings have been amazing, right? I mean, we've seen some really strong earnings across the board. That says we're not probably going to fall into recession anytime soon, in our opinion.
All right, Ryan Dietrich, LPL Financial Chief Market Strategist, joining us here today. He's got the jersey.
He's got the jersey up one more time. There it is. There you go.
You just need a cigar now, and you've got the complete outfit, I suppose.
I hope so. I hope so.
The game. Definitely. Ryan, appreciate the time here with us today. And everyone, on the other side of this short break, if you're gearing up for retirement and looking for a strategy to combat inflation, we've got the details for you after the break.
Welcome back. Let's get one more check at where markets closed about 26 minutes ago. Taking a look at the three major stock indexes, we can see a lot of red across the screen. The Dow Jones Industrial Average down by more than 500 points, or about 1.4%. The S&P 500 down about 85 points, or 1.9%. And the Nasdaq Composite down by about 2.8%. Now, the S&P 500 closing both today's session and the week lower, as we've seen volatility renewed across risk assets. But shifting gears now, with consumer prices rising by 7.5% on an annual basis, investors are having to get savvy to make sure their assets aren't getting crushed by inflation. Ken Murray, Retirement Planners of America Senior Retirement Planner, is here to break down some strategies for hedging against and beating inflation. This coming as part of our retirement series brought to you by Fidelity Investments. Ken, thank you so much for joining us this afternoon. Where do you think investors should be looking in particular right now as opportunities to outpace inflation?
Well, you know, I'm a student of history, and I got into, I don't know if you can see this, but I got into my DeLorean, and I went back to 1982, the last time we had the worst inflation that this inflation now seems to be actually eclipsing, and looked at what happened back then, and how would you have addressed that strategically during that time. The interesting thing is that when you have a lot of inflation, what happens is that as prices go up, companies want to protect their margins. So what they do is they raise their prices as well. And the dollar amount of their profits goes up, even though if you take inflation out, it really did not go up. But stock prices generally are a reflection of profits. So if profits are being inflated, then the stock prices will be inflated as well. So generally speaking, the best investment vehicle that you have to combat inflation with are stocks. And we've seen what they've done recently. Now we've got volatility right now, but stocks tend to be the best inflation fighter that you have, historically speaking.
Okay, and so if volatility persists, how then do you need to shift your strategy, your plan?
So thank you for asking that, because part two of the story is that as prices go up, eventually what happens is the consumer is priced out of being able to buy anything. And so if they start feeling the effects of that inflation, then they stop buying and profits now are going to get hurt. And when profits get hurt, the stock prices go back down again. So again, if you look at 1981 leading into 1982, the stock market went way up. It was a quite remarkable run. But then when inflation got too much for the consumer to bear, then we saw one of the worst bear markets we've had in the modern era. So if the Fed is not successful in controlling inflation, then we could see another big bad bear market. So diversification is extremely important, especially if you're over 50 and the people we work with are within 5 years of retirement or they're already in retirement. So that 10-year period, I'll say, if you're in that period, diversification, not being overly risky is extremely important, but then also having a stop loss strategy is very important. And in our firm, we call it invest and protect.
And you did mention this other variable, of course, being the Federal Reserve and monetary policy. And you mentioned that, of course, as earnings get inflated, stock prices do tend to go up as well. But I'm wondering, on net in this environment, do you expect the Fed tightening because of inflation to have on net a dampening effect on stock prices because of the valuation hit?
That is the $1 million question. Yeah, if the Fed can engineer a soft landing, as everybody hopes they will, and they can raise interest rates in a way that doesn't break anything, then I think profits will continue to increase and the stock market should be okay. Now, if the Fed goes too fast, it's kind of like you're in a car, the Fed's driving, and you're holding a cup of coffee in your hand. Now, if they slam on the brakes, you're going to spill hot coffee all over yourself, and that's not going to be very much fun. So the hope is that they can keep things on a smooth, even keel, keep the markets properly informed about what's going on so nobody panics. But the important thing is make sure that you are properly diversified and you're only taking as much risk as is necessary to accomplish your financial goals. Being greedy right now and trying to go for outlandish returns, I think, would be detrimental, again, especially if you're over 50. And then also having a strategy to say, you know what, this is not where I want to play anymore. And you want to shift your assets out of equities and potentially into safer assets as well.
Have you been able to quantify for your clients how much inflation has actually impacted the amount that they should have ready for retirement and where it'll even impact their lifestyle post-retirement?
That's an excellent question. One of the exercises that we go through with clients and prospective clients is we do what we call a retirement cash flow plan. In that plan, we look at how the sources of income that you're going to have, and we also look at your expenses. And we apply an inflation assumption to that. And we've always used a 4% inflation assumption, even though we've had periods over the last, it seems like decade or two, where it's been 2% or less. And so we always, in our projections, estimate a higher inflation rate than we think will actually happen. So yes, we do account for that. And especially if you're going to be retired and living on the money you've accumulated, inflation is one of your worst enemies. Bear markets and inflation and taxes. Those are the three enemies you need to mitigate or defeat if you can.
All right, Ken Murray, Retirement Planners of America, Senior Retirement Planner. Thank you again so much. With Super Bowl ad spending reaching new highs this year, we'll break down what to expect from this weekend's lineup of high budget commercials during the big game. That's up next. The Super Bowl halftime show is always a major part of the annual sporting event and a big boost to the artists performing. We have Yahoo Finance's own Ali Canal with us now for a breakdown of how artists are seeing streaming bumps from after the shows. Ali?
That's right, Emily. Super Bowl 56 is just days away, but the big game will not only be about football. We got to talk about all of those performances. This year, we have hip hop icons Dr. Dre, Snoop Dogg, Eminem, Mary J. Blige, and Kendrick Lamar all set to perform at this year's halftime show, the third production from the NFL's partnership with Jay-Z and Rock Nation. Now, I do have to mention that it was revealed last night that Snoop Dogg was sued for alleged sexual assault and battery. It is unclear at this time whether he will still perform at Sunday's event. Representatives for the rapper did not immediately respond to Yahoo Finance's request for comment, but that's something that we'll be keeping an eye on heading into Super Bowl Sunday. But when we talk about halftime performances more broadly, the NFL famously doesn't pay their Super Bowl halftime performers, but normally that post-performance surge many of these artists see is often worth the lack of a paycheck. So just taking a look at some of the past performers, last year, The Weeknd saw nearly every song he performed land on the Rolling Stone Top 100 Songs chart, in addition to his 2020 album, After Hours, delivering a sizable bump in sales. The year before that, Jennifer Lopez, Shakira saw sales increase of over 1,000% with 16,000 digital downloads sold. Also had significant bumps on Spotify. J-Lo Spotify streams surging 335%, while Shakira's jumped 230%. Other artists, including Maroon 5, Justin Timberlake, Lady Gaga, they've all experienced significant post-Super Bowl sales and streaming spikes, as you're seeing on your screen now. And these numbers, they're very significant, over 500% increases for most of these artists when it comes to those same-day music sales. So it's all about the exposure, the millions of eyeballs that are watching these performances. And it's a good lesson that sometimes you don't need to get paid directly to still be able to cash in. So I'm excited for the halftime show this year, and it's a lot to look forward to for these artists as well.
I'm definitely also looking forward to it. Yahoo Finance's own Ali Canal, thank you so much for that breakdown. As we continue to count down to the kickoff of the big game this weekend, Super Bowl ad spending soared to a record this year, with some marketers spending an all-time high of $7 million for seconds of airtime. Eric Huberman, Hawk Media founder and CEO and author of the upcoming book, The Hawk Method, joins us now for a breakdown of the supersized commercial spending. Eric, high-budget commercials have become a hallmark of the Super Bowl. How do you expect the ads that consumers will be seeing this year to compare to the ones that we've seen in the past?
Yeah, I think it's always a reflection on culture and what's going on. That's what marketers are trying to do, is comment on culture. And so we're going to see a lot of ads that have to do with inclusion and diversity. We're going to see ads that have to do with crypto and crypto.com making their big debut at the Super Bowl. We're going to see a lot of getting out, adventure. I believe there's some reports of still talking about vaccinations. So we're going to be seeing a lot of that. And then always the home runs at the Super Bowl are a combination between comedic ads as well as that more wholesome, touching the soul kind of ad. And I think those are the two that usually win. So we're going to see a lot of all of that, but you're probably going to see a lot of things tying back. You're going to see Meta coming out with an ad. You're going to see a lot of metaverse discussion. So things that have to do with what's relevant in the news as well.
It's particularly interesting because this is one of those times where a lot of the people viewing the game itself can decide whether or not, and they perhaps make up their sentiment mind at that point in time, whether or not they want to engage with a brand after a Super Bowl ad that they see. You mentioned Meta and Meta Platforms, their ad, I believe we're showing it here on the screen right now, and how critical it is to get an ad right for the future customer value, the lifetime value that you're looking for, even after this particular announcement or product drop or service launch.
Yeah, it's always been critical. I think now we have that feedback loop. So, prior to this, you wouldn't see the immediate feedback on, are people going and watching this on YouTube? Are they actually going to engage with the company? And now you can actually tie this back to results. And we talk about, thank you for mentioning the book. In that book, we talk about the 3 pillars of marketing: awareness, nurturing, and trust. And with a Super Bowl ad, you can kind of cover the 3. You can create new awareness. It's one of the most viewed things, period. But you also build a lot of trust and, that trust factor, because by nature, having a Super Bowl commercial kind of solidifies you as a real company, a real thing to experience. You're hitting such a wide array of people at a time when they're all getting together, watching something, having fun, enjoying something. So there's a lot of benefit to it. And I think we're going to see a lot of positive outcome from this, as well as you said, people are going to really be looking at what is the effect after the fact. We're really going to be able to tell the winners and losers more than ever.
And speaking of winners and losers, is there a discrepancy between some companies in how they measure success from their Super Bowl ads? I mean, is it all about sales dollars that come in post-ad, or is just having a viral moment sometimes enough?
I'd say you just nailed it. It can be either one. It depends on what the company's trying to accomplish. Sometimes it is sales, but frankly, if you're just trying to drive sales, there's probably better performance marketing channels that you can do that will show more uptick in just direct revenue. Again, the credibility of a Super Bowl ad, the virality of a Super Bowl ad, the reach goes a lot wider. You also have different companies that have different abilities to monetize it. Why you see some of the biggest advertisers like Google, Frito-Lay, Budweiser, they're trying to reach an audience to make sure that when you go and buy a beer or buy a bag of chips, you're picking their brands, versus some of the online companies and the digital companies that they need you to go directly to them. So there's differences in distribution from these companies that allow them to take different levels of advantage of a Super Bowl ad.
What's the advantage of making a big game ad, but not running it during the game itself on the televised event and the game that so many people are spectating, but there's also the second screen experience where people are having their social commentary and chat on social media during and throughout the game as well. Where is kind of the analysis for brands to say, we either run an ad in-game during the actual broadcast versus we just want to be in the space that everybody else is going to be having the discussions in?
Yeah, so the impression cost of the Super Bowl is expensive. It's known, $7 million a spot. It is 6 to 7. It is very expensive to run a Super Bowl ad on the Super Bowl, but I think it goes back to human behavior. We've almost trained Super Bowl audience to want to see ads. I'm one of them. We want to see what are the fun creative ads like the one being displayed right now. That was a great one that are fun or heartwarming or whatever that is. So people are looking for great marketing during this period. It's almost become a part of the culture. And so it is a great time if you really think you can stand out. It's also very noisy. Everyone's doing it. But if you can stand out, you may not need the Super Bowl itself to be that distribution. So it is a good time to release your version of a Super Bowl ad, whether or not you can justify actually running it during the Super Bowl.
And again, going back to this idea of costs and the record amount of spending that we're seeing during this year's Super Bowl, between $6 to $7 million per 30-second slot. Every year, we've really seen the price of a Super Bowl ad continue to creep higher. When do you think we'll see the ceiling here, or is this just going to be continuing to build as an arms race in terms of how much companies are spending on this?
Yeah, I think it has to do with the audience. Population growth as well as audience growth. I know the Super Bowl is expanding into international in a very strong way. They're having different teams actually take on different countries. So this could become more international, which means that those ad dollars could go further and they can continue to charge more. There's also inflation, which I know a lot of the rest of the show has been about, that causes the price to go up as well. And I think that combination, it probably will continue to go up unless for some reason, which I don't anticipate, but football doesn't become as interesting of a thing anymore. I know we've had a little of direct viewership decline on the Super Bowl the past couple of years, but I don't know if overall viewership after the fact, the streaming side of it, et cetera, has actually had any hit. So I think unless again, something happens to the actual Super Bowl, we'll probably see the price continue to increase and it be worth it.
All right, Eric Huberman, Hawk Media founder and CEO and author of the upcoming book, The Hawk Method. Thank you again so much. It's not just the Super Bowl airing on Sunday. The series Bel-Air makes its streaming debut this weekend as a new take on the Fresh Prince of Bel-Air. We'll have a chat with the cast of the reboot after this short break.
Welcome back, everyone. Now this is a story all about how Fresh Prince got turned into a reboot. New faces, new platform, but hoping for similar success to the original sitcom that won an NAACP Image Award for Outstanding Comedy Series. Here with more, we've got Yahoo Finance's Ali Canal. Ali.
I love that intro, Brad. You got me dancing on this Friday. But yes, the Super Bowl will not be the only thing to watch this Sunday. Peacock's Bel-Air will be making its much anticipated debut. The new series is a reimagined modern day take on the 90s sitcom, The Fresh Prince of Bel-Air. Now, how the show came to be is honestly out of a movie. Filmmaker Morgan Cooper had the idea to make a dramatic version of the beloved comedy. He made a trailer, put it on YouTube, and less than 24 hours later, he was in contact with Will Smith, who helped bring this show to life. I had the chance to speak with Morgan about that entire experience, including what it was like to work with the one and only Will. Take a listen.
The trailer, we uploaded it. We spent no marketing dollars on it. There was no publicist. And so the traction we got on it was all organic, which I think made it that much more impactful, that it found its way onto Will's desk. And as the story goes, apparently he was down filming Bad Boys 3, and he ran out of his trailer screaming, y'all see this? Like, he just went crazy. That meant so much to me that Will really appreciated it, because it came from a pure place and really wanting to honor, what he did and what, James Avery and the rest of that incredible cast did 30 years ago, while reimagining that show as a drama.
Bel-Air, it ended up on Peacock, but there was a bit of a bidding war amongst all the streaming giants. What was important to you when searching for the right streaming partner, and how did Peacock ultimately fit that bill?
Yeah, it's a great question. It was an incredible process, super chaotic. I'll never forget that week and a half of taking the show out. And, there was so much interest in the market. And ultimately for us, we were looking for a partner who, really believed in the vision ultimately, you know what I mean? And really wanted to preserve the vision that I had for this. And it was not only that, but also who was willing to support it through a commitment, through both a financial commitment, and, a very competitive offer in terms of a series order. And Peacock, they threw the gauntlet down with the 2-season order, and that really demonstrated their commitment and belief in this project.
You wear so many different hats here. What was the most challenging part for you, and who or what did you lean on throughout that creative process?
COVID, is a huge challenge from a filmmaking standpoint, especially a TV schedule where that train just has to keep moving to hit those release dates. And so, COVID was definitely a challenge, but, we all lean on each other, and Will, throughout the process, has been just so generous in offering wisdom and just being able to tap in time to time and just say, hey, you doing okay? Like, really like what I'm seeing. To tell the story of a family, I always felt like you had to build a family. You know what I mean? And that's what the show ultimately feels like. It feels like one big family. And so we're all there for each other through thick and thin.
And speaking of that family, I also had a chance to dive deeper into the series with the cast. That's right. We have a new Carlton, a new Uncle Phil, Aunt Viv. These are beloved characters, and there's a lot of responsibility that comes with that. So we discussed that element of things in addition to what fans can expect. Take a listen.
I love being compared to the first, but it is not. We're all thankful for the first, and that's what laid the groundwork.
Mm-hmm.
But because this is an hour-long drama, you're going to see stories and plot lines just thickened.
I think in the OG we saw I saw myself in Will, going through, but I think in this one you can see yourself in everyone, because we all get a different angle of the human experience.
You're taking on characters that were so beloved in the original Fresh Prince. How do you handle that responsibility while also bringing your own take to the roles, especially since the tone of this series has shifted a bit?
I always say we're standing on the shoulders of giants. And so it's not really about trying to put on a coat that isn't mine. It's more about trying to build on the legacy that we already have right there.
I just wanted to be as authentic as I could be, and not feel the pressure of having to be a cookie cutter of what he was, and I know that's not what he would have wanted for me to do either. He'd want me to just take it and just connect with it the way I connect with it in this modern modern current time.
Let's talk a little bit about Will Smith. I mean, he discovered Morgan Cooper's extended trailer on YouTube, which is how this series came to be. What has he shared with you guys when it comes to advice or lessons learned?
He really trusts everybody that, is involved in it. And I think that's the most, admirable part about him.
I remember the first day that we all sat down at the table read, and we're all like freaking out. It's like, what's happening? And I remember the showrunner sat us down and they're like, hey, Will Smith and the entire Smith family wants you to know that you're about to embark on one of the wildest, craziest journeys of your lives. So first of all, take it all in and take it moment to moment. And second of all, just know that they are at your disposal for anything you need. And that, I think, speaks to his character and just the type of man he is.
Well, for me, I was really just grateful. He signed my book and he wrote, I love how you're filling those shoes, and that was just I got to see his seal of approval.
If you've read Will's book, there's another book to come out because this show is going to be a part of his legacy and that canon.
Clearly a lot of love for Will Smith. And fun fact, he was one of the first celebrities I had the chance to produce, and he was so nice. I remember he complimented me on the jacket I was wearing, so I immediately loved him. Will Smith is great. And if you're looking to watch Bel-Air, the first 3 episodes are available to stream on Peacock this Sunday. Back to you guys.
Alec, now, thanks so much, and excellent interviews there as well. We're all going to be tuning in to see how the new Bel-Air reboot does. And everyone, coming up, we've got a big week for retail sales data upcoming. We're going to preview what to watch for next.
Before we say goodbye, we want to let you know what we have on our radar for next week, especially after this volatile week in trading that we just ended. Now, Brad, I'll kick things off with the economic data calendar. The retail sales report from the Commerce Department will be the big print that I'm watching on Wednesday before market open. Now, for now, economists are looking for a rebound in retail sales for January, with consensus looking for sales to rise by 2% month on month after a 1.9% drop in December. Now, that had mostly been attributed to some pull forward in holiday holiday shopping last year. But two things to note in this latest monthly report. Now, one is that the jump in Omicron cases is expected to have contributed to a shift to goods spending rather than services. So that may have boosted retail sales. And then number two, retail sales, we should note, is reported in nominal terms. So the increase in inflation that we saw in January also likely to contribute to a boost to that headline number on Wednesday as well. And in addition to retail sales, one of the biggest retailers, Walmart, will also be reporting earnings before the bell on Thursday. So two reports to definitely be keeping an eye on next week, Brad.
And continuing with the earnings theme for what we're going to be watching out for, I'm watching out for accommodations, and particularly in the creative accommodations, if you will. Airbnb, they're going to be reporting earnings, ticker symbol ABNB. Keep a close eye on that ticker symbol as we move forward throughout the week next week, and particularly also going to be looking at Marriott. But there you're taking a look at the past 3 months to see how Airbnb is doing, and they are down over that time by about 13%. It's particularly interesting to track Airbnb versus some of the other behemoths out there like a Marriott that are going to be reporting, because if there's anything that we have noticed from the mind of consumers right now and the trends of consumers, they've been looking for more of that experiential accommodation stay over the course of the pandemic, and knowing the cleanliness routines that come along with some of those Airbnb hosts as well has been critical. We had a conversation earlier this week with Trivago CEO Axel Heifer, who also gave us some insight into what they were seeing at this point in time and over their most recent quarter. And so accommodation space, going to be watching that. Also going to be watching earnings from NVIDIA. We've been keeping a close eye on the chip sector here. And as we were breaking down where even some of the geopolitical and international tensions could weigh on chip manufacturing and sourcing, particularly some of the raw materials that are necessary, NVIDIA is going to be in focus here. It'll be interesting to see where their gaming unit, of course, the GPU business, that is typically where they see the most outsized impact for their business. And with that bringing home the majority of the revenue, that's going to be interesting to watch to see where those figures come in at as well, everyone. But that's going to do it for us here today and for this week. We hope you enjoy the weekend and have a great Super Bowl weekend as well from myself, Emily, and the entire production crew. Have a good one. See you Monday.